683 sats compared to about 191,904 sats in July of 2025, which is an increase of about 6% year over year. Year-to-date BTC yield is currently 4.5% compared to about 22.8% for the full year 2025. BTC gain is approximately 30,000 Bitcoin year-to-date, which is about 30% of last year's full year gain. And in dollar terms, BTC dollar gain is approximately $2 billion year-to-date compared to about $8.9 billion for the full year 2025. Despite the significant drawdown in BTC price year over year, we continue to execute positive performance across all of our core KPIs. Since 2020, our Bitcoin per share has increased from approximately 46,000 sats to 203,000 sats, which is more than a 4x increase over that period. And in 2006, we have delivered, as I mentioned, 4.5% BTC yield year to date. As you can see here, historical annual BTC yield performance does move sort of in conjunction with Bitcoin price. In Bitcoin bear markets like we saw in 22 and 23, BTC yield was lower than the bull market years of 24 and 25. That being said, BTC yield this year does have the potential to outperform the prior bear market if BTC price improves and through the support and strengthening of our digital credit instruments. On this slide, we show here in Q2, within Q2, Bitcoin per share increased from approximately 201,170 sats at the end of Q1 to approximately 210,824 sats at the end of Q2. Despite the lower price of Bitcoin and the overall market volatility in Q2, the quarter's BTC yield of 5% outperformed the Q1 BTC yield of 3.2%. So we are continuing to make good progress. And lastly, I will end with a quick snapshot on the most recent view from our equity analysts. We added 2 new covering analysts from Barclays and Siebert for a total coverage of now 16. Across the firms shown here, the average analyst Bitcoin price target for those that have one is approximately $98,000. The average MSTR price target is approximately $296, and all with corresponding buy ratings. While we do not endorse any third-party forecasts, it's important to note that the banks are increasing their engagement with Bitcoin, with digital capital, and with a focus on strategy's role within that market. I think the growth also reflects the deep and growing demand from investors as well for independent institutional views on Bitcoin strategy and digital credit, and it helps deepen investor understanding of our business model, our capital structure, and the long-term value we are pursuing for our shareholders. So with that, I thank you all for your time, and I will turn it over to Phong for his remarks.
Thank you, Andrew. Thank you, everyone, for joining us this evening. I'm going to provide an update on our capital market strategy and our capital markets programs. And before I go into some of those details, I do also want to recap Q2 2026. We acknowledge that it was an up and down quarter for Bitcoin, and our common equity and our preferred have gone down in that period of time. But if I look at the key metrics that we look at for performance and health of the business, things are, generally speaking, positive. Our Bitcoin holdings over the course of the quarter increased 11%, from 762,099 Bitcoin to 846,000 Bitcoin. We reduced our debt outstanding from $8.2 billion to $6.7 billion, and on a net debt basis, we reduced it even more. This was down 18%. Our US dollar reserve is up from $2.1 billion to $2.4 billion at the end of Q2. And as Andrew noted, we're now at $3.75 billion. That's a 12% increase quarter over quarter. And our Bitcoin per share, potentially our most important of our metrics, went from 201,170 Satoshis to 210,824 Satoshis, so a 5% increase. So many of these metrics show health in the overall business. How were we able to do that? 3 months ago in our earnings call, we said that we were adding engines to the strategy playbook, if you will. We went from one-way capital issuance, buying Bitcoin through active issuance of MSTR, of our preferreds and our convertibles, to what we call active capital management. We're able to sell MSTR to buy Bitcoin US dollars debt prefs. We're able to sell our prefs to buy Bitcoin US dollars debt MSTR. And we're also able to sell our Bitcoin to buy US dollars, buy debt, buy prefs, buy MSTR. And we're able to use those US dollars to pay off dividends and to strengthen our balance sheet. We continue to be net buyers of Bitcoin and net issuers of Stretch. We want to be the largest buyer of Bitcoin in the world and the biggest issuer of digital credit in the world. And year to date, 2026, we have proven to be just that. We bought 174,895 Bitcoin year to date 2026. We sold 3,620 Bitcoin during that same period of time. We bought 48x more Bitcoin than we sold, and we increased our Bitcoin 25% since the beginning of 2026 until now. When it comes to digital credit and Stretch, we issued $7.52 billion of digital credit. We repurchased year to date $25 million. We issued 300x more digital credit than we repurchased, and we increased Stretch's notional 250% since the beginning of the year. So I think we are carrying through on our stated objective to be the largest net buyer of Bitcoin in the world and the largest issuer, net issuer of digital credit in the world. Another way to think about our robust access to the capital markets is to look at what we've done year to date 2026. So through 7 months in 2026, we've now issued $17 billion of capital. As you can see here, that's approaching what we did in 2025, primarily used to buy Bitcoin. And you'll also see the percentage of capital that we issued that was digital credit, specifically primarily Stretch, was 44% of the total capital we issued versus 28% last year. If you look at this same information on a quarter-to-quarter basis, Q2, we issued more capital than we did in Q1 of last year, Q1 of this year, and also we issued more capital in Q2 2026 than we did, or we raised more capital in 2026 than we did in any quarter of last year. So $8.4 billion total, of which $5.5 billion is digital credit. Q3 2026, right, so this is the month of July of this year, we've issued about $1.3 billion primarily of common equity. And of course, we want to see preferred equity added to that stack too. And so I'll talk a little bit more about why that's important. We've talked about the flywheel in the past, right? Our overall objective is to double Bitcoin per share in 7 years through digital credit. And why is this important? We want digital credit to work because we're able to sell digital credit to buy Bitcoin. That generates amplification to the company. That would increase our Bitcoin per share for the company, especially as Bitcoin increases. And it allows the company ultimately to do what we have been doing and what we intend to do, which is to outperform Bitcoin. Right? What are the inputs that can help us flex these levers? Decreasing our cost of credit, and we'll talk about that in a little bit. Higher digital credit sales, this is selling more Stretch, and a higher MNAV through accretion of our equity, our common equity, MSTR. So let me talk about the digital credit capital framework and how do we get this flywheel working even better than it has in the past. I'll start with our corporate objective. It's for Stretch to trade at $99 to $100 over time. And we recognize that that has not occurred over the course of the last month. Stretch is now trading at about $89.50. Our goal is to get this back to $99 to $100 because that helps our digital credit engine work and it helps us increase Bitcoin per share and ultimately accrue value to our common shareholders. So about a month ago, we issued 5 pillars that are going to strengthen Stretch and strengthen digital credit. The first major pillar is the US dollar reserve. We recognize the importance of the US dollar reserve to our digital credit shareholders. We had decreased that over time in the month of June, and we realized that it's important to keep it strong. And so we've increased it now to $3.75 billion, which is about 2.1 years worth of dividend coverage, dividend and interest coverage. And we're going to keep 1 year a minimum. And I'll talk a little bit more about that in a minute. Bitcoin monetization, selling Bitcoin for 3 purposes. 1, to fund US dollar reserves. 2, to fund dividends and interest expenses. And 3, to support our repurchase programs. And those are our third and our fourth pillar. The ability to repurchase digital credit up to $1 billion. We've repurchased $25 million so far year to date. And to repurchase MSTR up to $1 billion. And the fifth and last pillar is to manage our Stretch dividend in a way that it's thoughtful and supports the price of Stretch while also reducing our dividend burden. And we can review that monthly. The good news is we've built now an all-time high US dollar reserve, right? So we started at the beginning of the year in January at $2.25 billion. We drew that down to pay down $1.5 billion notional of our 2029 converts to $871 million. We recognize that that was not the right level to support Stretch and to support our digital credit. And therefore, in a pretty short order, we built it up in about 2 months back to $3.75 billion. 2 things I'll note. 1 is that is the highest our US dollar reserve has ever been. And 2, that on a duration basis, which is how many years of dividend and interest expense coverage we have, our high in January is 2.7 years, our low end of May was 0.5 years. We're now back to 2.1 years, and our target is to be somewhere between 2 and 3 years. I talked about our Bitcoin monetization program, right? Our intent is to sell Bitcoin for 3 reasons when we think it's appropriate for the company. 1, fund the US dollar reserve up to $1.25 billion. That would take our US dollar reserve up to $5 billion if we were to do that fully using Bitcoin, which would take us up close to 3 years. 2, fund dividend interest payments of $1.76 billion currently annually. And we've used Bitcoin sales to fund some dividend payments in the last month or so. And 3 is to fund up to $2 billion in our repurchase programs. So let's talk a little bit more about Bitcoin monetization and Bitcoin sales. This is a subject of much discussion during the month of May and June, so I thought I would provide some more clarity onto why we did it and what we believe the result to Bitcoin was when we did this. First, our first Bitcoin sale in the week ending May 31st was 32 Bitcoin. That was 0.004% of all of our Bitcoin holdings. And why did we do it? We did it to inoculate the market and test our processes. The average cost basis of that Bitcoin is $125,464, which came to a $4 million total cost basis with the proceeds of $2 million and the average sale price of $77,135. We took about a $1 million realized loss in that, and that gives us a potential tax asset, assuming a 29% corporate tax rate of about $400,000. Our second Bitcoin sale was about a month later, in the week ending July 5th. We sold 3,588 Bitcoin, about 0.4% of our Bitcoin holdings, so about 100x more than what we sold the month before. Why did we do that? We did that to fund our pref dividends that were due June 30th of 2026. The average cost basis of that Bitcoin, $116,000, which came to $418 million. The sale price was $60,000. And so our proceeds are $216 million, which we used again to fund our dividends on our preferreds at the end of June. And we took a realized loss of $203 million, which allowed us to potentially book a tax loss of $59 million. If you see here, we have 843,000 Bitcoin, and you can see the size of the bars of our Bitcoin sales are almost not noticeable compared to our total Bitcoin holdings. Of course, then the question is, so the next topic I'll get into is what is our overall potential tax benefit? We showed this slide last quarter. Of all of our Bitcoin, we have about $18.5 billion in unrealized losses, which equals a potential benefit of $5.4 billion on our taxes. So selling high cost basis Bitcoin at a low price gives us the potential to take tax losses that can then offset future capital gains. So did our Bitcoin sales have an effect on Bitcoin price? Right, we have 2 data points, so I don't think we can make a definitive statement, but I thought it'd be useful to look at these 2 data points in a little bit more detail. Our 32 Bitcoin sale was about $2 million that week. And what happened after we sold the $2 million of Bitcoin? Well, in the week that we sold the $2 million, Bitcoin price went down 4%. The week after we announced the $2 million sale, Bitcoin went down 11%. And as a reminder, that was 0.001% of the liquidity of Bitcoin that week. So we were 0.001% of the Bitcoin trading volume when we made those sales. Right, 1 month later, we sold about 100x more Bitcoin. And the week that we sold 100x more Bitcoin, Bitcoin price went up 6%. The week after we announced it, Bitcoin price went down 1%, and we were 0.104% of the liquidity of Bitcoin in the week we sold. Did we have an impact on the price? Based on the liquidity, I would think not. Based on sentiment, perhaps. We'll continue to study this, but we thought it would be useful to share a couple of the data points. Another way to look at this, the bigger question we sometimes ask is strategy propping up Bitcoin price with our purchases? Is strategy moving down Bitcoin price with our sales? Does Bitcoin need strategy? And I think we've said many times, strategy needs Bitcoin. So how would I look at this? As an example, average Bitcoin liquidity has been about $26 billion of trading on a daily basis. If we look at the week where we bought the most Bitcoin in the history of the company, our average daily purchase was $363 million. That's the max, right? In that particular week, we were 1.42% of the trading volume of Bitcoin. If you look at the last 12 months, we would average about $56 million of Bitcoin purchases a day, which sounds like a lot. It is a lot. But as a percentage of the $26 billion of daily liquidity, we were 0.22% of the trading volume of Bitcoin. Bitcoin is extremely liquid. We are a large purchaser, but looking at these numbers, I would say we were not a material purchaser of Bitcoin. What about when we sell? Right, the most we sold so far is $19 million a day. And in that particular week, that would mean that we were 0.08% of the trading volume of Bitcoin. And that's a pretty small number. And if we were to sell to satisfy our $1.7 billion of dividend obligations, that would average to about $5 million a day. And that would be 0.02% of Bitcoin liquidity. All right, so my takeaway from this is, look, we are a heavy participant in the Bitcoin market when we buy, but still not a material amount of the overall Bitcoin market. And we are a very, very small participant in the Bitcoin market when we sell. Back to the other pillars. So repurchasing up to $2 billion of our securities. All right, so this is $1 billion of our digital securities. We have a repurchase program now authorized. $13 billion is our market cap right now of our digital credit. $1 billion has been authorized. We've said we'll prioritize Stretch right now. When would we buy Stretch? When it's trading at a discount to par. How much of a discount? That's subject to management discretion. Might we buy it? We might buy it to reduce our annual dividend, or we might buy it to strengthen the quality of digital credit, and we might buy it to capture net BPS accretion, right? On MSTR, it's about $38 billion in market cap. We have an authorization to buy back up to $1 billion. We have not used it yet. Why might we buy it, or when might we buy it? We might buy it when it's trading at a discount to net Bitcoin per share, which we have not seen that occur on a sustained basis yet this year. Why might we do it? Because we think it would create long-term value by capturing net BPS accretion. How would we do this? We could buy in the open market. We could buy via block trades, tenders, exchange offers. And what's the time frame that we might do this? We have no obligation, no expiration. We can modify, suspend, or terminate this program at any point in time. So how do we get stretched back to par? Right, that is the focus of the company. That's the focus of the leadership and the management team. Right, to climb stretch back to $99 to $100, we can adjust the U.S. dollar reserve. You've seen us actively do that. We can maintain the stretch rate. We're not planning on decreasing the stretch rate to bring it back to par. And we found that increasing the stretch rate is not really an effective way to bring it back to par. So our current plan is to keep the rate right at 12%. And of course, we can buy back stretch, which you've seen us start to do. When we get back to par, we've learned a lot. We've learned a lot about how stretch trades. We've learned a lot about the types of people buying stretch. We've learned a lot about the overall characteristics of digital credit, leverage, what layer 2 players do on top of it. So what would we do? We could manage the ATM issuance, right? We could not issue necessarily as much as we have in the past. We could adjust the stretch rate, in this case down, right? If we see billions of dollars of demand for stretch and we don't want to grow digital credit too quickly, we could adjust the rate down from 12% to 11% to 10% or whatever we see fit. We can manage the BTC reserve, meaning we could decide how much of our stretch proceeds we put into Bitcoin. Historically, we put it all into Bitcoin, but we don't necessarily need to do that. We could put some of it into increasing the US dollar reserve. And of course, we can manage our overall capital structure. We can manage our convertible bonds. We can manage what else is in that capital structure. And then we can manage some of the policies, including the one that I've discussed. The stretch rate is adjusted by observing multiple signals, right? We have a 12% annualized dividend rate right now. And when we return to par, we'll look at things like trading levels, market yields, the Bitcoin market, the US dollar reserve coverage, and the capital structure to determine what the right rate is. And I want to reiterate our capital markets principles that we've shared in the past, and there's 6 of them. 1, we're going to continue to create long-term value for MSTR. That's the most important of our principles, and we're going to do that primarily by increasing Bitcoin per share. How do we increase Bitcoin per share? We're going to do that by growing demand for stretch, getting it back to par, and observe the trading characteristics and learning from that. We're going to responsibly reduce the convertible market debt based on market conditions. We did that in Q2, right? And we would consider doing that on a go-forward basis. We'll monitor stretch demand and credit risk to determine the size of the US dollar reserve. I think we've learned from Q2 that keeping a robust 2 to 3 year US dollar reserve makes sense, and our minimum will be 1 year. We'll adjust the amplification based on market conditions. The price of Bitcoin is a big factor to the amplification. And we'll sell Bitcoin when it's advantageous to the company, which we've started to do, and you could expect that we may do that on a go-forward basis too. So with that, I'll pass it over to Michael Saylor.
Thank you, Peng. I want to spend a moment talking about our credit products and our business model. So let's start with digital capital. We use Bitcoin as digital capital, and we just upgraded our website, and we're making available a whole set of metrics for Bitcoin investors to track Bitcoin as the investment. So what you'll see here is on our website, we're now tracking the real-time Bitcoin price and the market cap, but we've also added the 200-week moving average. We view that as being something akin to the basis in Bitcoin or the book value of Bitcoin. And a lot of Bitcoin movements are anchored to it one way or the other. You'll see that we're actually calculating the premium to the 200-week moving average in real time on our website. And we've also added a pretty neat metric, time above. And what you'll see on our website is that Bitcoin right now, it's trading at a very slight premium to the 200-week moving average. And for about 91% of the history of the network, it is traded at a higher premium than that. And so I'd encourage anyone to go check out this website. It's pretty useful. We've got other metrics like Bitcoin dominance and hash rate, the fear and greed index. You can also see the net ETF flows. They were as high as minus $5 billion or so about a month ago. Now they're coming in. And so this is for people that really want to gauge the status of our capital base, BTC. Now, let's go to the next slide. And what you see here is that that we're, in a phase of weakness. We're sitting now resting right around the 200-week moving average. If you're a capital investor, I say you have to take a 4-year time horizon. So the right price signal to look at is the 200-week moving average. And you see it's a pretty up and to the right message and signal. But you can see the periods of exuberance around late 2021. There was a massive premium. Then you could see in the crypto winter, we fell to a slight discount. And then you can see we traded back to a premium. Right now, we're sitting right on that moving average. Now, if we ask the question, what are the headwinds holding back Bitcoin? We really think there are 5. There's an AI capital expansion, $1 trillion or more of capital that are flowing into the data center build out, the AI center build outs, with the SpaceX, the Google, the Meta, the Anthropic, the OpenAI. And then, of course, you're probably familiar with all of the Bitcoin miners, and they're building out their data centers for AI, and they're extremely capital intensive. That's created capital suction in the equity capital markets, and also an attraction in the private credit markets where massive amounts of credit capital has been flowing. So that's a headwind. We think at some point we'll get through the biggest phase of that build out, and we'll settle into an equilibrium, and that headwind will become neutral, attacking wind, or it'll subside. We also see trade tensions have been weighing on Bitcoin, all the foreign tariff wars and trade wars and uncertainty. The Gulf War disruption is a macro headwind. It's and it revs up and subsides, and things escalate. The Fed policy has tilted to becoming more restrictive over the past 9 months. And we could see even as of yesterday, there were rumors that the Fed might raise rates, and 3 of the Fed directors or governors actually voted to raise rates. So that restrictive monetary policy from the Federal Reserve has been a headwind. And then delays in regulatory clarity. The clarity bill has not moved as quickly as people have expected, and there's substantial uncertainty about when that will be resolved. So those are the headwinds that we face right now. We also think any one of them could become a tailwind or a catalyst. And we think generally Bitcoin has done pretty well in the face of those headwinds. And as we get good news in any of those areas, I think that'll be very positive for the entire Bitcoin market. You can see that sentiment is near a cycle low, and this is the fear greed index. And we track this on our website now, and you can click through and you can see it. So that sentiment reflects itself in a number of ways in our equity price and our credit prices and in the Bitcoin price. But there are many, many positive factors in the Bitcoin ecosystem right now in the industry that I'd like to highlight. One of them is the BTC dominance has been consistently growing since the 2021 low. It's expanded about 20%. And now if you look at Bitcoin's market cap as a percentage of all the market caps of the crypto tokens, not including stable coins, Bitcoin is a bit more than 2/3. And we think this is an incredibly bullish sign. So when I refer to the fact that Bitcoin has won, the race to be the dominant digital capital network and the dominant digital monetary network in the world. I think this metric is one of the key signals that shows that it's one. There really is no serious discussion of a flippening. No one thinks that Solana or Ethereum or any other crypto network is going to flip Bitcoin. Bitcoin is the winner. And that's incredibly clarifying insight, because if Bitcoin is the digital capital network for the next decade, it's more likely than not that it's the capital network for the next 100 years. And we are building our credit structures and our equity structures on top of it. So this is the biggest uncertainty taken off the table over the past 4 years, underappreciated by many people. But perhaps it's more important than any other, week by week, month by month, year by year development in the entire digital asset space. We keep track of banking adoption in this space, and I've noted that the real drivers of Bitcoin price are going to be the formation of credit networks, either digital credit or banking credit. And of course, the banks have the ability to create incredible amounts of credit. So if the banks create credit on top of real estate values increase. And as banks create credit on top of digital capital, on top of Bitcoin, then the value of Bitcoin will increase. By our own Bitcoin Banking Adoption Index, which we just rolled out, and it looks at the top 25 leading global banks, you can see that we've advanced from 9% to 14% to 24% to 32%. And so we think this is just incredibly bullish. We will keep track of this adoption index each quarter, and on our quarterly calls, we'll report back to you as to how things are developing. Another great development this quarter is the formation of the Bitcoin Security Consortium. We worked in conjunction with all of the major Bitcoin investing and custody and trading institutions in the United States in order to form this consortium. And this is in response to a lot of investor requests, a very broad-based sentiment across institutional investors that they have clarity about how the Bitcoin network will address future security concerns. The most well-known one that's been talked about the most over the past 6 months has been quantum computer risk. And lots of investors wonder, how would the network react to a quantum threat should it materialize? And we have joined forces with all of these other institutions to make sure we stay coordinated on that. There are a lot of people doing really good work in the space. The point of the consortium is to support any work that is pro-Bitcoin security related. We all want Bitcoin to be a secure network for the next 100 years. And so I personally have had a lot of enthusiasm for supporting security related work with regard to Bitcoin. I supported security efforts starting about 2020 with my own personal funds. And so this is really the natural evolution of institutional investment in the security of Bitcoin. The intent of the consortium is not really to drive the protocol or protocol changes, but really just to fund investments committed to security and stability of the protocol. And each of the various institutions involved is going to make their own decisions. However, institutional investors would like a common voice, and they would like a coordinated response. And so it will be helpful for the entire institutional community and for banking adoption, investor adoption, and to get positive regulatory adoption and nation state adoption of Bitcoin for us to be able to coordinate and to communicate the work that's going on, and then make sure that we're ready for any security threat that may develop in the future. So a few words on digital credit. Stretch, STRC, is our flagship digital credit product, and we're laser focused on Stretch. Our goal with Stretch is we want to increase the liquidity, we want to decrease the volatility, and we want to build an ecosystem of market participants. We want people that are willing to trade it. We want people that are willing to short it. We want people that are willing to go long and hold it forever. I'm not terribly bothered by the fact that someone might buy it at $88 and sell it at $95. We would love for that to happen. We'd love for another group of people that buy it at 95 and hold it till it goes to 98, and other investors that will buy it whenever it falls below 99 and write it back to 100. And if they don't want to hold it at 100, that's okay. They'll be creating liquidity for other buyers at 100, and that stabilizes STRC. So we welcome derivatives traders, long traders, short traders, anyone that has any particular view, it's fine. If someone wanted to sell $1 billion of STRC short, they would be paying the 12% dividend, and so they would be paying $120 million a year in order to create $1 billion of liquidity to the benefit of our digital credit. So again, we don't really worry about it. We would like to return to par with the broadest, most diverse ecosystem of market participants that we can possibly develop. And so that means sometimes instead of doing things immediately, like we could, return STRC to par very quickly using our own capital, but that would exclude many of these other ecosystem participants, and we would be getting ahead of our equity investors, our credit investors, Bitcoin investors, and the like. So we will move progressively and deliberately with the thought that we want the deepest, richest derivatives market, the deepest, richest credit markets, the deepest, richest equity markets, the most clarity, the most liquidity, and the broadest reach with regard to STRC we can possibly create, and that will be best for everybody involved. You can see our progress toward this here. STRC has grown from 2.8 billion in notional value to 3 at the end of Q4, and then to 5.3 billion at the end of Q1, and then to 10.5 billion at the end of Q2. It's growing quite rapidly, and we're sort of in a hyper growth phase. If we go to the next slide, you can see why it's growing. Simply put, it's the highest effective, the highest tax equivalent yield and the highest effective yield of any major class of credit in the world. And right now we see STRC as competing against private credit and bank preferreds and junk bonds for the most part, those three categories. But we think over time it will begin to compete against investment grade credit, mortgage-backed credit as well. The effective yield is 13.6% right now, but the tax equivalent yield is 21.6%. We think that digital credit is going to be the best credit, is the strongest credit, because it's based upon the strongest capital asset, BTC, and because it's based upon the strongest business model. The digital treasury company business model, based on digital capital, has lots of advantages in creating the highest tax equivalent yield. And so simply put, we think we've created one of the world's great business models for creating one of the world's great products, the product being digital credit. Now, of course, I would think that, but the real question is, what does everybody else think in the world? Well, I think the most sophisticated preferred stock investors in the world could reasonably be considered to be those running the Blackrock PFF fund, the Virtus InfraCap PFFA fund, and the Van Eck PFXF funds. Those are the three largest preferred credit indexes that are publicly traded, and they're custodians of billions of dollars of capital. One thing that you'll note here in the past 12 weeks is that STRC is now the number one holding at all three, right? So it's not a fluke. We used to be the number 3 holding. We crawled up, past everybody in the market to be number 2 or number 3 in a hurry. But in the past few months, we've emerged as the number 1 holding, and it's not a fluke. It's universal across all 3 indexes. So we think this is incredibly bullish because you can develop all sorts of theories about what retail investors like and don't like, but I don't think anybody disputes that a professional money manager who's in the business of managing preferred equities and has been doing it for a long, long time is pretty good at it. And they've got a lot of skin in the game, and they're responsible to the most sophisticated institutional investors that are their investors. And you can see here on this table that we're the security of choice for all 3 and the number 1 security. And that we've got a lot of momentum here, right? When other people were selling, they're actually buying STRC, and I think that's very positive. Who's digital credit for? It's for every investor class, right? We're going to continue to refine it, and we're going to offer it to retail investors, to institutional credit investors, to corporate treasuries, to hybrid hybrid hedge funds and equity investors, and to digital money and crypto native investors. And we think that all 5 of these groups are just incredible growth opportunities for us. If we look at a snapshot over the past 3 months or so, you can see that 78% of STRC was held by retail and 22% by institutional March 17th. But as of the 1st of July, the institutional holdings had grown from 1.1 billion to 3.1 billion, so tripled, and they're now 29% of STRC outstanding. On the other hand, retail investments had not quite doubled. They were still very strong, but now they're 71%. So we think that the trend toward more institutional adoption is great for the stability of STRC. You can see on the right side of the slide that the average retail account grew from $44,000 to $48,000 over that period, and the average institutional holding went from 1.7 million to 3.5 million over that period. These are very, very bullish metrics, and they speak to the seasoning and the maturation of the asset. When we came public with STRC, it took us about 70 trading days to reach par. And some people forget this, but when we did the IPO, we IPO'd at 90. It took us 70 days to get to par. And if we trace the period since STRC fell below our trading range of 99 to 100, and where we are today, it's been 40 trading days. So if we were to trace forward 70 trading days from when STRC fell out of our trading range, that would put us around September 8th. So we're keeping track of that date, and we're keeping track of our progress. We will focus upon returning STRC to health. And we think that if we did it in 70 days after the IPO, then it's reasonable to target 70 days after it fell off our trading range from May 28th. We have the means to return STRC to par. Right now, you can see the market cap is 9.2 billion, and the notional is 10.5. So there's about a $1.2 billion dislocation. We have allocated $1 billion to buy back STRC, about 2% of our BTC reserve. We still have $975 million of that program available to us. And so the first place we look is to use that buyback program to cure the dislocation. But I would remind everybody that the company has total reserves of 58.5 billion. I've shown the bar on the right, and what you can see is that if the $975 million doesn't cure the problem, we have ample additional capital in order to cure the dislocation. We're currently in a discovery process to figure out how much capital it will be required on our part in order to return STRC to par. We're certain that we will return STRC to par. That is the goal, right? So there's no question about whether or not success is returning it to par. It is returning it to par. The big question mark is how extensive will the buyback be and how rapid will the buyback take place? And then what will be the exact open market execution strategy of the buyback? We are calibrating day by day and sometimes multiple times a day as we learn from the market. And of course, we have a lot of market signal every minute of the day, every day of the week. We also are getting signal back each week as we put out a new announcement about our status. We think this is one of those things where we want to do it not too slow, but not too fast. And we want to allow other investors, our credit investors, our equity investors, and the Bitcoin community to participate with us. But especially we want our other credit investors to join us on this journey. We can go to the next slide. We updated our credit tab on our website, and I would encourage anyone to go check out that tab. One thing you'll see is the BTC ratings of all our credit instruments, and you can see that the senior bond has got 122x over collateralization. You can see that STRF is now 12.9 BTC rated. So the BTC ratings of the instruments are improving as we build a US dollar reserve. We think this is obviously good for credit investors. You can calculate the BTC fair credit spread based upon your assumptions about forward volatility and forward Bitcoin ARR. We've added a new metric, the BTC floor rate. And the floor rate is the rate the Bitcoin would have to fall on an annualized basis in order for these credit instruments to be collateralized 1-for-1 at the end of their duration. And so how do you get to a BTC rating of 1 for STRF? Bitcoin would have to fall 21% a year, more than 21.6% a year forever, in order for STRF to be under collateralized at the end of its duration. So this gives you a sense of how fragile or robust any given credit instrument is. And you can see, for example, with the senior bonds, Bitcoin has to almost, go to zero in a hurry in order for those bonds to be under collateralized. But you can see even with STRD, the floor rate is 10.8%. And the floor rate across all of these things, all of our credit instruments is 11.8%, and we're starting to publish that on our website. We think that that's pretty useful for our credit investor. We can go to the next. I've got our credit model here, and it's a little bit more detailed, and I guess I'll just make a few points. If you're a skeptic, and if you think that Bitcoin's going up 0% a year forever, it's basically not going to perform, then the BTC credit spread that the model would spit out is for STRF is 86 basis points. So STRF would still be investment grade, even if your view of Bitcoin was it's not going to perform forever. The other instruments, STRC, E, and K, they start to look somewhere in the intermediate level as high yield, and STRD kind of falls into distressed debt levels. But having said all that, all of those publicly traded credit instruments have a spread premium over over that theoretical BTC credit spread, right? Because the market is pricing them much weaker than that. So even if you're a skeptic, they've all got very, very large 474 basis point to 670 basis point spread premiums. Now, what does it take for all of those credit instruments to be investment grade? Let's go to the next slide. Right, the BTC investment grade rate is a little bit more than 12%. So you can see at 12.5%, all of the credit instruments publicly trading, STR, F, C, E, K, and D, they all have credit spreads, theoretical credit spreads, less than 150 basis points. And so, if you think the Bitcoin is going to perform like the S&P index, gold's been about 12% for the past 6 years. The S&P has been a bit more than that. But if you have an optimistic view toward Bitcoin as it's a legitimate capital asset, you can see that the credit spreads all look investment grade. The spread premiums, are anywhere from 550 basis points to 1,048 basis points. If you're a long duration credit investor and you don't need your money back for 4 years or more, and you just want to make a long duration credit bet and you believe in the company, then you buy STRD and you get paid 1,048 basis points of spread premium and effective yield in the 16% range. The company's not going to suspend its dividends because we're going to protect the digital credit business. If we were to suspend the dividend, then that would destroy the credibility of the company and digital credit. It would be devastating for the asset class. So if you believe the company's business plan and if you believe in digital credit, you can see that STRD is a high effective yield and a massive spread premium. If you semi-trust the company and you just want a lot of investor protections, but you're a long-term credit investor and you don't need your money for 4 years, STRF is showing a BTC rating north of 12 right now. So what you can see is the senior $1 billion in the credit stack out of 15 billion. It's got penalties, dividend penalties. It's got dividend stoppers, right? And on the other hand, you're collecting an effective yield of 10.5%, and you're getting a extraordinary spread premium. And the company doesn't have any discretion to lower that dividend. So if you're a professional credit investor and you don't need your money in 4 years or longer, then if you trust the company, you buy STRD. If you semi-trust the company, you buy STRF. But on the other hand, if you're a short duration credit investor and you're going to want the money back in the next year or 3 months or 6 months, well, then you just don't want the volatility. You don't want to wait. And that's what STRC was built for. It was built for the shorter duration credit investor. I guess we would say at this point, if you think you need the money back, in less than 3 months, you're probably a money market investor. If you need the money back in 90 days, you're probably a money market investor. You're going to put your money in a money market. But if you could wait 4 months to 4 years, anywhere in that duration, then you're a short duration credit investor, like a stretch investor. And if you don't need the money for more than 4 years and you're a credit investor, you might want to look at some of the other preferreds. And of course, if you don't need the money for more than 4 years and you're a capital investor, you should buy Bitcoin. And if you don't need the money in less than 4 years and you're an equity capital markets investor and you want to amplify Bitcoin, you buy MSTR. But I think these models illustrate this pretty effectively. And that takes me to my next point. We think digital credit is the best kind of credit. We think that we're uniquely positioned to create digital credit, and the best form of digital credit, the one that's in the greatest demand, is going to be Stretch, STRC. It's going to have the greatest liquidity. It's going to have the largest AUM. It's the shortest duration. And in all of our discussions with credit investors, plus our view of the market, we've seen that what the market wants is they want the shortest duration, lowest volatility, highest liquidity, most stable, highest AUM, most broadly distributed credit. And STRC is already the most liquid and largest preferred stock in the world. So we expect to keep laser focus on it. We're going to do everything we can to make it the most appealing credit in the entire digital credit space. And we think that if we do that, it'll be incredibly compelling credit for people that might otherwise invest in private credit or junk credit or corporate credit. A few words about our equity. We now publish the hurdle rate, the break-even rate, and the floor rate on our website. The hurdle rate represents our blended current cost of credit. And so if Bitcoin outperforms the hurdle rate, then in our view, our BTC gain, when we sell $10 billion of credit and we book a BTC gain of X billions of dollars, let's say it is 10 billion, then if Bitcoin outperforms the hurdle rate, we're never paying back the credit, which means that the $10 billion is $10 billion of net income. So the company becomes incredibly profitable on a BTC gain basis when Bitcoin is outperforming the hurdle rate. And you could think of this as four simple zones. If you think Bitcoin's going to outperform the hurdle rate and you're an equity investor, then our equity will capture the positive spread over the credit. We're borrowing money at the hurdle rate. We're investing it at something that might be 15 or 20%, some premium to it. And so it's an incredibly good business. We capture the spread, and then we can cover the cost of the credit with the capital appreciation. And so the equity will thrive. But of course, the credit will also thrive because we're making a wise investment. So in that zone, equity and credit both thrive. If you expect Bitcoin to appreciate between the break even and the hurdle rate, the equity might underperform. It may not. We have a lot of tools at our disposal. We may actually benefit from the float and the volatility, and we can do a lot of things that may be good for the equity, but it's a bit harder for us. We have to work at that. So there's uncertainty around the equity. The dividends are still covered because we're substantially north of the break even. As long as Bitcoin's at the break even rate, we can pay the dividends indefinitely, and we can do it without even selling a share of equity or without any other capital or recapitalization. So you're in a pretty safe zone, a very healthy zone for the credit. And for the equity, we're in an operating zone. We have to think hard about how we can still perform, but it's harder than when we're substantially above the hurdle rate. Now, if Bitcoin underperforms the break-even rate, that's challenging for the equity. The equity will probably underperform. And the credit, for the credit, we have to do things over the long term. Like, we've got at 0%, we've got like 33 years. Right? That's the duration of the company. So it's not like we don't have time, but sometime in 33 years, we're going to have to do something if Bitcoin performs 0% a year. So we start thinking about what we might do if Bitcoin falls below the break-even rate. Below the floor rate, that's when we start to think that's a challenge for the equity. The equity is definitely going to underperform, but the credit's going to be impaired. And so that means we have to think about restructuring, the credit. We refinance debt, we roll it forward. We would have to become creative. But you can see here just how bad things have to get before you get in that zone. So the beauty of a Bitcoin treasury company is there's transparency every 15 seconds to this, and you can create all of your own models, statistical models, to figure out what you think's likely. You can plug in your own assumptions, and then you can figure out whether or not you're long equity, short the equity, long the credit, short the credit. If you want to hedge these things, there's so many different ways to be long, short, straddle, or take risk off the table. And we welcome it and we encourage it. That's one of the reasons why our derivatives markets are so healthy, and why the equity has so much liquidity. But what I would say to anybody is check out the website, look at these rates, and come to your own opinion about what you think Bitcoin's going to do. Now, the history is Bitcoin's been appreciating 33% a year for the past 6 years. And if you go to our website, you'll find we've got the 10-year rate as well. So you're not without resources here. Where are we right now? The markets right now are pricing fear. It's a very muted market, very skeptical market. Bitcoin's trading at a very slight premium to its 200-week moving average. As you can see, our credit is paying an 870 basis point premium above the BTC credit spread you would predict. If you plugged in Bitcoin appreciating 12.5% a year and staying as volatile as it is right now, then the credit would be fairly valued at 870 basis points less than it currently pays. And so you can see the credit markets are fairly skeptical. The capital markets are fairly skeptical. They've traded with a premium north of where we are 90% of the history of Bitcoin. And the equity markets are fairly skeptical. MSTR is trading at a 5.5% premium to our net assets. And you can see this illustrated a bit more on the next slide. Right, if the MSTR price implies a near zero value for the digital credit business. In essence, if you look at the market cap of the company compared to our net reserves, if we were to pay off all of our liabilities at face value, we still have $36.3 billion of net reserves. And the market cap is $2 billion in excess of that. So the real issue is, what is the operating business worth? And so our view is, if we can sell $5 billion of digital credit a year, and if Bitcoin outperforms the hurdle rate, then that looks like $5 billion of net income to us, and the business ought to be valued at some multiple of that, depending upon robustness and growth. If we can sell $10 billion of digital credit a year, then you could imagine the business being, at some point, we show the market we can do it, we show the market we can grow from there. You could put a 10 P to E on that. And so what you can see is, our view is the digital credit business is dramatically undervalued. It should be worth something substantially more than $2 billion. The market is pretty much skeptical that there is a operating business there. As the market begins to realize that we have a digital credit franchise, then I think that they'll put a bigger P to E on that. And as we show that we can stabilize STRC and we can grow it in a stable, steady fashion, then I think that we'll see those multiples expand, and the value of the digital credit business will expand as well. And I think that's very bullish for the equity. MSTR is built to outperform Bitcoin over the long term. And one way to see that is looking at these statistics. If you're a short duration investor, if you're just trading on a daily basis or weekly or monthly basis or even quarterly basis, it's pretty much a coin flip whether MSTR will outperform BTC. But as your duration stretches to 1 year, you get a substantial advantage. When you go to 2 years, it's 64% likely. When you get to 3 years, it's 87% likely. And in 495 windows of 4 years or longer, MSTR has outperformed Bitcoin 100% of the time. So if you're a 4-year investor, you've got a long time horizon, you can see that as the time horizon extends, the laws of statistics start to work in our favor, and we begin to outperform. And you can see it reflected here in the last 6 years, from August 10th of 2020 to today. Bitcoin's up 32%, MSTR is up 42%. The Mag 7's up 23, the S&P's up 14, gold's up 12, real estate's up 8, money markets give you 3, and bonds are a -4% loser. So our strategy is fairly straightforward. The stats seem to be telling a very clear story. We believe that we can continue to outperform Bitcoin, and the engine for doing it is the digital credit engine. Why do we believe in the franchise? Well, let's look at these 4 factors, right? We're sitting on an incredible capital stack. We have $55 billion of Bitcoin, 3.75 billion of US dollars, and we're a well-known seasoned issuer. That gives us a big capital advantage. We also have a technology advantage. We've been in the business for a long time, 35 years, but also we invented a lot of these credit instruments. We've been trading them in the markets. We've learned a lot about how they trade. And we think that understanding how digital credit works and how digital equity works is a big tech advantage. A third pillar of our franchise is the brand. We have millions and millions of followers. They know who we are. We're well known everywhere in the world, in every major capital market. And this is a big advantage. And then finally, there's a network effect. Millions and millions of investors, tens of thousands of institutions, deep pools of liquidity. We've got the highest ratio of open interest to market cap in the S&P universe. We've got a very deep, I think one of the most liquid stocks in that S&P 500 universe. So deep equity liquidity, deep derivatives liquidity. We've got the most liquid preferred stock, so deep credit liquidity. Lots of people trading these things. Lots of people making a market in them, all of the hedge funds. And we pride ourselves on creating lots and lots of trading pairs. So there are a lot of ways that people can be long, short, hedged, straddled, in equity or credit or derivatives. And that's a very, very large financial advantage and a large brand advantage for MSTR. And we think that we will be able to grow that. So simply put, what is the goal of the company? What's our ambition? We want to be the world's largest company. That's our ambition. Well, largest in what terms? Not the most employees, not the most products. We want to be the largest in terms of market cap, the most valuable company in the world. And what's our plan to do it? It's very simple. Own the most capital. BTC is capital. We're going to own the most. Our strategy is own the most capital. Who else would say they want to own capital? Berkshire Hathaway in the 20th century. I don't think they're as ambitious right now as they used to be, since most of their capital is sitting in T-bills or, sovereign credit. But in essence, Berkshire Hathaway had a strategy to hold a bunch of capital. We have a strategy to hold a bunch of capital. Most other successful companies don't have that strategy. The second prong, after we own the most capital, we're going to issue the strongest credit. If we have the world's best capital, the best performing capital asset, BTC, we should be able to create the strongest credit, STRC. And we think for every dollar of capital, we can sell 10 to 20 cents of credit per year. And so the more capital, the more credit, the more liquidity, the more stability, the stronger the brand, the lower the volatility, etc. And then by issuing the strongest credit, we think we'll create the best equity, MSTR. And that just becomes a virtuous cycle, acquire capital, issue credit, create equity, rinse and repeat. And, we have done that. We've gone from a $600 million enterprise value 6 years ago to 60 billion. So by a factor of 100. And we think we're just getting started. Now we're getting the engine tuned, and the credit turbine is beginning to spin up again. I will end by thanking everybody for your support, reiterate our principles. They haven't changed. And with that, we'll be happy to answer questions from the panel.
Thank you, Michael. We'll now start the live Q&A session. I'd like to welcome all our Q&A guests and invite them to turn on their video. We look forward to your questions. We'll go one at a time. I'll call out your names and you can direct your questions to the management team. For the first question, we have Mark Palmer. Please go ahead.
Yes, thank you and good evening. Earlier in the call, Peng noted that management has learned a great deal about the investors in Stretch and how they think. And one thing that we've seen is that the size of Strategy's USD reserve is important to retail investors in particular, and more important than the amount of obligations ahead of Stretch in the company's capital structure, such as the convertible bonds. With that said, would you consider borrowing against Strategy's Bitcoin holdings, specifically with a bank with a fortress balance sheet as your counterparty, and use the borrowed funds to increase the USD reserve to a size that would put to rest any concerns about dividend coverage, and presumably drive the price of Stretch back up to par, at which point the company could resume buying Bitcoin?
Peng, do you want to take that question initially?
Yeah,
Or
I
would
can
you like
start.
me to?
I think the feedback is that something between 2 to 3 years from our institutional investors is that level that we need to get the Bitcoin reserve to. We're at 2.1 years. We're continue to grow. We're doing it primarily through issuing equity at a premium to net asset value. We have considered and talked to many counterparties about borrowing against our Bitcoin. And I would say that the market is not as big and not priced as well as you would think it would be at the size we want. So it's not something we've considered doing. The other thing we have to consider is the counterparty risk, the terms, et cetera. So it's not something we've really looked too hard into. I think we have better ways to build up the US dollar reserve.
Yeah, so I think the short of it is it's not on the table right now. The company has the option, right, in the future if we ever needed to use Bitcoin, but we think that right now it would be more complicated than it's worth, and we have more straightforward ways to build the USD reserve up that will create fewer questions or counterparty risks or uncertainties. And so our goal, I think, is we would like to eschew debt. We would like the existing amount of debt to be the maximum we have. We would like it to be progressively whittled down in a responsible way over time. And we would like to avoid any kind of appearance of a margin debt or mark-to-market loan on the balance sheet, just because it tends to be an attack surface and an attack narrative for short sellers. And we don't want to create anything that creates those uncertainties if we don't need to. And I don't think we're going to need to.
Thanks, Mark. Next, I'd like to invite Matt Hogan.
Great. Thanks for having me, Michael, Andrew, Peng. Thanks for a great call and good execution on a difficult quarter. I have a two-part question. So watching the business evolve, you've periodically added new tools to the toolkit, first equity issuance, then convertibles, then preferreds, then perpetual preferreds. The first part is, are we at the end of that series of innovations, or are there more instruments coming down the road? And then the second is a variant of that through the BTC monetization program, you have effectively found a way to sell volatility and sell the volatility of investor sentiment at the securities layer. Wondering if you've considered, or there are reasons why you wouldn't also consider selling volatility at the derivatives layer as another tool in the toolkit to navigate always changing market environments.
I'll start with that, and then you guys can chime in if you like. Right now we have 6 bonds and 5 other credit instruments. So we have 11 credit instruments. We could issue 6 more tomorrow. We could do 1 a week every week, and we could blow out to 18 or 24 or 36 or 48 credit instruments. We could go. But we're actually, it's not hard to issue a credit instrument when you have 55 or 60 billion of unencumbered capital. We're going the opposite direction. We're laser focused on consolidation. So, I rather like the business model of like the Strives. If you look at Strive, they've got 1 equity, ASST, they've got 1 credit instrument, SATA, and that's it. And it's just a question of how big will the market cap of the equity get, and how big will the market AUM or the market cap of the credit get. And, I think you probably should expect that we won't have more, we'll probably have less. So I think our 11 credit instruments will be whittled down. Our explicit plan is to whittle them down over time. I'm certain that we'll keep STRC. STRC is the flagship. All the focus is STRC. We think that the other prefs that publicly traded are option value if they were fairly valued. Right now, they're not fairly valued. They're way undervalued. So, like, my message is, if you get this, you ought to go buy STRF or you ought to buy STRD. They're incredibly compelling institutional opportunities for a long-term credit investor. They're so good that I won't sell it to you, right? Like that's how good they are. The bonds we don't see as strategic. We think that we had to do the 5. If I could do it again, Matt, I would do no bonds. I would just sell STRC. I would go directly to don't stop anywhere else. Just go to the winner if I could do it again. And I tell people generally, like, if you're sitting on $5 billion of capital and you're a Bitcoin Treasury company, don't sell convertible bonds, don't sell long duration credit, don't sell convertible, don't sell a product like Strike or Stride or Strife or Stream. Just create something which is short duration credit like STRC or SATA, because we know there's 50x to 100x the demand. So if there is 100x the demand, we don't really need to create any new credit instrument to grow. And in fact, that, it's like I say, just because you can do a thing, doesn't mean you should do a thing. I actually think this is one of those examples where don't just do something, stand there, right? Like the more you do, the worse it is, because every new credit instrument robs liquidity from the one that really matters. So we're interested in combining liquidity or building liquidity. So it's more likely that we would offer you a swap to swap into STRC and pull liquidity than we would ever bifurcate it. And it is true. I can imagine 100 cool things to do. Like I can imagine digital money in yen or Swiss francs or pounds or euros. I can imagine a 10 vol credit instrument in euros, pounds, or francs. I can imagine a 0 vol money instrument in those things. We're just not going to do it. That's what I would say for everybody else, every one of our partners. They're great ideas. You should do it. But for us, they would be a distraction and they would dilute our focus and they would dilute liquidity. It's like, rather than even if I could issue, for example, stretch in euros, I would rather issue stretch in dollars and have someone else create stretch in euros and buy the currency hedge and get paid 200 basis points and they make a lot of money off that business than for us to do it. So we feel like we've got kerosene. We're not going to design the jet airplanes, the trains, the planes. Everybody else can build every refined version of it that they want. So I don't think it's constructive for us to be over inventing product right now. You know, it's kind of demonstrative when you think at Apple, you know, they're still making all their money off the iPhone. And it's like, I'm not against magical revolutionary product, but let me put it as a hurdle as this. If you came up with an idea where the demand was $100 billion or the market opportunities between $100 billion and $1 trillion, you might get my attention and we would talk about it. But if you gave me a $10 billion idea, I would say that's a distraction. And the only ideas I can think of that are $100 billion ideas are things built on top of STRC by someone else. And I hope someone else does build a $100 billion thing on top of STRC. Good for them. I hope they make billions and billions a year off of it and everybody lives happily ever after. But I'm reasonably sure that we're more likely to commit a foul by creating other things rather than by focusing on the one thing and making the one thing. Because the one thing is short duration, low volatility, high liquidity, stable credit. And that's $1 trillion opportunity for us. And if that's all we do, if that's all I do in the rest of my life, then that will have been greater than I could have ever hoped for. So that's what I think of with regard to that. Now, the second part of your question, selling volatility. You know, we could go and we could sell volatility. We could sell tranched, you know, we could sell out of the money. We could sell out of the money call options on Bitcoin. We could sell volatility against the commodity or the capital asset, BTC. We could also sell volatility against the equity. We could actually sell warrants on MSTR. And it's not lost upon us, right, that we could sell a warrant on an MSTR. By the way, when we sell convertible bonds, we were selling a bond with a warrant. So I could go and sell a $200 strike on MSTR, or I could tie it into a convertible bond. But as you know, we don't want to sell bonds because bonds are senior to stretch. So that's a non-starter. Now, if I were to sell the warrant, I'm selling volatility, but I'm stripping volatility. I'm clipping it off of the common stock. And so the point really is we are selling volatility right now, Matt. And the way we're selling volatility right now is we're selling MSTR. And so when we sell MSTR has a 90 vol or 80 vol. And the reason people want to buy it from us is because it's got vol. So if I turned around and I sold $1 billion of volatility on top of MSTR, I changed the convexity of the instrument and I strip the volatility from the equity and I transfer it to the other security. So this is kind of like I can sell 5 credit instruments senior to STRC, but they undermine my best idea, STRC. And I could sell 5 warrants. I could sell a warrant at 150, 200, 250, 300, 350, 400. But I'm stripping the vol and the value off of the underlying security. And what I'm doing is fragmenting all the liquidity and I'm creating complexity. And this is something that, you know, a professional options trader at Susquehanna or Millennium or Citadel or Soros, they could do all day long. And my view is they're better than us. And so there's two thoughts. One is, I don't want to steal an opportunity from a credit investor or an equity investor or a derivative investor. I don't want to steal it from them. I want to leave it for them. I want them to say, oh, these goofball guys, they could sell the volatility, but they don't, so I can. It's like you can. That's why people that we never met, that I've never had a meeting with the derivatives traders that create the options market and our stock, and yet they just spend this stuff up for us, right? That's the reason they do it, because that's what they do. So I don't want to steal their opportunity, and I don't want to make their job harder. I want them to have complete transparency and line of sight for 5 years, right? For as long as possible, so they can create all these things. But the second thing is, there's a general principle that we're a publicly traded company. We should do things that we are uniquely able to do that they can't do. So a guy with $100 million in a Bloomberg cannot create STRC, and they can't they can't do what we're doing. They can't issue it, right? And they can't improve it. And they also can't create MSTR. So we're creating securities. We can create publicly traded liquid securities globally, and they can't do that. But what they can do is they can enter on all those trades. So all of those other trades, whether it's like strip the vol, convert the currency, change the duration, butterfly between 1 year and 3 year, amplify it up, damp it down, structure it. They can do it. They should do it. I welcome them to come do it. And our representation to them, our promises, we won't compete with you, and we won't change the convexity. Like how would you feel if I put out a press release saying I just sold BTC call options at $75,000 a coin against $50 billion of Bitcoin? How do you think about the equity then? You're like, well, he just stole the upside on the equity, you see? And so the equity investor, and then how do you feel about the derivative, the call option guy? It's like, wait a minute, I just created that market and they just distorted the market in derivatives, and they're mucking with it. And now you've got all this issue of derivatives guidance. And so we're not trying to make the company more complicated. We're trying to make the company simpler. And it's such a good idea. My view is, yeah, it is a good idea. So I leave it for someone else to do. And it's not that we're not selling the vol. We're selling the vol, right? We sold billions and billions of dollars of equity. And it's like, to a certain extent, the people that bought it from us were buying it for the volatility and for the upside. And when we start selling the vol, we're stripping their upside away from them. And ultimately there'll be a price to pay. So I think it's one of those things where it's easy to do. I could raise $1 billion in 2 days by selling the warrant. I could raise $1 billion in 2 days by selling the convertible bond. I could raise $1 billion in 2 days selling a junk bond. And it's easy come, but there would be a bad hangover, and the hangover would be it would change the characteristics of the other securities, and it would fragment liquidity, and also it would undermine trust, right? And the trust is like, I'm not going to do that, and so you can take advantage of that knowledge to put in whatever trade, trade against me or trade with me, and it's more important for us that we make the biggest possible market in the equity MSTR and in the credit STRC, right? Than that we pursue every cool idea. One more point I'll make. We could generate billions and billions of dollars of revenue by selling volatility against BTC right now. We would also generate a multi-billion-dollar tax liability. And then the equity investors absorb the tax hit, and then we pass it through to the credit investors. So MSTR equity investors currently have a business model where they've got a deferred tax on capital gains, and the credit investors have a deferred tax on the credit dividend. And so we have a very tax efficient business model. And if we start to get cute by doing all this, we create lots of complications. You're like, well, maybe they don't care about deferring tax on the credit. Well, actually, it's not just that. It also eliminates the withholding tax for foreign investors. So you might get a 30% withholding tax. So this has so many complications to the tax efficiency of the credit or to the tax efficiency of the company, and introduces counterparty risk. And all of those are micro reason to do it. But to tell you the truth, the real reason that we don't do it is because I want some dude with a Bloomberg to get up in the morning and lay a $500 million bet, taking advantage of what he knows about volatility, or she knows. And I want them to know that they can put that trade in, and we're not going to rug pull them, and by counter trading or trading against them. Because the most important thing, the thing that's made us successful, is a very good partnership with the Citadels and the Millenniums and the Susquehannas, right? And the Soroses of the world, and the capital investors of the world, and capital groups, and then all those credit investors, and all of them, they've got their own models. And the last thing in the world they need is to have to guess how we will decide to trade in the next 12 weeks. It just breaks their models. And what'll happen is they'll take their money and they'll go home, or they'll cut their allocation of capital. And so instead of investing with us, they're like, well, I can't, the company's too opaque. It's a black box. It's like, that's just not the right way to build a network. And we could do it. I could generate $1 billion like this, but we're not playing for $1 billion, Matt. We're playing for $1 trillion. We want to create $1 trillion company and $1 trillion asset class. And that requires that we think very long-term strategically, and we can't do it alone. We need people with more money than us to trust us.
Yeah, super clarifying. Thanks, Michael.
Thank you, Matt. Next, we have Ramsey El-Assal from Cantor. Ramsey, go ahead, please.
Thanks for taking my question this evening. I think it was Andrew that mentioned in the prepared remarks plans to either equitize, repay, or refinance the existing convertible debt. Can you all collectively help us think through the scenarios where you would opt to or be compelled to deploy these different approaches, and also comment on the general timing of your actions when it comes to addressing the upcoming convertible debt maturities? Thank you.
I can start. I would say, Ramsey, the simple answer is that we have all of those options available to us, right? And so in terms of monitoring the market, being able to understand what the right action is at the right time, I think all of the options are open. In terms of timing, I don't think there's any prescribed rush right now. I think we're continuing to be very disciplined in how we think about it. I think the activity in Q2 showed that we're able to go out and repurchase the debt, and there is an active convert market that's very active right now. But really, it's just about waiting and seeing when the right time is. Right now, our priority is to get Stretch back to par, as we've said. And so I think the broader message is simply that liability management options remain open. There is no set timeline. We will be disciplined in how we think about it, and we'll move forward in that manner.
I can give you an example, Ramsey. Our next convertible debt put date is September of next year. It's our 2028 converts with a conversion price of $183. My expectation is that in September of next year, we'll be north of that conversion price. We won't get put, and then a year later, we'll equitize it because we'll be north of $183. Let's say a year from now, we're not north of $183, we get put, then our options are either to sell MSTR at a premium to pay it down, our options are to sell Bitcoin to pay it down, or we could just refinance it, right? The terms of convertible notes right now, we get asked every single week by a bank, are we willing to do a 0 up 40, $4 billion 8-year convert? The terms are actually better now than they were when we entered into most of these converts in the last 5 years. So there's a lot of options, and that's the next one that comes up, and that's how we would think about it.
Thanks.
Thank you, Ramsey. Next, we have Samson Mo.
Okay. Hi, thanks guys for having me on. It's great to be here with this lovely big Bitcoin group of heavyweight intellectuals. So I have a compound question. I hope you don't mind. It's a bit of a follow-on to Matt's question. So I understand you want to keep things simple. You don't want to be trading against the guy with the Bloomberg terminal and 500 million. But do you think there is any benefit in this sort of new shift to an active capital management strategy to do things like sell covered calls? Because there is now a price point at which, Fong, you said, is advantageous to sell Bitcoin. So you could deploy some capital in those markets just to optimize your acquisition, or possibly create like a side pocket for selling cash secured puts to buy Bitcoin cheaper at times too. Do you view that as conflicting with the current strategy of keeping it simple, or is there room for optimization in there for the Bitcoin accumulation? Because it's a hard market, especially when Bitcoin is roaring.
I'll give you a quick answer on that, Samson, which is just right now, that's not part of the plan. We just think it would generate counterparty risk, complications, change the convexity of the equity, change the tax characteristics of the company, change the tax characteristics, or it might create a tax complication for the credit. And our view is the single most lucrative thing we can do with a stack of Bitcoin is sell credit against it, not sell volatility against it. So anybody with $1 billion of Bitcoin can sell $100 million or $500 million of coverage of covered calls and the like. Anybody can do that. A private citizen could do it. There's only 2 companies in the world right now that have shown that they can actually sell digital credit against Bitcoin, us and Strive. And there's only 1 company in the world that can sell credit at our scale, and that's us. And I don't know why we couldn't sell. We were selling $2 billion a month of it. We could sell $1 billion a month of it. So our focus is get the digital credit reactor up and running, and don't do anything to confuse the matter, and don't do anything to create opacity. And again, they're all options. Like in the future, if I had to do it, right? If I had to do it for some reason, I would do it. But right now, we think the best business in the world is selling STRC, and the most useful thing we can do, that the path to become $1 trillion company, that the path to become the world's most valuable company is not selling call options on Bitcoin. The path to becoming the world's most valuable company is creating the credit money on top of Bitcoin. And everything we do that is complication to the credit that makes it confusing, it's like, that undermines the credit worthiness of STRC, and it distracts the management team. So it's not on the table right now, and we're just going to focus on returning Stretch to health. Did you have a second part to your question?
Yeah, sort of related to Stretch. So just a disclaimer, I'm a big believer. I think Stretch is a brilliant product. We try to do the same structuring instruments for nation states like Stretch. But there is marketing around Stretch saying, we make Bitcoin money. And in the Bitcoin space, there are people that are kind of wondering, what is your view? Is Bitcoin an asset? Is it digital property? Is it digital Manhattan, or is it money? And do you feel these instruments like the preferred squeeze out people from discovering real bearer Bitcoin? And I think it'd be cathartic for people to hear what your view is on that.
Yeah, it's a good point. I think the thing to keep in mind is our marketing is to the 99% of the people that don't own Bitcoin, that don't want to buy it. Right. So when when we say when we talk about Bitcoin and what we're going to do with it, we're selling products, credit products, to people that would never ever in a million years buy the Bitcoin. They just won't buy it. Either they won't buy it because it's illegal for them to buy it. They don't buy it because it's against their mandate to buy it. They don't buy it because they don't want to hold it. They don't buy it because they literally can't, that they don't have the ability to punch the button and buy it. So it's either technically impossible, or it's just, impossible. So we're creating a product for them, and when we create a product for them, we need to market it in a package that they can buy. I think that the issue with money is the Austrian perspective on money and the JP Morgan perspective on money is a non-sovereign store of value bearer instrument is money. So gold is money, everything else is credit. A famous JP Morgan quote from more than 100 years ago in a congressional hearing. And I've said Bitcoin is money, everything else is credit. If you're an Austrian economist and if you're a Bitcoiner, then you would understand that that resonates with you, and you would be 1% of the money in the world, or 1% of the opinion. The rest of the world doesn't agree with us, right? The 99% of the world, they think that money is a zero vol pegged to a fiat currency. It's a money market, or it's actually a stack of dollars. They think of money as the most saleable good, as a medium exchange unit account, store of value, but in the fiat frame of reference. And it's not hard to point toward that. There's $30 trillion in money markets, and it's literally a regulated term. Like, for example, it's illegal to market your thing as a money market, right? Because it's a regulated banking term. And so the rest of the world has defined money as an asset pegged to a fiat currency in yen, euros, dollars, francs, pounds. That's how the rest of the world is. Okay, so when you're creating marketing, there's no point in marketing to people that are 100% invested in Bitcoin that they should buy Bitcoin, because they don't have any additional money to buy Bitcoin with, number one. And number two, they don't need to hear that, right? Like, no one that's 100% invested in Bitcoin needs to hear from me that they should buy Bitcoin. They would say, I already did that. So when we're marketing to the people that wanted to buy equity, or wanted to buy credit, or wanted to be invested in something different. So to the conventional institutional investor, we would position Bitcoin as digital capital, because it's a capital asset and it competes with real estate and equity portfolios and credit portfolios, other liquid instruments like that. So they think of it as a capital asset, and then they would recognize STRC as a credit instrument. And there'll be a little bit of, some people think, well, it's preferred, that's not credit. Well, the truth is it is credit. It's just not a bond. And so they would view a preferred equity as a credit instrument, and we would deliver that. Now, in the fiat frame of reference, gold is capital. A gold-backed bond would be credit. And a instrument that was pegged to the US dollar, right, a note, would be currency, or would be money in a fiat frame of reference. And that's the world for the last 100 years, and that's just the way it operates. So when we think about how you grow the business, if you're going to grow Bitcoin from $1 trillion to $100 trillion, you can't just convince all the people that have invested everything in Bitcoin that they should keep investing in Bitcoin, because you're going to get a trickle of cash flows. You're going to have to go find $99 trillion of other money or monetary value. And sort of by definition, it's somewhere else. It's invested in real estate, it's invested in bonds, it's invested in the equity capital markets. And that's like a $1,000 trillion stack of capital, and we're 1 trillion. That makes us 10 basis points, like we're 0.1%. So when you go get that money, you're either going to create a Bitcoin-backed credit instrument like STRC, or you're going to create a Bitcoin-backed equity instrument like MSTR, or you're going to create a wrapped Bitcoin-backed fund like IBIT. And all of those are channeling capital into the Bitcoin ecosystem that could not They could not contractually, maybe they could not legally, they could not technically, they could not ethically, they would not economically buy the underlying crypto asset. They just wouldn't. And you can, the irony is always seeing people that are Bitcoin maximalists that get angry that we're actually, that BlackRock is selling wrapped Bitcoin to sovereign wealth funds, or that we're selling amplified Bitcoin to an equity investor, or we're selling digital credit, credit instruments backed by Bitcoin to a credit investor. But I guarantee you there's no one that buys those instruments that sold Bitcoin to buy the instruments because they didn't want to. It's like all the demand is coming from people that they say, I have a pool of money and I can't put it in the 40 vol crypto asset. And so their choice is put it in a money market or put it in a diversified credit fund. So we see the expansion as digital credit will allow us to tap into the multi-$100 trillion credit market. And then if you can take that credit and create an instrument pegged to a fiat currency, if you can peg it to the yen or the Swiss franc or the euro or the pound or the dollar, and you can offer a spread higher than the risk-free rate, the conventional rate, then you will start to divert capital from the money market instruments. And we talk about digital money. What is digital money? Digital money is a Swiss franc that pays you 4% in a world where the fiat money is a Swiss franc that pays you 0 or negative. Right? And we can debate semantics in the crypto community, but it's kind of irrelevant because all the money is not in the crypto community. The money is in the fiat community. So if there's $1 trillion invested in Swiss francs that yield 0, and you want $100 billion of it, you have to offer them a Swiss franc that yields 4%, backed by a digital credit instrument backed by Bitcoin. So, when we use the phrase digital money, we're creating a product to sell to the people that have the hundreds of trillions of dollars of fiat-backed securities or money instruments or credit instruments, because that's what they understand. And we use the word digital credit. We're creating a product to sell to people that have credit that is fiat-based, that they understand. And what is Bitcoin? Well, yeah, it is money. It's digital gold. As much as gold was metallic money, Bitcoin is crypto money or digital money. But it's also digital property. It's also digital capital. It's also digital energy. It's also, trust, digital trust. If you want to establish or authenticate digitally, how do you prove your identity without a trusted third party? It's one thing to transfer money without a trusted third party. It's another thing to prove that you're Satoshi without a trusted third party. The answer with both of those is using a public-private key combination. I mean, that's Nostr approach this, and I think public-private key cryptography is a critical thing, but even with public-private key cryptography, the ability to anchor it into the most energetic, most secure global blockchain is important. So I think that Bitcoin is important to understand as a trust network, a monetary network, a capital network, an information network, right? And what is the highest best use? I think the market is clearly spoken that the highest best use is as for store of value or as a capital network. We have proven without a shadow of doubt that Bitcoin functions if you want to store your monetary energy for 4 years or longer. And the way we've shown it is we're moving $50 million a day. You're selling $1 billion a week of something. Right. So clearly that's a killer app, but there are other applications, right? Medium exchange applications and authentication applications and the like. They're not nearly as valuable right now. And it'll be whatever it'll be. But our view is we'd like Bitcoin to become 100 times bigger than it is. And that means we need 100 times more money. And it's other people that have the money. And right now they're invested in fiat denominated credit, equity, and monetary instruments. And we need to create products that appeal to them, and we need to market them with words that they understand. And the most important thing is get the money.
Awesome. I think people will be happy hearing us talking about Bitcoin as money for 10 minutes. Thanks.
Thank you, Samson. Next, we have Nick Cremo from Barclays.
Thanks, CJ, and hi, team. Thanks for having me on this call and taking my questions. The first, I just wanted to ask on STRC. It's good to see the dividend coverage is over 2 years now, well ahead of the 12-month minimum and the USD reserve from your digital credit capital framework. Just wanted to ask if you would consider raising the minimum number of months of coverage to say maybe 18 or 24 months, just as a mechanism to get STRC closer to par if later this year it's kind of still trading in this high 80s range.
I think we'd consider it, Nick. I think the best thing to get it to trade to par is our commitment to a US dollar reserve and increasing the actual number, not necessarily increasing the minimum. I think the other thing we can do to get traded back to par is a steady repurchase program, which you've seen. And another thing is just Bitcoin price going up. I think those are some of the levers. Would we increase the minimum US dollar reserve? Maybe at some point, but I think a year is a good spot. Really, how much we have in the US dollar reserve, I think, matters even more, and our commitment only to use it for dividends and interest.
Thank you, Nick.
Got it.
Thanks, Nick. Next, we have Lynn Alden.
Thank you for having me. My question is, do you have current guidance on kind of a target level of overall amplification or leverage for the company as part of the capital structure? And kind of a related question is the counter-cyclicality or pro-cyclicality of capital issuance? And so, for example, when STRC has a lot of demand, which tend to happen along with the other instruments during bull markets, there's a choice when it starts to go above par, either to issue more STRC or to potentially ratchet down the dividend. So far, the choice has been made to issue more, accumulate more Bitcoin, historically at these kind of pro-cyclical prices when they happen, as most Treasury companies do. Going forward, do you have kind of just overall guidance of what you think that kind of the ideal amplification structure is or level is? And then do you plan on trying to find ways to, now that you have a kind of a multiple different levers to pull, to be somewhat more counter-cyclical in your approach, or take a view on whether Bitcoin is maybe oversold or overbought and therefore leaning in or leaning out of? Or is that not really how you view what you're offering to investors? Thank you.
I guess I can start, and then Fong, you probably have some comments. You notice on our website we added those Bitcoin metrics, and one of the metrics we added is the 200-week moving average, and then we added the premium to the 200-week moving average, and we started tracking it, and we started tracking the percentage of the time Bitcoin is above that number. And so I think traditionally we've always wanted to be long Bitcoin, but I think we underestimated the value of US dollars. And now I think we've developed an appreciation for actively managing the mixture between USD and BTC. And obviously we have more US dollars today than we've ever had in the history of the company. And, we saw that when we went, 98% or 99% BTC, 1% USD, the Bitcoin investors didn't like it, the equity investors didn't like it, the credit investors didn't like it. So it actually was counterproductive to be too BTC focused. So I think you could expect that, we're going to be staring at metrics like the premium to the 200-week moving average. And I think that although in the past we've had 100% allocation to BTC, I don't think it'll be 100% in the future. I think it'll be a mix. And to your point, if you're sitting at 100% premium to the 200-week moving average, then the likelihood that Bitcoin's going to trade the opposite way goes up, right? And so I think that when we're sitting at premiums, we probably will, be counter-cyclical and err more toward dollars. And we're sitting at discounts, or we're sitting, at very small premiums, we would be more bullish on BTC. And the reason that we publish that on our website is we wanted people to see the metric that we're staring at. So yeah, so that's a long-winded answer to your question, which is sort of, yeah, we are going to actively manage it. And one aspect is, what is the credit coverage? And the other aspect is, what is the mix between USD and BTC? Do we have 10% of our reserves in USD, irregardless of credit obligation? And do we have 36 months or 24 months of dividends, right? So they're both interesting factors to be managed. I'm of the opinion with the credit, if you want strong credit, like creating chromium steel or stainless steel, you want 20% to 30% chromium and iron and just a smudge of carbon. But is it 20% or is it 30%? That's the question of, do you have 24 months or 36 months of dividends? So we want to actively manage to create the strongest possible credit, and we're trying to figure out exactly what that alloy is. But the other piece is, irregardless, is the company better if we're sitting on 55 billion of Bitcoin and 5 billion in cash? And if we had 100 billion of Bitcoin, do we want to be sitting on $10 billion of cash, even without thinking about the credit? I think the answer to the question of how much cash is probably going to be driven by market sentiment and the market premium. And I don't want to simplify it down to it's as simple as just looking at the premium to the 200-week moving average, because a lot of people will come up with a few other metrics. You may have a number of your own metrics, right? And there's debate in the community about what's the best way to calculate whether Bitcoin is at the top of a cycle or at the bottom of a cycle. But I think we're going to start to look at those signals, and that will drive the allocation of cash flow. If we sell $1 billion of credit, I don't think you'll see 100% BTC, 0 USD as the norm. I think it'll be a ratio, and what the ratio is, well, it'll be a function of the equity capital markets, the Bitcoin markets, the credit markets, and what are people telling us? If the credit investors, still want more cash, then we'll probably lean toward dollars, because the credit markets want it, regardless of where BTC is. But if the credit is strong and there's no issue there and it's stable, then it will be a function of, where is Bitcoin in the cycle, and what are the forward yield curves, or the forward vol curves look like, and that will vary. Fong, do you have anything to add on the subject, or any thoughts?
Yeah, I think we're at the 1-year birthday of Stretch, which is a brand new asset class, digital credit. At about 9 months, we learned the hard way that we shouldn't let our left-brained Bitcoin bulls say that everything we can issue, we just pour into Bitcoin. And I think we've learned that holding US dollars makes a lot more sense. We also have learned a lot more about our investor base, the retail versus institutional base, the leverage they take on, what is important to them. And so we've talked to a lot of them to figure this out. I think reducing the rate when we see, a strong Bitcoin price, a strong, premium to the 200-week moving average makes sense, right? So I think that's something we consider doing too. So yes, I think we agree with all your points, Lynn, that we need to look at the cyclicality, we need to look at the demand, we need to look at the price, the interest rate, how much US dollars we hold. We'll be a lot more thoughtful and methodical this time around about growing the digital credit base. I'm excited to see Stretch get back to par so we can exercise all that we have learned.
Great. I appreciate the guidance.
It's worth noting, that with credit, we've noted that the market would probably rather pay us a lower dividend rate with more currency backing it than a higher dividend rate with more Bitcoin backing it. And so there's this circularity there, which is you don't want to carry dollars because they underperform BTC, but you do want to carry dollars because otherwise you have to overpay to issue the credit. And so to find the sweet spot of, how do you create strong credit that has a dividend that's somewhat better than junk bonds, that's compelling enough to have a high demand, but is lower? Like we could see people don't want the thing paying 14% if they don't feel secure, right? But on the other hand, a lot of our credit investors told us, I'd be happy to be paying you 9% if I just didn't have any anxiety. So, finding our way to the right balance is all about, all consistent with a dynamic equilibrium because if you find the right credit point, then that lowers the cost of capital, that lowers the hurdle rate, which is better for the equity. So the equity benefits if we issue the most efficient credit, and the credit benefits, and we know for sure that it's this balance of dollars and BTC, and we know that we have been underweighted dollars before. Now we're in this discovery, and we're talking to our investors every week, right? Like every day we're talking to them, but every week there's a new announcement. And so every single time we make an adjustment in the capital structure, we watch to see how the credit settles. Then we go and we talk to our investors to see how they feel about it. And of course, we have other moving parts, like the Bitcoin price is a massive moving part of it. If it falls $20,000 or rises 30%, but also SOFR and, the federal, the monetary policy of the Fed is a second moving part, and then the private credit markets and the equity capital markets. So I think it's a moving target, but what we've learned over the past 12 weeks is we need to actively manage those ratios, and we need to be humble, and this is a hard thing for a lot of people to understand, maybe the best way to buy the most Bitcoin is not to buy the most Bitcoin. like if it was an 80-20 split or a 90-10 split, we'll actually get more Bitcoin over the long term because it's all about sustainable growth. And of course, it's very difficult to explain this on X because people want they don't like nuance of I'm going to sell 1 and buy 10. They want to hear that you're going to sell none and buy 11 and do it with money you conjured from a genie, under the desk. And we don't quite have that.
Thank you, Lynn. Next, we have Lance Vitanza from TD Cowen.
Thanks. That's a great segue to my question. Over the years, investors have come to associate strategy with a number of principles that at one point seemed absolute, but later proved more flexible in practice. Bitcoin monetization, obviously one example. Today, management has been clear that it does not intend to issue Stretch below par. My question is, under what circumstances would you reconsider that position? More broadly, how should investors distinguish between principles that are foundational to the model and those that are contingent on market conditions?
I think we learned that the market they don't want volatility in their credit. They want lots of liquidity, low volatility, short duration, stability. They want to buy it around par. They want to sell it around par. They want to collect the dividend. That's what they want. And that's what they expect us to give them. And If we do that, then they make a decision in 10 seconds. I'm just going to buy $1 million or I'm going to sell $1 million. If we allow it to flex plus or minus $1, that order becomes a 3-day process. Like I placed a limit order. We've allowed it to flex 40 cents in the past. People put in limit orders and they wait they put in the order on Wednesday and they're waiting on Friday and the order isn't filled. And what would have been a 5-second decision became a 3-day decision. But if you let it flex plus or minus $5, we have an example like STRF. STRF is objectively a better credit instrument. Like it's 12x over collateralized. It's got super dividend stoppers and it's got non-payment penalties. And if you're a credit investor, in theory, it's 10x better. And yet it trades with 1/20th or 1/30th the liquidity. And I scratch my head. I'm like, why isn't nobody wants this thing? And so whenever people say, why don't you just let STRC float up $2 or float down $2? I think, well, because I've already got that. It's called STRF or STRD, and it's got 1/30th or 1/50th of liquidity. And so the answer to the question is, we're never gonna, if it trades, if you offered me $10 billion to sell you the instrument at $99.99 and take 1 penny off, I wouldn't give you the penny, Lance. I would not knock off a penny if you put $10 billion in front of my face, because it's a matter of principle and credibility. If we can't create it such that it trades at par and we can't sell it at par, we're not going to sell it at all. Our backup is we just do nothing. The Hippocratic Oath, do no harm, right? And if we can't, like, we're not going to sell Stride, we're not selling Strike, we're not selling Strife, we're not selling Stream, and we're not selling Stretch right now, and that's okay. At some point, Stretch will return to par. And the only question is, how much money or time will we have to exert to get it to par? But I guess I would say it's not worth doing if we can't do it right. It's like come back to kerosene. It's like the reason Standard Oil was successful was because it was standard and it didn't blow up in the engine and it didn't burn you to death. It didn't start a fire. It used to be that people created oils and they were impure. Like if you ever put bad diesel or bad oil in your fuel tank of a boat or a plane, it destroys the engine. So the impurities render the product useless. So here's my analogy to you, which is, if it's a little bit bad, I can either say, okay, well, here's some kerosene. You should test it in your own factory or in your own chem lab before you put it in the engine because it might blow up. And I put the disclaimer on it. Or I could just not sell it to you. And my point really is, if you can't create this stuff so it's pure, like it's got to be pure and it's got to be what the market wants, or just sell nothing at all. And if we can't create pure short duration credit at par, we'd rather just sell nothing at all until we get it right. Because the demand is, in my opinion, it's 100x more for short duration credit, 100x more, and maybe the ultimate market is 100x bigger. And so it's like we're just playing to win here. And it would be very easy it's like, I could let it float I could sell it at 98 or 97 some days or 99. What would happen would be the market would shrink by a factor of 100. And you would basically turn people it's like, what if your bank took a 1% commission every time you deposited money? Or they didn't, and it was random and it came and it went and you weren't quite sure. Or what if the trading fee, it changed from 5 basis points to 5% randomly from week to week? It's like I put my hand on the light switch and sometimes I get a shock and sometimes I don't get a shock. And it's like, you don't want to touch the switch. And so that's how we feel about this thing. It's like you would be so angry at me, if it's like you bought it at 100, you sold it at 100, but you could have sold it at 105, or you bought it at 100, but then you could have bought it at 98. It's like that kind of thing. It just destroys the product. And we've inadvertently tripped over what we think is the magic product, the greatest product in the world. The marketplace wants us to strip the volatility off it. They want it to trade at par. They want it to be liquid. That's our job. If we punt, if we abrogate on our responsibility, it's just like someone shipping you beer and saying, well, here's a 6-pack. One of them is spoiled, but the other 5 are good. Just check before you drink. It's not acceptable, right? It's a failure, right? To create it. We're creating a failed, flawed product, and we're lowering our standards and telling ourselves it's okay. It's not okay. It needs to trade at par. We won't sell it below par. Right? If we have to spend an extra $1 billion to get it to par, it's an extra $1 billion. If it took an extra $2 billion, an extra $2 billion. If it took an extra $4 billion, spend $4 billion. It's like, how much is it worth spending to make the airplane that flies across the Atlantic without crashing on the way? It's like, just make the thing work, right? And that's what we've discovered. We've got a thing, everybody wants it, we need to make it work. I can't guarantee you exactly how many dollars it takes for me to get it to work, or how many days it takes me to get it to work. But what I can say is that it is so clear in our mind that this is what the market wants, and this is what we can create, and this is the thing that will make the company worth hundreds of billions and then trillions of dollars, that there's nothing else worth considering. Everything else is a distraction, a waste of time. We just need this thing to work as designed.
Thank you, Lance. Last but not the least, James Van Straten. Please go ahead.
Thank you for having me on, guys. I love seeing the 200-week moving average on the dashboard, and it'd be great to see also like on-chain metrics that are complementary, like the realized price and true market mean. I think it gives a much greater indicator of support levels. But I've got kind of a two-pronged question. So, like, looking back over the cycle, this is your guys' second cycle. What assumption about the capital markets proved you guys wrong, or least certain that you expected? And then, as capital markets start to move on chain, do you think this can create new opportunities for strategy, whether through tokenized securities, which would obviously reach a broader global investor base? Or even issue a strategy stablecoin in the future? Is this something that you guys think about?
Hey, Fong, do you want to start?
Yeah, I can cover the first one. Maybe Mike, you'll cover the second one. In our first bear cycle in 2022, some might recall, we had secured debt that had covenants on it that were quite restrictive to the company. And we had a Bitcoin-backed loan that had a margin requirement on it. And our biggest lesson learned from 2022 was don't do either of those. And so here we sit in 2026 and we're fully convertible notes and preferred. And so that was a big lesson from 2022. And I think we upgraded our capital structure as a result. The biggest lesson so far from 2026 is the importance of holding liquid US dollars to fund our dividend and to overfund our dividend, so people have confidence in the preferred dividends. And I think we thought that liquid Bitcoin would be important, but what Mike mentioned earlier is the people who are holding these prefers don't look at Bitcoin the way they look at US dollars. So that was a major lesson learned. And we did a lot of things in May, June that, I think looking back at that, we can execute things better. So we learned a lot. And so the next bear market 4 years from now, wherever it is, we'll learn from that too.
Yeah, and I would add, I think, yeah, in the capital markets, sometimes the equity capital markets correlate with Bitcoin and they trade in lockstep, but sometimes the correlation is broken. with the AI bubble forming, equity capital markets diverged from the digital capital market. And so they will converge and diverge, and generally things that are good for risk assets are good for all of us, but sometimes they'll get a boost from the demand for AI, and then sometimes we'll get a boost as a very pro Bitcoin dynamics evolve. So I think as a company, we've realized that we're straddling the equity markets. When the equity capital markets are rallying, that's generally good for our equity, but it's not necessarily good for our capital asset BTC. And so we're also straddling the credit markets. And sometimes there are things that are credit positive or credit negative, the way the yield curve moves and so forth. And then sentiment in private credit or other sorts of corporate credit, they have their own dynamic. And then there's the digital capital markets, and that's Bitcoin, and it has its own dynamic and drivers. And what we need to do is just be in a position to exploit and arbitrage the various opportunities. And when one market is mispriced, we're buying the cheap one, selling the well valued one, and then occasionally we just have to put the engine in reverse and go the opposite direction. And I think that 2-3 years ago, we had a much simpler business model. And now we realize sometimes you sell credit, sometimes you buy credit, sometimes you sell capital, sometimes you buy capital, sometimes you sell equity, sometimes you buy equity. And the more nimble you are with regard to that, then the more shareholder value you can create. With regard to the issue of tokenization, I think the killer security to tokenize is digital credit. If you look at what's going on right now, people have been tokenizing money market funds, and they're yielding 3.5%. And they put them in a looping protocols, and everybody wants yield, and yield drives the entire DeFi economy. But if you can plug a 10% yielding instrument into a tokenized asset instead of a 3% yielding instrument, there's so much more energy that you can do a lot more with it. So ultimately, I think that the real interesting killer application is going to be looping digital credit, either stepping it up 2x, 3x, 4x, or stepping it down, stripping the vol. And if you tokenize STRC and then you step it down and transform it, there's a market for 4% yielding yen, as a yield coin, or 5% yielding euros, or 4% yielding Swiss franc, or 6% yielding dollars. And the way you're going to get to that is you can't create that with money markets. You can't take a 1% yielding yen money market and step it up to 3% with any kind of economic responsibility or rationale. It's crazy. But you can take a 10% yielding or 12% yielding digital credit instrument, and you can transform it into any currency, stabilize it, step it down, provide liquidity, give it daily liquidity or hourly liquidity, and you can stream a yield and strip the vol off it. So I actually think that the more tokenized securities we see and the more money flows into that, the better that's going to be for digital credit. And I think that, what does the world want? The world wants probably the world wants $1 trillion worth of stable coin that pays 6%. And what the world has right now is $250 billion of stable coin that yields nothing. Right? And then they jump through hoops trying to make the stable coin that yields nothing yield something. But and so how are you going to actually create $1 trillion of stable tokens that yield something that's more than SOFR? You're going to do it with digital credit. So I think that that's really the killer thing. With regard to all the other tokenized securities, the killer idea of tokenization is creating a free market in custody and credit. Like if I have $1 million of Apple stock, can I actually transfer it to a custodian that will pay me 4% yield on it? Because right now I don't get yield on it. And if I have $1 million of Apple stock and my bank will give me a 40% advance ratio and charge me 8%, will someone give me an 80% advance ratio and charge me 4%? So in theory, you could see those markets form. In practice, I don't see them happening in the US right now. And there's still a lot of obscurity. There's a lack of clarity about what kind of tokenized use cases will be allowed for securities. But one thing is clear. Stable coins are going to be crippled in their ability to generate yield. So the path to generating yield and fixed income is going to be through tokenized securities, not through tokenized currency or the like. And I think we're really well positioned for that. And I think ultimately it's the one thing that they're really good at in DeFi is they're really good at looping something 2x, 3x, 4x, or they're good at tranching risk and stripping it down to zero vol. So that's financial engineering tokenized. And the one thing you want to engineer is if I give you a 10 vol, 10% dividend yielding asset in dollars, then in DeFi, in theory, you can create any currency, any monetary instrument pegged to any currency, and you can step it up and step it down with transparency. And so I really see as something like STRC is like the universal fuel source for the digital asset economy. And that's really an opportunity for us should that economy become material. To be clear right now, it's only 1.1% of the money is in DeFi. So 99.9% of the money is TradFi. And so we don't need it. And it won't. And the truth is 100x more money is solving this problem in the credit markets and the equity capital markets. But I do think that DeFi and digital assets and tokenization is interesting because the people involved are more progressive, more innovative. They move much faster. They're much more creative. They'll take risk. They're not so crippled with tradition and custom and incumbency that they fear to do something which is an obvious thing to do. And so all of the really cool, innovative products will probably come out of the digital asset space first. And then it becomes a regulatory struggle and a political struggle to see whether you can get approval to sell a compliant version of that thing in the capital market where you're operating. And you know, we don't have any time to go into that. That's a podcast in and of itself. But that's what I think.
Thank you. And just sorry, I have a quick question as well. On the 26th of June, when Stretch traded down to $70, is there any insight you had on that? Is that forced liquidations from the DeFi, or was it something else?
Tell me, I didn't hear the first part of your question because you cut out on the 26th of June when what?
On
happened?
26th of June, when Stretch traded down to, I think, $70, is there any insight you can give on that day? Was it forced liquidations or, yeah?
You know, what I think happened is that there are a number of broker dealers, unnamed, and we can't even identify them all, that were actually creating credit, 3x or 4x credit against STRC under very favorable terms. So they were giving very high, like a 70% advance ratio or an 80% advance ratio against STRC based upon its previous trading dynamic. And then when it traded down and the vol spiked, I think that those entities they dial back their credit lines from an 80% advance ratio to a 20% advance ratio, or they pull those credit lines and they created, in essence, the equivalent of a margin call or a liquidation event. But see, to call it a margin call would be misleading. It's not like someone got over levered and margin called. It was a second order thing. The credit lines creating the leverage got withdrawn And one of the lessons we learned is it's important for us to offer the instrument in such a stable way so that the second order and third order credit lines backing the investor that took on the trade don't get pulled away from the investor, right? And that was kind of it was an unexpected thing that we learned. So it wasn't DeFi, by the way. The simplistic notion would be, oh yeah, some retail guys over borrowed or some DeFi degenerates like took on too much leverage. That's not what happened. Some TradFi organization said, well, we'll give an 80% advance ratio when it's trading with a vol of less than 10. And then when the vol spiked to 20, they changed the advance ratio and it created this second order and third order rippling effect where you then had someone sell or liquidate, and that created a downdraft in the price, which created another liquidation. And so it was a second order, third order reflexive contraction in credit in this system, we believe, that caused it to trade into the 70s. And that created, when it got into the 70s, that created anxiety for first order investors that then reacted to it. So it's kind of like an amplified reflexivity through a lot of different parts of the market, all working at the same time on a novel asset.
Thank you, James.
Perfect. Thank you.
I'll turn the call over to Feng for any closing remarks. That brings it
Thank
into
you. Thanks to the analyst, both on the Bitcoin side and the banking side, for joining us. Thank you, everyone, for joining us for our earnings call, and looking forward to seeing you all again in 3 months.
Commitments to not sell Bitcoin is actually not valuable, it has negative value. You have this option, now you, by your own actions, decide, okay, I no longer have this option. You're kind of cutting off some of your own moves, cutting off your own resources.
Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard, and today we're joined by Allard Peng, research analyst at Bitcoin for Corporations. Welcome to the show, Allard. Good to have you back on. All right, so you put out a research report recently. We want to get into that and kind of get your observations on what is currently going on in the capital markets and kind of the macro environment in which we find ourselves, and of course, Bitcoin's price action. So yeah, you want to kick it off by kind of diving into the research report you put out and kind of what your motivation was for putting that together and what your findings were.
Yeah, sure. So the report went out like end of June. It's called Quant Framework for Digital Credit Risk. The main thing I was trying to do was kind of educate the space on how to think about digital credit risk from a quantitative perspective. I think there's a lot of frameworks out there for looking at these assets, and they're obviously a very new asset class as well. So just being able to like quantify that risk using objective metrics, I think, is an important contribution to the discourse. So just to kind of get into it, like the main thing I'm starting off from is the concept of BTC rating, right? So this is something that I think has been introduced for should be about a year now, since like Strike came around and Strife, and then Strategy came out with the BTC rating and a bunch of other frameworks, right? They have their credit dashboard that kind of goes from BTC rating into BTC risk and BTC credit. So starting off from that, and I think the unique approach that I'm taking towards this is I'm saying that like the BTC rating could be thought of as a starting point for measuring the Bitcoin risk. And then from there, you can actually use the Bitcoin, or rather specifically for this paper, the Bitcoin ETF option markets to quantify that risk. So this is largely what the paper goes through, the methodology behind doing that, and behind like chopping up the risk premium that these digital credit instruments pay you into the different risks that you're exposed to. So like that would be what you're compensated for, right? Like the type of risk that you're compensated for, and that becomes your return. So that's kind of what the paper does. And yeah, it's just meant for, it could be allocators, it could be investors, it could be just anyone who's interested in digital credit and Bitcoin-backed credit markets, to just give a quantitative framework for looking at it objectively.
Yeah, it's really interesting. We've seen in the discourse a lot of, among the critics of Bitcoin Treasury companies, suggesting that the equity should trade at a discount because of all the risks associated with that equity position in the common stock. Do you agree, kind of on a not on a day-to-day basis, but from a valuation kind of theoretical perspective, should the common stock be trading at a discount or a premium for a company that's amplified Bitcoin?
Yeah, I think in general, like if we were to look at it from just raw valuation, if it got to a discount, I would say like you have a bit of a margin of safety there. And if it got to a premium, then I would say like this is probably, like I think some premium is more likely to be fair value. That being said, like the way I view the common equity of, I'll just call them pure play Bitcoin Treasury companies that like don't really have a meaningful operating business, but they actively engage with the capital markets to grow Bitcoin per share. Let's call that like the core goal. So I think if you were to look at the common equity of this type of enterprise, you should think of the common equity as a call option on the underlying Bitcoin stack, right? And I think so it's kind of like a Bitcoin call option that is perpetual in its duration. And if we were to think a step further about how one would value such a call option, or how one would think through abstractly what the features of this call option is, well, a call gives you convexity, right, towards the upside. And you actually pay a cost. You might have heard of the term like theta, which is the time decay. But in reality, theta is not exactly time decay. It's actually the cost for gaining convex exposure to the underlying asset. So theta is actually the cost of gamma, vana, and volga. So those are three sets of higher order Greeks. So they're like second order derivatives of the first derivatives. And these are all convex exposures to volatility, to price, and to the volatility and price like cross. The cross derivative of those, that would be vana, right? So basically, theta is paid for you to gain exposure to those three higher order Greeks. And in the case of this common equity, your theta is your perpetual preferred stock dividends. That's what's being paid, right? So like the common equity is constantly bleeding in order to pay that theta off to maintain that convex exposure. And so I think that's really the right way to value this. If we were to go from like Graham and Dodd style, like securities analysis, from the core classics of investment valuation, like you could probably use a framework like SEEB, common equity Bitcoin exposure, right? You take the Bitcoin stack, you subtract out the notional value of your prefs and your debt and all of the credit instruments, everything that's not common equity. And then you say, like, oh, wait, this would be the common equities Bitcoin exposure, right? Now, I think that's a fair way to do it. If we were to tie it back to options, that would be kind of like the intrinsic value of that option, right? That would be like if the option was in the money and you're saying like, okay, this is how much is in the money, and everything above it, your quote unquote premium, that would be your extrinsic value of that option. So I think that would be like the framework that I would use. And frankly, for this digital credit report, it kind of lays the foundation for starting to think along those lines. And I will have a part 2 and probably part 3 that kind of elaborates on these like quantitative valuation methods.
So in Bitcoin bull markets, we've seen, for example, Strategy's MNAV expanded, I think, to like 3.5x. So within that framework, is that just reflecting the amount of volatility, the forward expectations on upside convexity, or was that like really a bubble that was overvaluing Strategy?
Yeah, I mean, I think both of those things can certainly be true. The way I think I would interpret it in hindsight is probably it was more bubbly than it was the other things that you mentioned. But, like both of those things can absolutely be true, just because in a bull market and in these events where prices rip into the upside, obviously the price of convexity goes higher, right? And obviously the implied volatility of these of all underlying instruments within this stack, right? If we're claiming that the common equity is a call option on the underlying Bitcoin, then there's necessarily an implied volatility attached to that asset base. And the common equities premium to its net asset value reflects that implied volatility. So like the market has a view on that implied volatility and the convexity that the common equity can give you, and it can place a pretty high bid under that, right? And I think I would say, like, speaking along this line is like, this will not be within my decision making anyway, but like for a treasury company to take advantage of these situations, like when their management team views that the securities that they have are let's say priced above fair value, then they absolutely should issue into the market, and that would be an accretive transaction.
And wouldn't that reflect kind of the supply and demand for amplified returns on Bitcoin, that these vehicles will grow their balance sheets when there's a lot of demand? Do you think that the balance sheets will shrink in bear markets, or is it really just about paying the dividends, as we saw most recently? Strategy sold a fairly small percentage of their stack just to prove out kind of their business model. Is that do you think that's going to continue, or is that kind of a one-off just to prove that they can?
Yeah, I think in the future, like, this is absolutely something that we could see more of, just because if you're looking at it from the perspective of I want to maximize the value generated to the common shareholder, right? Then the name of the game is to sell stuff that is overvalued or relatively overvalued, and then buy stuff that is undervalued or relatively undervalued. That's it. Like, if you can consistently do that, everything else will kind of like work itself out, and then value will accrue to the common stock. Okay, like that's it. Now, obviously, all of this is somewhat contingent. All of this is contingent on Bitcoin like actually outperforming, right? Like it's all contingent on that. Everything's downstream from that. But assuming that is the long-term case, then everything else from then on really is just about selling stuff when it is relatively overvalued and buying it when it is relatively undervalued. So from the perspective of Bitcoin versus the common stock versus all the other preferred stocks versus the cash reserve, amongst that set of assets, amongst that like Rolodex of assets, there's always going to be something that's relatively overvalued, and then there's always going to be something else that's relatively undervalued. As long as you can make the trades properly, then the value will eventually accrue towards a common equity.
And to that point, I think that as strategy kind of discovered this menu of options over time, because they didn't start with all the options on the table, even though obviously in theory they were there. They were kind of going through the idea maze, and now that I think that they have made clear that they can buy or sell any of these different assets or equity instruments, it seems to have caused like a perception that they are not holding to promises that they would have made in the past, right? Of say not selling your Bitcoin, but obviously it seems rational for them to say that all options are on the table, and that's kind of how maybe you keep the short sellers away. It's how you keep demand for the preferreds coming in. That you have that full optionality. Is that the same way you see it, or do you think that commitments to, for example, not sell Bitcoin are valuable?
Yeah, I mean, I would say I would actually take the opposite stance of what you said last. Like, I think commitments to not sell Bitcoin is actually not valuable. It has negative value because it is a short option, right? Like, you are now short an option, and now, like, if you had this option, now you've, like, by your own actions decided, okay, I no longer have this option. Like, you're kind of cutting off some of your own limbs, right? Cutting off your own resources. So that's how I see it. Like, I think ultimately it just comes down to what is in the best interest of the common stock, right? Like, that is what every company exists to do, is to accrue value to the common shareholder. And yeah, like that's the bottom line. So it doesn't matter about anything else really. I mean, obviously we'd like to see more companies buying more Bitcoin, and we'd like to see, we'd probably rather not see more companies selling Bitcoin. But at the end of the day, like, the companies, like, they're beholden to their shareholders and beholden to value creation, not beholden to, some random idea saying like, oh, we cannot sell ever. Like, that's just not good and not how you do business.
And if we look outside of kind of the Bitcoin Treasury space and we look at other companies, it's pretty common for them to be buying and selling assets depending on what the valuations are of those assets, whether they're doing stock buybacks or issuing more stock, and doing M&A and spin-offs, etc. So this is kind of the new phase of active capital management that we're entering into. Do you think that another possibility for, let's call it, ideological flexibility would be on the question of using derivatives? We have not so far seen Saylor or Strategy implement derivative strategies like we might have seen with Metaplanet, for example. Do you think that's going to enter into their menu, or is that would that create too much noise for them?
Yeah, I mean, I think right now the company has a lot of, like, an identity crisis of sorts. Like, maybe it's not that way to management. Like, maybe they have an idea of what they want to do. But I think in public perception, there is that identity crisis. I think anything can really be on the table. To the point about derivatives, right? Like, obviously, Saylor has made it clear, like, he probably wouldn't want to put more structures on top of it that, potentially generate, like, income on the Bitcoin via derivative strategies or staking or whatnot, right? And that's very reasonable. He doesn't want to make the investment case more complicated. But that being said, like, here's one easy example for where derivatives could be a value add, right? Imagine if they have, so obviously they have a bunch of prefs, right? But imagine if they set aside some Bitcoin, they hedged that Bitcoin that was set aside for the prefs. I think that would probably like instill more confidence in the backing behind the prefs. Like if they set aside, so right now there's about $10 billion notional of stretch, right? And so they're like, okay, we know there's $10 billion notional for stretch. We're going to set aside $10 billion of Bitcoin and we're going to hedge that with puts, right? So they pay money for these puts. And if that Bitcoin that is set aside for stretch, again, it's not like encumbered necessarily, but it is set aside like at least nominally. Like the company does say like this much Bitcoin has been set aside and we're going to put a hedge on it to make sure that its USD value doesn't fall below a certain point. Like would that be positive or negative for the digital credit? I think it would be fairly positive. It probably would be viewed like something akin to a cash reserve. Functionally, it's kind of like a cash reserve if you're saying that, you know, it's not going to go below this point. So the flip side of that is if you buy a protective put on some Bitcoin, that is logically equivalent to just buying a call option at that same strike, right? It's the same return profile. So if you've justified, okay, we're going to set aside this money for this Bitcoin and protect it with puts, now you've obviously also justified, like we'll set aside this cash reserve, but then we'll use call options to have Bitcoin upside exposure. And so now you can clearly see like simple derivative strategies certainly can make total sense, right? What I probably would not see happening is something where they're like, okay, we're going to do a sophisticated options market making kind of deal and then use our Bitcoin as marginable collateral to open these trades. Like I don't think we're going to see that. But, you know, again, I think anything could be on the table.
Yeah, that makes sense. You know, you mentioned on kind of the protective put side, they already have these cash reserves for future dividends. That is credit positive for the preferreds, but it's also introducing cash drag for the common. How do you think about that trade-off in terms of maybe their cost of capital on the preferreds versus the drag?
Yeah, so I would say mathematically, and I've written about this like on Twitter and whatnot, but mathematically, they are not going to maintain a N-year constant amount of dividend coverage. It's impossible because, like, just think about this. If you're going to keep issuing more digital credit, and let's say you issue at, let's just keep numbers simple, at a 10% cost of capital, right? So every year you issue this share, and the share is worth $100. Every year you got to pay $10, right? If you wanted to maintain 3 years coverage on that, like, you know, like now you have, that's 30% of your value is 10% times 3 years. Now that's 30%. So every $100 you raised selling this thing, you have to set aside $30, which is kind of like a, you know, it's not exactly this, but it's kind of like a loan origination fee of 30%. So this is like, you know, like there's an extent where this is like, okay, this is unacceptable. I will say, to the point of the discourse around the USD reserve, the true origin of like where this all came from was the S&P credit rating. They did the S&P credit rating like October of 2025, and in the credit rating, the agency specifically said, hey, it would be nice if you guys had a cash reserve. That's where the origin of all of this comes from. Okay? It wasn't like an idea that they just like thought up of. It was something that, you know, was specifically prescribed, and then they decided to act on that prescription, and now they have that reserve. And so the point of this reserve was always to just get your foot into the credit rating agency's door so that you can get a good rating on your prefs, and then this way you can sell more prefs, hopefully at a lower cost of capital. That was always the plan. It could have been, you know, now it might have, like, because of a lot of market fears and whatnot, things could have shifted towards like, hey, we need to make sure this cash reserve is always up and at all times. But I'm just saying, like, just trying to sound the bell here is just like, it's not going to happen in the long run. Like if you are of the position that more and more digital credit will be issued, then you cannot simultaneously be of the position that this N years of dividend coverage will be maintained, where N is a constant number. Like N has to start going down over time as more credit get issued, right? So I think that would be how I view that. I think a lot of fear is in the market right now, and the company unfortunately has to also respond to that. So that's kind of how I see like what's going on with that.
And do you think the cash reserve should be set aside for situations where companies simply don't have access to capital markets, and so it's their last resort, or to use it more strategically, like Strategy did earlier this year with paying off part of their convertible debt?
Yeah, like so this one I kind of want to take it away from just Strategy, right? Because there's companies in general that like have Bitcoin, and they can also have some cash. If a company just had Bitcoin and cash, the cash should obviously be deployed, however it is that would be most value accretive at that moment, right? And given the facts and the long-term time horizon as well, right? So incorporating all of those facts, what is the best course of action right now? So, in general, that's how you should always like use cash, period. And then also, if a company had an operating business that was throwing off a lot of cash flow, and they also had liabilities that they needed to pay because they were financing their Bitcoin purchases, well, now they don't really need that cash, right? They don't need that cash to keep it to pay coupons or dividends or whatever, because they have cash flow from their operating business that they can use to pay that. So that question and the results of that question kind of change when the parameters change. With Strategy, like, unfortunately, they don't have that operating business that is able to throw off that much cash flow to pay all those dividends. So to the credit markets, it's like having that USD reserve is an insurance policy of some form. And because of that, like that's why they're stuck in this kind of situation. If they were to take that cash and deploy it, the deployment logic still is the same with any operating company. It's just whatever is most value accretive at that moment, given all the facts.
Yeah, that makes sense. And then there's also kind of the sequence of returns problem, right? Where even if we're long-term bullish on Bitcoin, outperforming the preferreds, in the meantime, we could have a very long sideways bear market and cause kind of issues. How do you think about the sequence of returns issue for Bitcoin Treasury companies? Is the 4-year cycle over? Is kind of the other big underlying question there. But yeah.
I mean, sequence of returns is ultimately the main variable and question mark whenever you're dealing with any kind of leverage, right? Or amplification. I know there's, people make that distinction, but, for our purposes, I'll just say leverage, right? So anytime you're dealing with leverage, you have the sequence of returns. When it's margin leverage, your sequence of returns is just super time sensitive, right? It's like within a day or two. And if you're doing these kinds of like perpetual preferred equity given leverage, then you now have more time to be correct about something, and you've given yourself more time. But over this time, right, like given a poor sequence of returns, you will see the common equity get absolutely crushed. And this just comes back to what I was saying earlier, like the common equity should accurately be thought of as a call option, and that call option throws off decay of some form, like some kind of cost needs to be paid for access to that convexity. And so if you got access to that convexity for, let's say, 3 years, and 3 years, no big event happened that allowed you to profit from that convexity, well, then you would have been paying a lot. You would have been bleeding a lot, right? So, of course, your call option would be severely degraded in value. and that would be a common equity that got crushed by a poor sequence of returns. In terms of the second part of your question, the 4-year cycle, like for me, it's like I mean, I think we cannot deny that the 4-year cycle came on time, at least for the top. Like as far as like this time, it was concerned. Like it came exactly on time. Going forward, I do think like it's eventually going to fade because I don't see any like economic reason for why it needs to continue. But you know, I cannot deny that empirically it has held up so far. If I were to guess, I would have to guess like, hey, most of the market's probably thinking that October of this year will be around where the bottom is. I don't think the bottom is going to be as extreme as in prior bottoms, right? Just like the top this time wasn't as extreme as prior tops. So that's kind of my view. It's like kind of, you know, we'll more or less follow in lockstep this time around. And yeah, but things will be fine in the long run because I think the fundamental properties of Bitcoin really haven't changed at all. And if anything, the surrounding like political, institutional, and other kinds of backing behind it have only gotten stronger. So I think the long-term future is very, very sound. It's really these like, you know, intermittently you have these kinds of issues. So that's my view on the 4-year. Yeah.
So on the point of cycles, there's kind of the diminishing returns thesis that every Bitcoin cycle has underperformed the previous one. And then we saw gold have a massive generational run over the past few years. And it's obviously much bigger than Bitcoin's market cap. I think it's 20 times bigger than Bitcoin's market cap. So in my mind, at least, it kind of invalidates this rule of thumb of saying, hey, the bigger the asset is, the harder it is for it to move. On the other hand, gold has been driven by central banks buying. And we don't really have that on Bitcoin's horizon just yet. We'll see how the strategic Bitcoin reserve develops. But what do you think have been kind of the catalysts for this bear market? Is it just the OG selling, or are there other macro factors that we should be looking at?
Yeah, I think it really does not have to be more complicated than OG selling. If you look at other macro factors, I think the last time we were talking about AI. Like AI can draw attention away from Bitcoin. Like, and I said, look, even Polymarket can draw attention away from Bitcoin, and all of these things kind of pool together insofar as factors that can influence how a cycle plays out. We have 3 very big IPOs, like the biggest of all time this year, right? That's going to pull a lot of capital out of assets. Whether we like it or not, like Bitcoin is still roped in broadly, largely, as a speculative asset, right? And so that is going to, new and hot and like really fashionable IPOs is by definition going to compete with that same theme for Bitcoin. So I think that's just what's been going on. But it doesn't really have to be more complex than OGs have sold, and them selling doesn't really have to be more complex than, hey, look, they've done the 4-year cycle like 3 times now, and they're just like playing in lockstep with how things have happened as they've seen it. So I don't think we need to ascribe more complex theories to that than just, things are just following the prior lockstep.
And so this will come off as 2020 hindsight, but you'll hear people say, strategy, these other Bitcoin treasury companies, they were buying a lot at the top when they could raise a lot of capital, and they were immediately putting it into Bitcoin. They should have raised the capital and then DCA'd in or waited to time the market. Do you think that there's some truth to that they should be market timers, or should they be pretty agnostic as to when they're buying?
I mean, so I think there could be some truth to it, but I think I think the real mistake people make is that they're kind of taking on the perspective of what they should do as natural persons and then extrapolating it to how a corporation should be. Like if you were a natural person, and let's say you were just borrowing money or whatever, like you might want to like DCA it, right? And that would probably like smooth out your returns. With a company, it's not real. I don't think it's that big of a deal with a company because at the end of the day, like they like the less moving parts, the better. And you want to keep things simple. If your policy is to buy Bitcoin or if your policy is to increase your cash reserve, then whatever money you have coming in would just go towards whatever standing policy you have. And then you can kind of leave a lot of like variables out of it. And I'd also propose that the flip side of this is, people are basically just talking a lot of trash during a bear market. And so, of course, every week, you bought in the prior week and this week it's a little lower. It looks like you had a terrible entry price. But on the flip side is if this was a bull market and every week it was lower than, the current week, now it looks like he's buying below spot, right? So it's like if you just look at the perception and like did not really think too much about it, you'll always get the wrong and more biased view, and that'll always be your conclusion. But if you just think about it a little bit more, it's not really that bad. If you get the money, just use the money towards whatever policy makes the most sense for the company right now. The bigger question is like, is the money being deployed correctly between cash and then should we even be issuing prefs at this time or should we even be issuing common at this time? Like that's really the bigger question. I think like I would probably have liked to see the discourse more focused around that.
It seemed like the prefs STRC when it hit $100, they were issuing more. It seems like there, as a practical matter, wasn't really a ceiling on how much they were willing to issue, and then they started trading at a discount. I've seen rumors that it was because people were leveraging up on top of the prefs to capture some spread with margin loans on their stock portfolio or something like that, and then they get liquidated and are forced sellers. Do you think that the trading band and the communication about the $100 par value that needs to evolve, or that there's some kind of game theoretic changes that need to be made to the instruments themselves?
Yeah. This is a great question. And it's a very, very deep topic. I don't know if I'll be able to fully cover it like here. So I think the bottom line up front is, they were ultimately contending with something called the impossible trinity, right? And this is a topic that is very, very, it predates Bitcoin by like decades, right? It basically states that within any economic block, you can only have two of the following three things, right? You can only have either, you can peg I know it's not like a true peg, but I'm just going to use that word because that's what the textbooks use. But you can have a pegged or a fixed exchange rate. So in STRC's case, this would be the promise that it would trade at around $100. And again, I know it's not a promise, but this is like the implied. Okay, so you have the fixed $100 price. You can have free capital flows, which means people can freely buy or sell, exit the system, which is always going to be true because it is a security that trades on the NASDAQ, right? You cannot impose capital controls there. And then, of course, you have the third thing, which is sovereign monetary policy, which in this case is just the ability to control the dividend rate. So that's the impossible trinity. Of those three things, you have to pick two. You cannot have all three. You've already said you're going to keep it at $100, so you've picked the fixed exchange rate. And you've already listed it on the NASDAQ, so you've picked the free capital flows. This means you no longer control the dividend. Now, if that's the case, then you're completely up to the whims of the market. And so if the market's going to push the price down, you will now have to raise the dividend. And there's no choice. And the only choice you have would be to compromise on the first thing, which is the $100 stated amount, like having it trade there always. So what has ended up happening? Well, I think the market, quite frankly, has pushed it down. And, like you remember, I think back in, back when Stretch had first started, it was trading at around 92-ish, and they suddenly raised it like 100 basis points. Remember that? Like they raised 100 basis points to like force it back towards 100. And now we have Stretch at like, at the time they made this decision, it was like below 87, right? So below 87, they only raised it 50 basis points, right? So you can kind of see how there's already starting to become a compromise on the dividend side of things. Or the statement that was issued, might have been 2 weeks ago or 3 weeks ago, but basically it was the one where they had that new policies, like new everything, right? And part of that statement said, we will no longer raise the dividend on Stretch just because it is trading below 100. So when I looked at that, I'm like, well, this is clearly the company saying that, like, hey, look, we're not going to guarantee that this $100 fixed rate is going to hold. So this is them reclaiming control over the dividend, right? So in the impossible trinity, this is them saying, okay, I'm not going to do number one anymore. I still have to do number two, which is because it's listed on the NASDAQ. And then I am going to reclaim control over number three, which is the dividend. And that's perfectly okay. That's perfectly okay. They have every right to do that. It's their it's within the rights of like the prospectives for the security. So that's fine. But I think in many ways it was needed. Like this was going to happen sooner or later. Now, the other thing is like, should we materially change the security? And I think this is probably even more interesting than everything we had just discussed, because like personally, I do think that there is room to make some changes. First of all, this is a floating rate instrument, or rather, it's a variable dividend instrument. If you look at the market for floating rate notes, for example, they tend to have about like 2-year maturity. So in 2 years, something has to be paid back. The principal has to be paid back. And then the way the coupon is adjusted is every day you snapshot the SOFR, and then you put a fixed spread over it. Okay, so the spread itself is fixed to the value of the principal, the face value of the note. And then SOFR, of course, is what floats. SOFR is the only thing that floats. Okay, so to all of these other instruments that are floating rate, SOFR is really what makes them floating rate instruments. It's by virtue of the fact that SOFR floats. That fixed spread isn't floating. Okay. If you look at digital credit, it's completely different. Digital credit, it floats by virtue of the fact that the price, we are trying to keep the price stable. The price is not at $100, then we change the dividend. That's why it floats, right? So that's potentially a problem, because like it makes this thing a little too different from the others. So that's potentially a problem. Another thing is, and this part, it almost pains me to say this, because I do view perpetual duration as a good thing. But I think to a credit investor, right, the fact that something has to be repaid at some point is an anchor point on objective value. Like if I know for a fact, like 2 years down the line, I am going to be paid the principal, and like this is their obligation to do so, then I have that objective anchor point. If all I have is this promise that this dividend will be paid, but then the dividend can also be suspended if something happens. Like now you can see where, to me as a credit investor, I would either have to attach a huge spread onto it, like a huge credit spread, or I would really not treat it as credit at all and treat it as something that should trade with more volatility. And if everyone else in the market kind of thinks that, you will have the volatility that we just had, right? So I think like this is a natural outcome of the economic incentives, and if we want to change this outcome, we have to change those incentives. So one thing I would like to see them at least consider is perhaps put some kind of investor put into these instruments. Okay, like if the stated amount is at $100, they could put the put at like 85. And then every 5 years, every 5 years, like let's say, the investors are allowed to put the security back to the company, force the company to buy at 85. What that's going to do is, first of all, it now creates the objective anchor point. So it kind of mimics what the floating rate note does, right? But also, it keeps the perpetual duration. It's just no longer like a Macaulay duration anymore, right? It's more of a, it's duration by virtue of the fact that, this thing doesn't expire. But then again, if it gets putted, then it's done. So that's kind of the new game theory. And if we then look at this new game theory, as we approach that 5-year put date, what's going to happen is the price, if it's below 85, will go towards 85. And once it goes towards 85, you also have the perception that, hey, if I don't put it to the company, then I earn the dividend. And so maybe it goes to premium to 85. And if it goes to a premium to 85, they wouldn't put it anymore. They would just sell it if they wanted to get their money. You see? So I think something like that could create more stable dynamics to digital credit. But that being said, like, is it even possible to amend stretch to that extent at this time? Like, I don't know. But I'm just saying for other like companies that might be looking to issue these credit instruments, these are things to consider, right?
So first on your point about the put, couldn't the investors overlay the derivative on top of the instrument? I think that now there are options chains on the perpetuals. Do you think that's a reasonable approach, or it really has to be the issuer to put in this protection?
I think the issuer would have to do it because the options market right now, I mean, it definitely got a lot more liquid after the sell-off, but it's just not enough to accommodate the size, right? Stretch is a $10 billion notional value asset. There is not that much options trading on it, so it would be nice, yeah, it's true. Someone else could buy the put, but when you're talking like a really large scale, money manager managing a bunch of money, like this is not an option for them, right? And ultimately, those are the pools of capital that we were looking for in the first place. So I think creating that accommodation of the investor put would probably fit that bill a lot better. It'll make them feel a lot more comfortable, right? Because then it feels just like one of those floating rate notes that they would otherwise buy. So yeah, those would be like my two addendums, right? Like, forget the variable rate that's based on the price. Just like make it SOFR plus spread. You make it SOFR plus 700 bips. That's more attractive than any floating rate note. Okay, like SOFR plus 700 bips, and then we can go from there. And by the way, if it's really SOFR plus 500 plus 700 bips, like, you will eventually get it to trade above 100, because these things, it's not going to stay like that forever. Like, once the market like wakes up to it and they're like, yo, this is actually a good instrument and the risk isn't really that bad, it will like break the peg, but it'll go to the upside now, right? And so, of course, implied within this is also just remove your 101 investor call, right? Remove that $101 strike price to call everything back at 101. Allow it to trade above par if needed. I think like Saylor did something like that. They were like, yeah, we can suggest that. But what they were doing was more so like saying, hey, like this would deter the shorts from putting on short positions at 100, which of course, right, that's a reasonable deterrence. I just think long term, it's probably better to not target a stable price and better to just act more like traditional floating rate notes.
Yeah, and so that's a really interesting proposal. With the SOFR plus, I think that makes a ton of sense. The protective put just it sounds expensive for the common stock to underwrite that.
I think it's like this. Like, I think ultimately, with something like that, the company will not issue as much digital credit as they did right now, right? Like, imagine if they knew 5 years later, like, we might be on the hook for 85 cents on the dollar, right? Then they'll be more careful about it. But, and so what that would lead to is, A, they buy less Bitcoin in the meantime. But B, like, they probably have higher quality buyers. And this is the part where I think no one's really talking about, is that, like, right now, I believe most of the buyers, first off, we know most of the buyers is retail. Okay, like, Strategy has their own deck. It says, like, for Stretch, about 80% retail ownership. But here's the other thing, okay? And this is the part that, like, people don't really think about that much. The 20% that's not retail, at least 6% of the 100%, about like 600, about like, yeah, like $600 million of Stretch was owned by these DeFi protocols. Now that's probably I'm gonna assume, right, that's gonna come across as institutional. So, but like, that's institution ownership, but what's really behind it is just retail. It's like no institutions really use DeFi, okay? So like, what you really have is probably about 90% is all retail ownership, and they're all trying to do these like leveraged looping kind of things, right? And so that's the quality of the investor that you have under this current model, right? Because they think like, oh, you actually are going to make sure the price goes back to par, and you're just going to keep raising the dividend. So as long as I can like maintain this margin position, I can keep pocketing a spread. Those are the incentives at play. Whereas if you had other buyers who see that there's the investor put, they will come in, and they're not going to be the type that does those kinds of those games where they leverage loop something. And now the behavior of your investors is necessarily going to be different, right? So when you have a first wick down or something, everyone isn't getting margin called. They're just looking at their investor put and they're like, yo, like we're gonna be okay. Like, worst case, we hold to when this put expires and then we just exercise it. And that becomes the new dominance mentality for that market, right? For the market on that instrument. So I think there's something there. Like, there's something to consider about that. You won't sell as much, but your buyers will be probably quality buyers that's not trying to play these kinds of games that'll ultimately just make everyone look bad, right? Because, look, if you promised that this, I know they didn't promise it, but if you're marketing it as like, hey, this will more or less stay at this trading range, then it doesn't for an extended period of time, that looks terrible. That looks awful, right? So these kinds of faux pas just won't happen as much because the investor base will be different, and I think the credit looks more like traditional credit and less like something too new and too like out there. And I think there are benefits to doing it that way. But to your point, it is going to be expensive, right? And it's expensive on the one sense because, we cannot issue as much. But it's expensive on a different sense because, look, if we have to accommodate like huge lump sums of exercise, then we'll have to be much more disciplined with how we manage cash. But again, I will say, right, assuming the asset coverage is there, the exercises should never happen. Does that make sense? Like, assuming the asset coverage is actually there, it will always go above 85. Once it goes above 85 or whatever the strike is, right, it'll always go above there, and it'll peak a little bit over that because there's a dividend yield in the future if you don't exercise. Because it peaks a little over that, they will never exercise because they're going to just sell on the spot market. The other thing is, if they end up having to, if investors exercise anyway, and the shares are trading above spot, you can ATM to just like raise the money and just give the money back. Like, you could do that. So I think I know the put is it could be more controversial, but I think if you think it through, it's like there's actually some optionality there, and the upside to it and what you gain from it could make it worth considering. So that's kind of my idea.
Yeah. Okay, just to pressure test it a little bit more, because I think it's a really interesting idea. If in 5 years you see this kind of flash crash, right, where there's stress in the market, not for any underlying credit reasons, not due to a lack of coverage, but purely because there's more sellers than buyers, does that kind of force the company's hand when really they should have been able to ride through it?
Yeah, it does. In that case, it definitely does. But if that happens, right? Like, there's literally no problem in just selling the Bitcoin and then like meeting those exercise needs. Like, there's literally no problem with that. They can also preemptively, like, if it goes below the strike, like, let's say we are 3 months out, right? 3 months later is gonna come the exercise date. And then it falls way below. It falls to like 75, or how it fell like this time, right? At this time, the company is like, all right, so 3 months later, we're going to have to pay back 85 cents on the dollar. Right now, it's at 75. Let's just scoop up as much as we can at 75, right? Like, this becomes at that point, you're accretive. You're 100% accretive because you're buying something below the point where, like, you're going to be obligated to pay that money. So that would be an action to do, and this would be exactly what the cash reserve would be for, right? Like, for stuff like this. Frankly, the cash reserve isn't for paying dividends because they sell Bitcoin or common to pay the dividends anyway, and the cash doesn't get depleted. So it's like this is the type of thing where you can deploy cash in like larger quantities.
Yeah, that makes a lot of sense. It's a really interesting idea. The other question I would have along those lines is, the effective yield increases as the price of the preferred goes down, and doesn't that just naturally attract more investors or even just short-term traders who kind of see that it's mispriced, and so the issuer doesn't need to do anything, or do they have, again, promises made to keep it close to 100, and so they have to do something?
Yeah, so I think it's valid to assert that as the effective yield goes up, it draws in more buyers. But then I also think like that mental model only works within like your plus or minus 1.5 standard deviation type of event, right? Like once you go outside towards the tails, you have no idea what's going to happen. So this is something that we have to be very careful and precise about, because like ultimately the way normal credit assigns the value is because there is that repayment date. That's what anchors the value. If you just have an instrument that throws off dividends, but then it never has to like pay the principal, you have a situation where everybody in the market now knows that the next time I can get out and get my principal back is completely up to the whims of all these other people that are playing around in this market, like I am. Like which one do you think gives more confidence? Like the first one where like, hey, I'm definitely going to have to be repaid at some point, like 2 years from now, or like 6 months from now, or some specific date from now. Or the second thing, which is like, oh yeah, I can do this right now and it would be a high yield play, but when I have to exit, I am completely subject to whenever that future spot price is, and I have no idea what it's going to be, right? So that is clearly, yes, that could attract traders. That could attract people who are like long-term, short-term, right? Who are more short-term than long-term. But now think about it. Like if your entire premise was we were trying to sell to the credit markets, but now you're saying, hey, now we just want to attract traders who would leverage up and who would like try to go in for the high yield. are you really targeting credit anymore? Or are you targeting people that are more short-term traders, right? Not that it's wrong to like sell instruments to short-term traders, but if the stated goal was to like sell to traditional credit investors, and then in fact you are not doing it because of the way you've structured the instrument, then I think something is wrong there, right? Like maybe it's not legally wrong, maybe it's not like even wrong for the company to do that, but something's wrong in terms of like how you're presenting it, and then like what's actually going on, and there's a disconnect about that.
Like a product market fit issue, really. So this raises an interesting question, which is that rather than positioning the preferreds as better than a money market fund, for example, or kind of like a savings account where you do have kind of par, create, redeem, right? You don't have to worry about the principal. Positioning it as more akin to buying a piece of real estate, home, let's say, to rent it out, and that you'll earn the income stream of rent, which will be stable, but your ability to sell it at par is not guaranteed, right? So really the decision-making process should be about, do you want this stream of income, and how confident are you about the future dividend rate, rather than trying to worry about, can you get in and out of the principal at par? Does that make sense?
So are you asking me like the
marketing, the product market fit is of a longer duration than what kind of has been floating out there of, oh, this is like cash?
Yeah, I mean, I think if you're talking about it and like you're marketing your security as the issuer, yeah, you shouldn't use the kind of like cash thing. I think that's not the best like legally sound way to characterize it. But then also like it is hard to do marketing, and it is hard to like grab people's attention. And so I understand like there are incentives at play that just because of how attention starved everything is, right? It's just like you have to try to grab people's attention, and then you have to make outstanding statements in order to do so. This is just, I think, how things are in the social media age, right? So it's one of those things where we could wish it were different, but I don't think things would change that much. But that being said, like the larger point is absolutely correct. Like I think something like Strife, for instance, right? The most senior pref that just like it's basically a perpetuity, with of course a risk, with a credit spread that needs to be attached to it. But like that's a very good security, like all things considered. If you are truly a retiree, then you've like did your math and you're like, all right, from today until when I retire till the day I die, like I'm only gonna need this much money per year. This is how much Strife I'm gonna need to fill that part of my investment portfolio. Perfect. Like then you don't have to worry about the price. So like, if you're truly a retiree, like yeah, there is a point to be made. Like why bother if the price like collapses below your entry price? Because as long as you're still getting paid the dividend, that's what you bought it for, right? Sure. Like what's the problem? But again, like I think the pain that is felt in the market, like at least over the last month, is just frankly because those were not the buyers. The buyers were people that were leveraged long. They were probably trying to earn some like carry spread, and they're probably trying to like be the first ones out as soon as anything went wrong. And then a lot of them just got caught flat-footed, and that is how we saw the cascade that we saw. So I think that's really how it is. And part of it is also like, the super conservative investor that's just buying this for retirement, they're probably not looking at something like this that isn't rated, right? Like you just have to think that like there's just all these other variables at play, and strategy is in a very hard position to have to balance all of this, right? It's a difficult thing to need to balance everything and make as much people as possible happy. So I think that just also needs to be something that's considered, right? Like it's hard. It's genuinely hard. Not that it's an excuse for anything, but it's just difficult.
And on that point, as people kind of get more educated and see the track record for these over multiple years, is that how you change kind of the investor base for these instruments from short-term to more long-term income, or do you stick by your thesis that there needs to be product changes?
Yeah, I mean, I want to clarify. Like, I'm not saying there necessarily needs to be. I think what I'm suggesting would be very helpful. Like very helpful certainly in the next like 2 years. Long term, I don't think like these instruments are dead unless the Bitcoin thesis that we all have is wrong. Okay.
Right.
Like that's where this is all downstream from. So as long as like I think ultimately what happens is once the bear market ends and the bull market returns, like all of this stuff will be bailed out at the end of the day by the rising Bitcoin price. Okay. That's just what I think would ultimately happen here. Like we can suggest all of these things, like Saylor can and his team can put out these like new frameworks and whatnot, but this is all to just try to outlast the bear market.
And on that point, do you think there will be instability introduced in the bull market by people selling the preferreds to buy the common because now they think that's going to outperform, and then vice versa in the bear market, them at the beginning kind of just dumping their common stock to pick up the preferreds, and we'll constantly see this back and forth rotation? Is that destabilizing?
I think it'll happen. I don't think it'll be destabilizing. And the main thing is during the bull market, you'll just have so much more demand anyway. So, and remember the flexible load here, right? To use a Bitcoin term, right? The flexible load here is really just the ATMs. Like if a lot of people want to buy this thing, but then also a lot of people want to sell it, then the ATMs just won't run as hard. But if a lot of people just want to buy it and the demand is like gushing and overwhelming, then the ATM will run however high it needs to run, right? So that is how I think it is. Like the flexible load here is the ATM. And so I don't view that as a destabilizing factor.
Yeah, that makes a lot of sense. Allard, I've really enjoyed our conversation today. Is there anything that we missed? I want to encourage people to go check out your research report and to dig into it. But before we sign off, are there any major points that we didn't address?
No, I think we've covered a lot. We probably need like another hour or so to talk through like all the stuff happening on the protocol side. Like it's also lots of stuff going on. But yeah, on the corporate side and digital credit, I think this has been comprehensive.
Awesome. Well, thanks for coming on the show, and thank you to our listeners for joining us for another episode of the Bitcoin for Corporations show. As we travel through this bear market, I think now's a great time to be learning more and absorbing kind of what's going on. So we hope you'll join us on the next episode, and don't forget to like, subscribe, leave a review, and share it with your friends and family.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Katie Greifeld. We're keeping an eye on equities, but let's check in on the world of digital currencies. Strategy beefing up its reserves to $3 billion following its recent stock sale, not buying or selling any Bitcoin between July 6th and July 12th. Joining us live, I'm pleased to say, is Strategy CEO Feng Li. Feng, fantastic to have you with us. So as I said, this week you issued that stock sale. Your cash reserves are up at $3 billion. My understanding is that this allows you to pause Bitcoin sales for the time being. But talk us through, what the next several months look like. Do you plan to sell more Bitcoin? And if so, how much?
Katie, thanks for having me. We have really evolved from being a Bitcoin treasury company to a full digital capital platform. We're the world's largest identified holder of Bitcoin in the world. We have over 840,000 Bitcoin. Digital credit has been launched in the last year in the form of Stretch. That's $10.5 billion. So we have a responsibility to our common shareholders, our preferred shareholders, and Bitcoin, of course. We issued now, or we've accumulated $3 billion in cash because we listened to our preferred shareholders and they said having liquid cash on our balance sheet in the short term is important. And we also sold Bitcoin to be able to show liquidity with our Bitcoin. Yes, we will continue to issue capital. It could be in the form of MSTR, it could be in the form of Bitcoin, and we're going to make the decisions that are best for our shareholders over time.
Well, could it also potentially be in the form of STRC that, of course, are preferred shares that are known as Stretch? My understanding is that you last issued Stretch in mid-May. Of course, it's been trading at a discount here. Do you plan to issue Stretch again in the near future?
Yeah, our plan is to get Stretch back to par. Unsure how long that will take. Building up the U.S. dollar reserve was a big part of that, and we'll continue to build that. And yeah, when Stretch gets back to par, we'll issue more. We'll buy Bitcoin. We may continue to beef up our U.S. dollar reserve. That's a big part of our capital plan, is to issue more preferred over time because it's very accretive to our Bitcoin per share, which is accretive to our shareholders.
Well, I am curious just about just kind of the structure going forward. I mean, to get back to par, is there a sense here that you can do that, whether it's with selling more Bitcoin or issuing more equity? Have you determined what might actually be the best path to get there, or the most efficient path to get there?
We think the first thing is the U.S. dollar reserve, right? I think we've learned over the course of the last couple months that having that liquid access to U.S. dollar capital, whether it be 1, 2, 3 years, is quite important. And we saw when we increased it in the last couple of weeks, we got stretched up from a low in the 75 range to close to 90. So we'll continue to build that. We increased the dividend. I don't think the dividend is as much of a factor. And I think a track record of success and a track record of execution. And then, of course, education. We're a year into the product. A lot of financial products take 2 or 3 years to mature. So we're early, we're learning, we're listening to the market. And the great is there are built-in mechanisms with the market, for example, going to par, right, and staying at par. That's the mechanism lets us know what we're doing right and what we're not doing right and what we can improve upon.
What's the communication, though, with shareholders overall? There's been a lot more focus, obviously, on the preferred shares, but I mean, you guys issued a ton of common equity in the preceding years, and I am curious if there's any sense in trying to reconcile with some of those folks who bought a lot higher than where that 96.73 price stands right now.
Our shareholders understand our primary goal is over time to outperform Bitcoin, which is an extremely volatile asset, right? It's vol is somewhere in the 30, 40, 50 range, and they understand that MSTR is built to outperform Bitcoin, and as a result, when Bitcoin goes up, MSTR typically goes up more. When Bitcoin goes through a bear cycle like it is right now, MSTR can perform a little bit worse. But as long as MSTR is priced at greater than the net asset value of our Bitcoin, it means that our shareholders are giving us credit for the performance above Bitcoin. And when we do that, we can issue more equity for the most part. Look, we talk to our shareholders all the time. There's quite a few constituents. As you know, we're one of the most liquid stocks in the world. And when we talk to our shareholders, institutional, retail, we look at what people say on social media. We take a lot of comments. We bring that all in, and it's great to have the feedback.
And I mean, just looking forward again, I mentioned that, you know, your cash reserves, they're $3 billion right now. It seems like you have several years of being able to cover your interest expenses. But I mean, when you game plan out in the future, 3 years, 5 years, it just feels like Bitcoin has been stuck in this rut for a while now, you know, trading around $60,000 per coin or thereabouts. But do you have a break glass sort of plan if, you know, we go down to 30,000 or 20,000 or even below?
Yeah, when Bitcoin gets down closer to 8 to 10,000 is when we're going to have, you know, we have to consider some of the risks associated with our debt. Until that point in time, we feel very secure about the balance sheet. Look, to your point, Bitcoin has quite a bit of volatility. It goes up and down, and every time it's in a bear cycle like it is, people ask, okay, will it go to zero? And it hasn't yet in its 18-year history. In fact, it just achieves all-time highs. But what we need to do is build a capital structure that can withstand bear markets and, of course, benefit from bull cycles. And that's what we've done so far. We've been through this in 2022. We're going through it in 2026. And I'm pretty excited about the next bull market of Bitcoin.
So for those folks who are concerned that sort of micro strategy as being kind of the dominant buyer, or at least a perpetual buyer of Bitcoin, there's some reassurance you can give them that you are not gone from that market as a buyer?
We're not going anywhere. We're the largest identified holder of Bitcoin. My objective would be the largest buyer of Bitcoin for the foreseeable future. We're not going anywhere. Anybody to $40 billion a day. You saw a couple weeks ago, we sold about $200 million of Bitcoin. It did not move the market. In fact, the market moved up during that period of time. So, but we're not going anywhere. We're sticking with Bitcoin for the long term. We'll be buyers of Bitcoin for the long term.
Okay, so you're not going anywhere. I do want to go back a little bit to the preferred shares because Bloomberg News did report last week that distressed funds, they're in talks to swap their preferred shares for other securities. Of course, that would be a negotiation. And with that in mind, can you give us an update on what those conversations sound like? What is actually developing there?
Yeah, there may be funds talking to each other about swaps. We haven't been in any material conversations. The way we're going to make stretch work is we're going to continue to increase the U.S. dollar reserve. We're going to listen to the market. We've put out, the opportunity and the option to buy back stretch if it makes sense, but we're not in any material conversations otherwise.
And Feng, before we let you go, I want to reflect on strategy a little bit because you're the CEO of strategy. You're best known, of course, for being a Bitcoin Treasury company, really the OG, but you also have a software business, and as of the end of March, you had more than 1,500 employees, and I'm wondering, sitting in the CEO chair, how much of your time do you divide between this ecosystem of financing that you've built up to accumulate more Bitcoin and the actual underlying software business?
I'll start with I'm an engineer by education. I'm a technologist at heart. I'm a financier as my day job, I'll call it. So I love software. I love AI. I love Bitcoin. They're the convergence of all the things that I really enjoy doing. 50-50, 40-60, a lot of the discipline is the same. And, keep in mind of the 1,500 employees, we have folks who are in finance and marketing, in engineering, in legal and accounting that are able to bring a maturity and 25 years of public company experience to our Bitcoin business that I think a lot of other companies that are in the Bitcoin or DeFi world aren't able to bring. And it's part of, I think, what makes us successful.
All right, Fong, really appreciate you taking time for us. Fong Lee there, the CEO over at Strategy.
My stance is I should not have to worry about your thing. Like, you can go do whatever you want. I'm not forking off with you guys. I largely agree with 110 ideas to limit data. I disagree with the execution and tactics used to push it.
Is it the right frame to call it a change if they're saying we want to go back to what we were doing before?
But it's not. The 110 fork changes a lot of other things too. I get vitriol from all sides, core included. The core camp is not without fault here. It takes two hands to clap.
You feel like BIP 110 is doomed to fail, basically, or like you don't think it's going to actually work. Why is that?
Emotions are running high right now, but this is not consensus. It can't fly. Otherwise, the barrier to attack Bitcoin is so low.
Samson Mao, welcome to the show.
Thanks, Jake. Great to be on.
Yeah, great to have you today. I'm excited for this conversation. For those who don't know you, you are the founder and CEO of Jan3, whose flagship product is the Aqua Wallet. You're also working with Jimmy Song on a nonprofit called Production Ready, which is a really interesting development to me in the Bitcoin space right now. You guys are working to fund the creation of a third Bitcoin node software implementation. And you're looking to provide an alternative to core and knots. And you're sort of focused on maintaining a conservative node implementation, not focused on let's add all this new functionality to Bitcoin, more leaning towards let's keep things conservative, essentially, which makes a lot of sense to me. Your career background includes serving as chief strategy officer of Blockstream, which was interesting. I learned that doing research for this. When was that you were working there?
Well, that's a while ago. I think it was 2017 to 2022 or 21, something like that. It was a while.
Okay. Yeah. Cool. You did before that COO of BTCC. So you were working on a Bitcoin exchange and mining pool, and you had a video game development studio before that as well that you founded.
Yep, I still have it. Pixelmatic, still running.
Oh, okay. Very cool. Very cool. Yeah, maybe we'll get to that at the end of the conversation. First things first, I thought since the core versus knots BIP 110 conversation is so spicy, we could start there. You're working on this third node implementation with Jimmy, and I wonder first if you could start by summarizing BIP 110, like what is going on there with the core versus knot side of things, and do you have a specific take on the matter? Would you like to remain neutral as a third party in this? Yeah, I wonder where you stand on all of that right now.
Yeah, well, there's no end to spicy things these days. There's a lot of spiciness going around all over both sides, everywhere, up and down, left, right. But yeah, where to start? I mean, the thing is, like, I don't think 110 is a viable solution, and I've kind of tried to ignore it a lot, and people kind of ping me and say, well, you should state your position and say something. And Jimmy tried to take a neutral stance, and he was sort of crucified on that stance by both sides. So the core people said, how can you be neutral? It's going to fail. And then the knots people said, you're weak and you're unwilling to pick a side. But I think neutrality or ambivalence is a viable stance in this case, right? So I was planning to write a blog post about this or an X article or something, but I haven't had time. Maybe I'll do it this weekend. It depends on when you publish, but maybe I'll get ahead of you. But my stance is BIP 110 is largely unviable, and it should be ignored. And this largely ties into the principles of my thinking behind Production Ready, which is we need a stable ossification-leaning implementation, because Bitcoin is first and foremost money, and you don't want to play with the system and software and network that enables the first sound money that we've really ever had in the world, that is better than gold, better than anything, because it's information and it's bearer. So there are obviously technical arguments against 110 and reduced data and everything like that. But I think the biggest thing is you should be able to not need to care about the current thing in Bitcoin. You should be able to be in a coma for 3 years, wake up and run your node on core 29 and still be able to transact, right? Having to rally behind and push for something that is an emergency is the antithesis of Bitcoin, right? It's supposed to run perfectly without intervention and the need to campaign and convince people that this is important and you need to do something. The whole point of Bitcoin is that you can do nothing and just sit there with your Bitcoin in cold storage. So,
can I ask you a question about that real quick?
Sure.
Because that seems to me to be, and I'm still trying to wrap my head around like getting deeper and deeper into the technicalities of this conversation. But it seems to me that the knots BIP 110 side of the conversation is sort of saying we had a functioning idea thing that we were aiming at here, and then when Core 30 released, we blew open the filters that maybe weren't perfect, maybe didn't fully do the thing that they intended, but it wasn't saying, okay, now we're going to make this change where we're going to completely open this and allow all of these larger sized pieces of arbitrary data onto the Bitcoin network. So it seemed to me, from my understanding of it, that these were the guys that were saying, hey, how about we don't try to like change it and increase the functionality and add data storage as a feature of Bitcoin, yet we preserve it as focusing on it only being money. Does that seem right to you?
There's a lot to unpack there. So we'll start with the latter part. Like, yes, I agree Bitcoin is money. And there was a few months ago, or I forgot, 6 months ago, there was a lot of vitriol tossed at core developers for not saying Bitcoin is money. And then some of them said, yes, Bitcoin is money. But it's not about whether you want Bitcoin to be money or not money. Money is an emergent property. Bitcoin, first and foremost, is software. So I see the really aggressive 110 people coming out saying, you know, Bitcoin is money. If it's not money, it's not anything else. But Bitcoin is money is an emergent property of Bitcoin. If you look at rhinestones, you can say, oh, if rhinestones aren't money, they're nothing. Like, what is a rhinestone? It's a rock, right? If gold isn't money, it's nothing else. Like, what is gold? It's a rock too,
shiny
right?
yellow
Shiny
rock.
Gold rock, but it's still nonetheless a rock. But you wanting Bitcoin to be money does not make Bitcoin money. Like, it is a network effect. It is an emergent property, and it is emergent property stemming from its innate properties. That it is bearer, it is information, it is permissionless, and you can zap it around the world with no intermediary or third party or any gatekeeper. So you can't really say we want Bitcoin to be money. We need to make it money harder. And I see that a lot. Like, even I think in your notes before, you're talking about strategy and digital credit, but this is also a prevailing theme amongst the people that don't like strategy. They're saying, oh, wrapping Bitcoin up in this instrument, STRC or Strive with SATA or Metaplanet with Mars, it degrades the property of Bitcoin as money. But it really doesn't. It's not that because they did something, Bitcoin is less of it, less like money. It really has nothing to do with it.
Application on top. Yeah, that doesn't change the base. Yeah.
And it is viable for people to use Bitcoin in any way they choose, right? Like, they can put it in an ETF. They can have it as a base asset, a digital capital, building digital credit on top of it. That's the nature of Bitcoin. And if Bitcoin can't do that, then there's something wrong with it. If it has to fit within a narrow definition of a small group of people that, you know, it is money if you do these 5 things with it, then it doesn't really work as money. So you can see it's kind of like it's kind of a conflicting thing there in and of itself, the argument. But going back to your other point too, it's Bitcoin is a very interesting thing. It's almost counterintuitive to a fault. And we saw this with the Bcash, the Bitcoin block size civil war, right? It's a well-meaning thing where you say, well, we need to increase the block size because otherwise people can't transact for cheap, right? It's a very well-intentioned goal that sounds good on the surface, but has deeper implications. Like, well, before we figured out that you could have a block size increase through a soft fork, the thing that was looming on the horizon was a hard fork. And that basically is a totally new thing, a new coin, a new blockchain. And that's not immediately understood, that, you know, your well-meaning intentions over here has deep repercussions over here. But not just that it's a hard fork. You're basically changing the rules for some goal. And that's a slippery slope. Like, okay, well, what if the new thing is, well, there's not enough coins. Not everyone can be a whole coiner. We need to increase the supply. So you can see where it goes, right? Once you start tinkering to optimize for some perceived emergency situation, then you just become a fiat currency and you're subject to the whims of a centralized organization or mob rule. And I think it's similar with BIP 110, which is, it's an emergency. We need to stop bad data, CSAM, whatever, everything from getting on the chain. And while, yes, it sounds like a good ideological stance, and it certainly doesn't help that Luke calls everyone a pedo that disagrees with him. But the thing is, it doesn't change anything that Core removed the limit. They shouldn't have done that because it obviously impacted a lot of people and it fragmented the Bitcoin user base. But you could do that even before Core 30, right? And this is me saying that as someone that vehemently disagreed with what they did and thought that they should have left the policy intact, even if it was simply a detriment or a deterrent. But it still doesn't change that you could have done that before, right? Like, even without Core 30, you could still embed data. There are easy ways around it.
What's the case? Like, why did they say that they did do it, right? Like, we agree that it seems to me to be a terrible idea. Like, why make it easier for, this non-monetary data to get onto the blockchain? But what's the case for doing it? Is it just like we want to be able to sell NFTs and, why did they say they were doing it?
It's because for them as a developer, it's really easy, right? You can easily bypass the limit and get the data in. I think this is the divide. You have very technical, very sharp people that are not that empathetic or high in EQ, and you have the rest of the users of the network, which largely just download the software and run it. And if you just download the software and run it, then there is no real opportunity to embed data, right? You're just sending a Bitcoin transaction with the Bitcoin client. Either you're running Bitcoin Core itself or using it as a node and something on top of it, but it's pretty straightforward. But if you're technical and you're in the command line, you can easily do all sorts of things very easily. And I think that is probably the biggest gap in understanding here, that core developers think they did nothing wrong because you could have done that anyways. It's like, the image of a park and there's like a path where people are cutting across the grass, and I guess the city put up a little gate there, right? And it didn't do anything because people just walk around the gate. From a developer standpoint, that's exactly what the case is. From the less technical user base, it looks like they removed something that was stopping people from doing something that they view as bad for the network.
Here's a question I get asked almost more than any other question. Mark, how much Bitcoin should I actually own? Not should I own it, but how much? Now, almost nobody can answer that with a real number. The retirement system was built for an era. It's gone. Meanwhile, they're printing away your purchasing power while your 60-40 portfolio, it limps along trying to keep up. Now, that's exactly where Unchained comes in. Now, if you want, you can book a free 30-minute session, which is a one-on-one call with one of their specialists, and they'll walk you through the retirement calculator all live. They'll model, the Bitcoin strategy side by side with a traditional 60-40 portfolio over the next 20 years. You'll also see what your balance sheet could look like at retirement, how much Bitcoin you could be holding, and what different tax structures do to the outcome. At the end of the call, you're going to walk away knowing exactly what your number is. And they'll send you a complete personalized link where you can keep it, you can revisit it, you could share it with your friends, your family, whoever else needs to see it. So book your free session at unchained.com/markmoss.
I don't want to put words in your mouth, but you said something along the lines of like, you feel like BIP 110 is doomed to fail, basically, or like you don't think it's going to actually work. Why is that?
Well, it doesn't have consensus. So there are a lot of comparisons to the block size wars and activation of SegWit, but there was major consensus that SegWit was the path forward for the network to fix the malleability bug and to enable Lightning. And it was just a few people blocking it for financial gain, personal gain, ASIC boost. And it was really more about the activation mechanism and activation timeline over the change itself. Whereas 110 and everything, it does not have consensus, especially amongst technical development experts, people that actually work on the software. And even outside of that, there are a lot of ordinary people using Bitcoin that don't agree with it either. So it's a very small group of people that really want to push this forward. And they can be very aggressive and nasty. So it's not a good combination for building consensus. And that is exactly what you need to do to get change in Bitcoin. But all of the technical arguments aside, I go back to you should not be forced to need to worry about something urgently for Bitcoin. Like, that's just not the case. Right now, 110 is popular, it's fashionable, people are rallying, a small group of people are rallying behind it, and I'll get blasted for everything I've said here because, you know, if you're not on their side, you're their enemy. But I don't view it that way. Like, I empathize with them and why they're upset with Bitcoin development in general. But that's not really the path forward. But my point is, if you replaced all the figureheads of the 110 movement and you pick something else, like who in your view are the major ringleaders for 110? Luke?
I think Luke, Matthew Cratter, and probably Bitcoin Mechanic are the people I've heard the most from on it.
So people agree with them. They like them. And you have to kind of take a higher level view of this and think from a more macro perspective. So let's replace those three people with, I don't know, three other people for something. Like, what was the last thing that was urgent for Bitcoin? Making Bitcoin quantum resistant. So you replace that with Nick Carter, who invested in the Project 11 thing to help blockchains secure themselves against quantum attacks. You put a podcaster in there to replace Matt, like, I don't know, Mark Moss, right? And then, I don't know, pick someone else that goes in there and is a
Bitcoin Mechanic equivalent.
I don't know, someone, whatever. But you get the idea, right?
Sure.
Like,
sure.
Just because they make a big fuss, there are some nodes running it. There's like 1% of hash rate signaling. That's not consensus. And you, as a 110 supporter, would absolutely be against that, right? I would think so.
Well,
right?
yeah. And the argument that they're saying is that there would be reason for miners to wait to the last minute to signal or something like that, like from this game theory perspective.
I mean, you can say that, but I don't see that as the case at all. If you look
what do you think of knots? Like the fact that, I think knots has gone from 0 to 20%?
You can't just look at node signaling. That's an easy Sybil attack, right?
Yeah,
Anybody
sure.
can spin up a node. I'm not saying that they're fake. There are definitely real people running knots nodes. I know them.
Right.
But if you look at some of the, like, I read my feed. Like, I see people, like, they're saying, I'm running knots, but I'm switching back to core because now knots is saying I have to signal for 110, right? So now you're being forced to do a change. And, I don't believe that's how Bitcoin should work.
Is that the right frame, though? Is it the right frame to call it a change if they're saying we want to go back to what we were doing before, right? Before Core 29, that was the procedure. So because it seems to me, in my view, that Core 30 was the change.
It's not.
So then I guess it would be a change to the change.
That change didn't matter. So if you want to undo that change, just edit your config file.
Yeah.
The 110 fork changes a lot of other things too. Like,
sure. Yeah.
They're so. Let's pause for a second. I largely agree with 110 ideas to limit data. I disagree with the execution and tactics used to push it.
Okay.
So back in 2025 in Lugano, I actually organized a meeting to see if we could talk things through. And a lot of the players in the space that are fighting with each other now were at a table discussing things. And there was some tentative agreement that, things can be hashed out and maybe there can be a way to limit data to make everyone happy because, nobody wants data to be stuffed into Bitcoin. I think the camps are really divided on should we do something because it is futile and we should minimize harm to the network by discouraging. So I think it's a very thin line where the disagreement is actually over. But
what about like the David Bailey side of the crew that has, what's it called? UTXO management and, and like Bitcoin Magazine in 2023, I think they were like, you can buy special sats. These sats are like, special sat sort of thing. So it seems, we have a photo attached to this sat or we have whatever. So it seems like at least that group would have a financial incentive in being sure there's not a restriction of non-monetary data.
Well, the thing is,
right?
you can never stop all data, right? Bitcoin is data itself, right?
Yeah.
We can define spam, and that's another whole topic and can of worms, but you can't stop it forever. Like there is always going to be a way you can smuggle some data in, right? It might be more convoluted, it might cost more money, but there is always a way. And I think that is what the point the core side is making, that you really can't stop it. But then there is a happy medium where I think you can say, well, something should be done to limit this extraneous data, right? Because it ultimately fees are the filter, but obviously you also don't want spam. So there's a happy medium to tread here. And there was a discussion to try to find a path forward, but then the 110 camp decided just to go it on their own and push for this thing really aggressively. But, going back to my example, you can replace everything with quantum. And I think a lot of 110 supporters would say, no, like that's obviously not good for the network and we don't agree. There's no consensus.
You just don't rush, just let's slow it down a little bit. I hate the rush.
There are so many cases of this. Like there's covenants. Remember, Jeremy Rubin was pushing hard for covenants. I don't disagree that covenants are good, but you cannot go and campaign and try to make it happen. It doesn't work. Consensus is organic. It has to emerge, and we should agree. If you don't agree, you'll fork off. And that is the destiny for 110 because there is no consensus. But you can go on and on. There are all these examples in Bitcoin history where some group of people thought, this is really important, and we need to do this. And you just have to step back from the current situation, maybe take a breath and calm your emotions down. Emotions are running high right now, but if you replace the situation with any other situation, you'll see like this is not consensus and this is not going to fly. It can't fly. Otherwise, the barrier to attack Bitcoin is so low. You and I and Mark can launch an attack on Bitcoin and disrupt the whole network. That's not Bitcoin. It doesn't work. Bitcoin will shrug it off.
What do you think of Mechanic's take that, like, I've heard him say in response to this, that Bitcoin was designed to be partial to a minority that wants to have more restrictive rules? So if you have, I think, does that make sense? I don't know that I can explain it as well as I've heard him explain it, but he said like it was designed in a way where it was to be more conservative, it would be partial to a minority of users who wanted to be more restrictive in terms of the rules than expanding them.
That's just not true because Luke wanted a decrease in block size and we didn't get that. Like that didn't happen. And I don't think that would happen, right? So if that is true,
would
then,
that be a more restrictive rules? I guess. Yeah, I don't know. It might be over my head. I might have to talk to Mechanic about it.
You can soft fork and make the block size smaller. And I think that's probably what was the right step, but that ship has sailed. But you see, you can think something and have an opinion and not go against consensus. It's not that you have to flush the whole thing away. That's how altcoins are made. That's how Bcash was made. That it has to be this way. Bitcoin has to be used in a certain way or else it's failed. Like, again, we've heard that time and time again in the past, right? Over and over, either authentically or inauthentically as a reason to create a fork and profit from that too. But your other point about the ordinals people, like I've said it publicly, like ordinals are a joke. They were always going to die. And yeah, like, of course they have an incentive, but I don't know if restricting data would stop that incentive. It would make it more difficult for them, but they can always work around it. And the benefit of scamming is far higher than whatever fees would be prohibitive to prevent you from putting data into Bitcoin.
Okay,
I mean, that's their whole economic model, right? They made more scamming people into ordinals than they paid in fees, but they still made money scamming people.
Yeah. yeah, I don't think that's something that can be solved with Bitcoin software. The fact that people are going to try to scam other people, that I don't think we can program that one out of humanity with software exactly. But that's interesting. I guess my last question is, so why, related to BIP 110, it's a RDTS, right? So reduced data temporary soft fork. So why is it temporary? And if it is temporary and there is a chain split, what happens after the temporary soft fork ends?
Well, it's going to just create a fork, a minority fork with low hash rate. And then I don't know. I haven't thought that far ahead because it's not a priority to me. And it should not be a priority to me. Like, who are you to tell me that something's happening in what? I don't even know the day. What day is it that they're going to fork off?
I think it's like 28 days from now. So like 25 days from when this releases or something.
Yeah. So who are you to tell me that there's going to be a fork in 28 days? Like, you don't get to say that. We're all self-sovereign nodes on the network. And you can think that, you can do whatever you want, but that has nothing to do with me.
Yeah. Well, yeah, it'll be interesting to see how it plays out. I wasn't around really for the last, in 2017, I was way out on the fringes, so I wasn't really around for the conflict, but I'm interested to see how this plays out. Is there anything that you feel like your average Bitcoiner should do or be aware of going into this?
If you're just running a node that is consensus compatible, you have nothing to worry about. So what you have to figure out is, are you consensus compatible? And, I'll leave it at that.
Okay. Yeah. So moving on from BIP 110 specifically, but still node implementation conversation, why did you start production ready? And what do you think success for it would look like?
Well, the goal was that there will be another client that is focused on security and stability instead of adding new features, because adding more things increases attack surface. And there is a disposition in Bitcoin core development to keep on adding new things and changing things. And as we've seen, that's not necessarily the best thing for the software. There are bugs introduced. And there was like a bug where funds could be lost too, which was, I think, 2-3 months ago. But it just seems like the priority is not on stability and moving towards ossification, but adding new things. And I think that's not ideal. But again, this is a point that is lost on a lot of people. I can't stop core from doing anything. I can't tell them what to do. It's a collection of individuals that have funding or work on their own funding. So the best I can do, and I think Jimmy and others agree that when we started production ready, is we have to fund our own client, and you have to have economic skin in the game. We have to raise money like all the other orgs, like OpenSat, Sprink, whatever, and we have to fund development, because if you're not funding development, then you really don't have a say in what happens in any given software client. So our solution is to build our own, and then people like it, they might run it. But we think it definitely is an option that should exist out there, and we're trying to take it slow, not rush things out the door. We want to find good developers that want to work on this for the long term and are aligned with the vision of safety, security, eventual ossification. And one of the most misunderstood things is, we get attacked on all sides because we're kind of in the middle. But production ready is not the client. It is a funding organization. But a lot of the people that are staunch core supporters like to go after us and say, well, how dare you launch this thing and raise money because you don't have the software yet? But we're raising the money to build the software and to put the team together. And the client is not production ready. Production ready is the nonprofit that is raising money to fund developers to build the thing.
Mm-hmm. I really like the idea of a third client. Hopefully we have 4 or 5, 6, 10 at some point in time. I think it seems to me that the more the merrier would be good. But I really like the idea of a third client because, like in, let's say, politics, you have like right and left, or even look at core versus knots, and you have like the two sides, and it becomes this like character attack. You guys are evil, because they want their side to win so bad. It's so focused on tearing down the other side. And I think a third implementation allows for people, allows for a more nuanced conversation versus like, you guys are evil if you're not doing this, or that sort of thing. That is really promising to me. So I was really happy to see you guys were doing that. I talked to Jimmy at the last conference, and that was the first time where I really understood what you guys were up to, and I was like, that seems really important to me. This is kind of a funny question, but I've heard people make the case for dropping op return to 0, or like getting rid of it essentially, and saying that we should like retard max the approach to like the Bitcoin software, that we need to stop trying to say, oh, we want to increase functionality, add covenants, add whatever things on top of that. Do you think about that, like in creating a node implementation that just like stops trying to do new stuff, or maybe even goes in the other direction in terms of functionality, like reducing functionality?
We don't know yet. That will be up to the devs that we recruit and hire to work on it. But the vision is ossification and stability. But if you ask me personally, I don't really think that does anything. The whole point of adding the op return was that you could prune it. Because if people want to stick data in, they can do so in a number of ways. So you're going back to trying to reinvent the wheel. The op return was put there so you could put arbitrary data, a little bit of arbitrary data, and not bloat the UTXO set or whatever weird thing people figure out to do later. But there is something I think that should be done. Like right now, if you run a prune node, you're pruning everything. It'd be nice to be able to just prune the op return and still have all the data itself, not the op returns. But that is probably a bigger lift and a longer term project that, I don't know, no one's looking into it or funding it right now. But I think that would be worth funding, because right now the rallying cry from core is like, just run a prune node. But then, you don't have a full node at that point, or archival node that has all the blockchain data, because by pruning it, you pruned everything.
And for those who are concerned about like the CSAM side of things, I think the argument there is like, well, I have to download it first before I prune it, right? So then still you have to, like, your computer needs to scan, or something, you have to gather the data and then have something that does the pruning, if I understand that. So
yeah, but there is no, like, I really don't want to get into it, but there are no pictures on the blockchain. So you can talk to AI and figure it out.
Additional software to try and piece things together.
And contiguous, not contiguous. I don't want to get into it, because the more I get into it, the more I'm going to get attacked. So I'll just say, like, my stance is I should not have to worry about your thing. Like, you can go do whatever you want. I'm not forking off with you guys.
Yeah, I mean, I'm glad to have people like you who have done the painstaking job of being like, I'm going to remain neutral and everyone's going to be pissed at me and I'm just going to eat it because, like, that's, I know it's not fun. So, I've kind of, it seems I've kind of been in the Knots BIP 110 camp more from an ideological perspective, but I try to hold on to these things loosely, primarily because I recognize that I'm in the point. I come to Bitcoin from more of a cultural Austrian economics sort of perspective, and not like, kind of what fiat currency, the problems of fiat currency and what it's doing to our world, and not from the technical perspective. And so because of that, I sort of have to trust me, bro, with what the developers tell me. I didn't like review the code myself for Knots, Core 30, whatever. And so I kind of have to be like, yeah. And I think in doing that, you have to look at what people are saying, what their values and morals are. I don't know. It's a difficult thing to navigate. I've tried to like maintain an open mind as I've tried to learn more and more about it.
Yeah. As I've said, I agree with the key principles that there should be efforts taken to reduce spam. And if there is something like ordinals, we should try to filter them out. But that's not a fight you take to the consensus level. You can do that in policy. The issue, I think, is they're trying to shortcut fighting for policy, because policy, you could just talk to the miners and convince them all to follow the policy. But that's hard to do. It's easier to just say, well, we're going to bring this to consensus level changes, right? And soft fork, hard fork doesn't matter. You're still affecting consensus rules at that point, and you're pushing something onto the network that you should not be pushing on the network, because that's not how it works, right? Like I think Satoshi had an alert key or something where he could send a message to everyone to upgrade, and that was removed because you don't want that. Actually, in a decentralized network, nobody should be saying, "Hey, upgrade your thing." It's not like, I don't know, pick your software. It's not like Spotify or your Claude Code, where you have to install the last update blindly, right? And
yeah, we don't want that.
Yeah, you don't want that. And you don't want to be forced to worry about something on some timeline that someone arbitrarily picked, right? Why in 28 days? Why not in 37 days? Why not in 378 days, right?
Well, yeah, I'm glad you're working on a third option, Samson. So thanks for doing that. And I'm sure there's a lot of other people who feel that way. I'm sure you get lots of the vitriol, but I'm sure there's a lot of people who are really appreciative of what you're doing that are just not on X posting all day, so.
Well, I get vitriol from all sides, core included. So
yeah,
and I want to add one thing too, like the core camp is not without fault here. It takes two hands to clap. A lot of developers, they said a lot of stupid things, and they gave the ammunition to the not side to use
I was
against
just pissed
them.
off at some of that stuff that, there's a few things that they're saying where it makes me want to be like, all right, well, whatever this guy's doing, I'm out. I want the other side, because this guy,
And you have to, you just have to understand people in general. Like, Bitcoin is money to people. People put their savings in money. If they feel you're mucking around with it, of course there are going to be emotions running hot. And a lot of those core white knights, you know who they are. They will just leap to defense and attack too, right? And it doesn't help the case in either way. So it's not like, the Knots people are at fault. Core side obviously did something, right? Even if they're technically right, you can be technically right and still incite a riot, which is what's going on right now. So my hope is that everyone stands down, because no one's really going anywhere, right? Everyone's going to be around, unless people decide to fork off and go with an altcoin. In 5-10 years, everyone's still going to be here, hopefully, but yeah, you can't really kick someone out of Bitcoin, right? You can't force someone away and make them leave. Even the altcoin projects have Bitcoin, and they're still holding their Bitcoin tightly.
Well, we'll leave that there. Yeah, well, it'll be interesting to see how it plays out and how everybody reacts. And yeah, hopefully it is just not that important. However it plays out, hopefully it's just not that big of a deal either way. Let's talk about Jan 3. How would you describe what you do to the company to somebody who is, or do for the company to somebody who is hearing about it? Like, what's your guys' mission?
The mission is to accelerate hyper-Bitcoinization. So everything we do is to get Bitcoin adoption worldwide as money. That's why we build the Aqua wallet, and that's why we engage governments. It might sound like a conflict, because we do get people criticizing us, like, why are you trying to help governments get Bitcoin? It should be the other way, separation of money and state. But the thing is, a government adopting Bitcoin is separating money and state. Like, it's not that you bankrupt a government, it's that they don't print money anymore, right? So it's a very subtle point that you have to really think about to understand. But getting them to use Bitcoin is a good thing for people, because governments are made up of people, and they determine a lot of the laws and regulations that can impact the ordinary people. So the more people in the government that understand the Bitcoin ethos, understand how Bitcoin works, is better for a nation state and for the people that live in that nation state. And Aqua is just it's a Bitcoin wallet. We're trying to bank the unbanked, onboard billions of new people into Bitcoin. So we focus on stable coins, because a lot of the global south, our biggest market is LATAM. They're using stable coins. So we give that to them, but we also give them Bitcoin. And we've since branched out a bit. We've built Agentic Aqua, which is MCP and CLI that lets any agent, like your Hermes OpenClaw agent, get their own Bitcoin wallet and do everything that you can do in Aqua. So we're doing a lot of stuff.
That's very interesting. There's got to be a point in time where these AI agents just start, they figure out ways to be insanely productive and just start siphoning off Bitcoin supply, taking supply out of circulation. Jeff Booth's commentary on that seems really interesting to me, where he's like, I think that he said something along the lines of like, I think that AI is basically going to become like electricity, where it's like a commodity, where it's like something that is, it's not like the AI bubble is going to pop. Basically, there's a bunch of money going into AI, and that at some point in time, it's like it's all going to be demonetized. A lot of that value is going to come out, and it's going to be more like the applications using AI rather than like the models themselves, because the models are replaced by something else every month. There's a new best model, and then that model becomes open source 2 months later. And then, it doesn't make sense to me like there'd be a lot of long-term value stored in something that has like no moat, like a moat of 30 days, somebody else makes something new. That's really interesting. You also said in the conversation, go ahead.
Sorry. I think the future is largely going to be agentic commerce. So you can see where it's going already, people spinning up their own agents. And the language models are just a part of it. It's the agent with context and tooling that really makes a difference. And as it becomes easier to create these agents, and as the agents get better, smarter, and more capable, then it's just going to be a lot of agents doing commerce with one another and using services and paying with Bitcoin. Because if you think of it from a macro level, agents are unbanked, right? They can't really get a credit card or debit card. So they have to use either Bitcoin or USDT or something, right? That is permissionless.
What are the most interesting developments you've seen at the nation state level with Jan 3?
Well, it hasn't been that interesting lately. So it's a direct parallel of the real world, a nation state and a head of state. Like if you imagine you're trying to orange pill your neighbor, it's just a random person that has maybe little understanding to no understanding of Bitcoin, and you need to try to get them to want to buy Bitcoin. It's just as challenging. So what we find is when Bitcoin price is low, like now, there's very little interest to talk with us. When it's up, then there's interest. So the meme where it's like the two tables.
I've heard that before.
Bitcoin at 63, whatever, 63, 64. There's no one lining up there. Bitcoin at 150 or 250,000, long line. So we're just kind of focusing on building right now, rather than engaging. Of course, we still do have some engagements here and there, but it's not. We're not aggressively going out to do meetings because we know it's not going to work, and it's also harder to get the meetings at this time.
You said recently that you think the bottom is in already, which is sort of a contrarian take. I feel like most people, I think, are expecting the cycles. Most people in my circles, at least, are expecting the cycles to just continue to play out because they've been on this like shockingly programmatic, they've played out the same way. The pattern has been very, very similar. We would see this bear market year around October, November is when we've typically seen pretty on schedule. We've seen bottoms in that time. Yet you recently said that you think the bottom's in already. Why do you think that that's the case?
First, I'm a permabull, so I'm always bullish on Bitcoin.
There we go.
Second, it doesn't make sense. Like, why would it follow perfectly the schedule? I mean, a lot of people expect it to, and I think it's a self-fulfilling bear market in that sense, where people are expecting the bottom in October, and they've sold, right? They're preparing. But, Bitcoin has a habit of doing what you least expect it will do, and I think people are going to be surprised very soon. But third, we're already at the 200-week moving average, and we've never broken below that for any significant amount of time. And that there's also the power law that's showing, time is not on your side. As time progresses, Bitcoin does tend to follow a power law model, so it should keep going up over time. So every month past now, I think, is moving into recovery territory, if not, straight vertical to the moon movements. But the other reason I think this time is different is because this time is different. If you look at the Bitcoin Treasury companies, if you look at the ETFs, they've largely added additional shock absorbers to the system. If they didn't exist, maybe we would have crashed much lower with this last crash, which, if you think about it, there was really no reason. Like, what was the trigger event? Nothing really blew up. We just kind of went down and then down again. And then, like, why are we here at 63? Nobody blew up. There's been no tragedy, no bankruptcy, nothing. So we're just sort
It
of...
seems to me to just be an over leverage pattern, right? Like, it looks to me where we get to a point every 4 years where everyone thinks Bitcoin's going up forever. Everybody levers up to the top, and then we just see that deleveraging. I mean, the day where we did hit that final bottom, there was just like a massive liquidation cascade that hit, crypto broadly.
Yeah, it's definitely possible. But if you look at it, like, the supply of Bitcoin is limited, and all of these entities have been buying nonstop. And it's not just them. There are many more entities buying Bitcoin than the publicly listed companies, right? But I see it as sort of shock absorption. Like, the ETFs, they will only go so low because people won't sell below their cost, because a lot of that money is long-term capital. And the Treasury companies are also shock absorbing too, right? And they're also holding still. So I see it as a very different structure these days than in the past, where you might have had Bitcoin slide 80% because nothing else existed to shock absorb. But we have a lot of shock absorption right now, which I think stops it. So we'll see. Like, nobody knows for sure, but I would honestly be very surprised if we went lower now, because that would break, the 200-week moving average standard, and it would probably push the power law out of its comfort zone.
I am kind of expecting us to go lower. Like, when you look back in 2022, I believe it was, we were under the 200-week moving average for a little while around this time in the cycle. But I also tell people, it's like, I'm not sitting capital on the side waiting for it. That's for sure. Like, I that would freak me out. I pay my bills and put my excess economic energy into Bitcoin. I don't overthink it, really. I do think we'll probably, when people ask me, like, where do I think the price is going? It's like, I think we probably go a little bit lower, just because it seems like we're in a simulation, and it just seems like it all goes according to this predetermined, not predetermined, but it just, I expect the pattern to repeat until I see it not repeat. But but also
you might see it not repeat this year.
Yeah, certainly. Yeah, I'm not setting aside any capital waiting, that's for sure. Especially now, right? You hit the 200-week moving average. It's like, don't overthink this, like, just get in there.
But the way I look at it is, those massive drops, it's usually because the players in the market are not ready to take action, right? Like, if you look at some of the past drops, it's just because of cascading liquidations and whatnot. But time is really not on your side if you're a Bitcoin bear. Because if you look at strategies as one example, they've largely repositioned. So they've taken a hit too, right? Like, their share price is down, their preferreds are down, but they've adjusted. So if you think of it as, the Bitcoin price is moving down is some attack. All the battleships have kind of reoriented, pulled back a little bit, and they're ready to defend against the next wave. So, Metaplanet, they've acquired Cybo, a securities firm, and that will allow them to do more things. Like, everyone is ramping up against the potential next onslaught of a dip. So everyone is in a good position now, and I think the market as well. Those big scary dips are usually because they're just cascading and there's nothing to catch it. But when you have the mechanisms in place, then it cannot dip that far. Those really only happen as a shock. Like, it's just within a day or something like that. But as time goes on, everyone repositions and prepares, and it makes the likelihood of dropping a lot lower, a lot less.
And, you just have the classic, the coins move from lower conviction hands to higher conviction hands throughout the bear market. So as we go lower, the probability that we go lower decreases.
Yeah, I view it as rotation of short-term capital out and long-term capital in. And that's really how money is made in not just Bitcoin, but every market, right? If you look at Warren Buffett, that's the game. The long-term capital wins, short-term capital panics and exits.
Yeah, I think we're going to be having an exciting, epoch, an exciting few years moving forward. You get through the slog, the bear market, and everything's boring, and everyone's fighting, and nobody's getting along. But we'll get back to the glory days. Not too long from here, I don't think.
I agree.
So I'm with you there. Yeah. This is kind of. I wonder if you've ever considered presenting an argument like this to the nation states when you're talking to them. So I'm going to string together a few ideas here, but you in another podcast were talking about how gold can be created in fusion reactors, essentially. And if Bitcoin monetizes energy by requiring energy pumped through computers, that's how Bitcoin is created. So you place this monetary premium on the energy. And when a commodity is monetized over time, it typically becomes cheap and abundant. You had like glass beads in Africa where that was the money that they used. And then as soon as that happens, you have people who figure out how to make new glass beads and not discover them naturally. And then, glass beads become cheap and abundant. And we've seen that take place on copper or whatever commodities. You'll see that take place when they're used in that way. So if this process continues to play out and the cost of energy drops closer to zero over time from solar and nuclear, we may end up in a position where the downstream implications of Bitcoin mining driving energy near zero makes the ability to create gold come around, right? Because you can create it in fusion reactors. So if you have a bunch of energy, you could create gold, and that the downstream implications of Bitcoin mining would destroy the scarcity that makes gold valuable. And it seems like that would be not too far out of a possibility for us as we have more and more creative ways of generating massive amounts of energy. And so I wonder if that's something that you've ever considered presenting to nation states who are relying increasingly on gold, right? They're decreasing their USD reserves and increasing their gold reserves. And if energy continues to drop, we'll come to a place where you can make gold and then it's not scarce. And then the monetary premium we attach to it could be destroyed quite rapidly, just like glass beads in Africa, when somebody figured out how to create those. Have you ever considered that? I'm just, I had that thought when I was listening to you talk about the gold fusion reactor thing.
You make sense in theory, and it is a compelling argument. Obviously, I agree, but I don't think it matters. Money is really, it is your ingrained beliefs. I think for gold to suffer some existential crisis, it has to just be, it probably won't happen. The way to cycle out of gold is time. The people that grew up with gold and believe in gold, not understanding Bitcoin, they will eventually, move on and retire and pass on. And eventually it'll be people that understand Bitcoin, understand technology, understand the dynamic we have between energy, information, and money with Bitcoin. And they just replace those people in those positions where they can make decisions to adopt Bitcoin. Because, technically, if you compared that finding where you could manufacture gold in a fusion reactor, that concern is just unexpected inflation, right? And that's the same concern with quantum computing, that, it will do something and, increase the supply somehow or bring old coins back into circulation. But if you look at the market, there's no reaction at all because they don't care. They've already decided that the older generation has already decided gold is safe. And nothing will convince them of anything counter to that point. So
until we figure out cheap alchemy, basically.
Yeah.
But who knows when that will be. Yeah.
Gold is far more centralized, right? It's really central banks buying at this point. And Bitcoin is bought by everyone. And because Bitcoin is bought by so many more people, sentiment is much more powerful because there's more sentiment to go around. But how much sentiment is there for gold when the decision is made by, I don't know, probably count them on your fingers and toes, that many people at the central banks making a decision. And they're not reading the news or anything. So they're kind of immune to sentiment because they're so disconnected from reality. So In theory, yes. In practice, we just wait and
Yeah.
let Bitcoin take over.
It seems probable that it would first come to pass where the consensus would just shift, right? Where the consensus would shift from using gold as money to using Bitcoin as money without any major variables changing. But I do wonder if like 12 years from now, it's like, oh, fusion reactors are much more popular, and now we're pumping out a bunch of gold that we're creating, or the asteroid minings, or whatever it is, whatever technological advancements that allow us to rapidly increase the supply of gold, and then we'd see some shifts take place at that point in time.
Yeah. But if you think about it a bit more, it's also a demographics issue, right? The central banks, who is their customer? It is the people. They have to provide stability to the people of that nation state. And demographics are all skewing to the older side right now. So they need to have the valuable thing that the older people think is valuable.
Mm-hmm.
So it's a catch-22, really.
Yeah, that's interesting, because everybody running the governments is 70. They're not, and there's the percentage of 70-year-olds that are Bitcoiners is pretty low. It's like RFK and four other guys or something. Yeah.
But those 70-year-olds are catering to the bulk of the population, which is the aging population.
Yeah, that's interesting. Yeah, just 15 years passing would change a lot. It seems. They say technology progresses at every one death at a time or whatever. Science progresses, something like that. Couple quick. You got time for maybe one or two more quick questions? How you looking?
Maybe one more.
One more. Yes, sir. All right. I'll squip my. I had a couple questions about the Great Pepe War meme that you reposted a while back, but maybe we'll talk about that another day. You had on Aqua Wallet, you guys provide stable coins, which I hate the term stable coin because it's not stable, but whatever. I'll let it go for now. You support Liquid and Lightning, and I'm curious about why you decided to support both Liquid and Lightning, and how. I understand how Lightning operates at a technical level more, but maybe if you could tell me how both of those operate, and then why you guys made the decision to support both of those.
Right. So Lightning has evolved, I think, from the initial design, where you would run your own Lightning node and that's it. Like the substrate and the interoperability, it would be one and the same. But right now, Lightning is more of just an interop layer connecting many different substrates. So base layers or base systems. If you look at Wallet of Satoshi as one of the first Lightning wallets, it's like connecting a database substrate to the Lightning network, right? And then you have other things like federated mints. You have eCash, you have Arc, you have Spark, and you have Liquid. So Liquid is just another substrate, and I think it's the best substrate of all the ones available. It's the most battle-tested, longest running, with the best properties like privacy, confidential transactions, and reliability. So yeah, basically the challenge is, what is the substrate? Because if you remember, there was a Moon wallet back in the day, and it was very popular because they were doing submarine swaps to Lightning from a main chain. But as soon as main chain fees went up, then that substrate, the main chain substrate, stopped working.
You lost me there a tiny bit. Submarine swaps to main chain. What does that mean?
So basically, you're swapping an on-chain transaction to get Lightning capacity.
Okay. Yeah.
So we're doing the same thing, but on Liquid. So we're immune to fee spikes on main chain. But Liquid, Aqua is a Liquid wallet at the base. So the base of everything is Bitcoin and Liquid. And Lightning transactions in Aqua are just swaps out of Liquid into a Lightning transaction atomically. And USDT is natively issued on Liquid as well. So when we interface with other
I didn't know that.
USDT blockchains, we're swapping as well. Like you can pay in Liquid USDT and the receiver will get Tron USDT or Polygon USDT or all the different USDTs. So at the base, it's a Liquid wallet, and then everything is a swap out from that Liquid wallet.
Okay. So basically you're saying so these are a bunch of different applications. I'm going to try to reduce it to average Joe terms, because I almost had to ask you to speak slower for me so I could keep up. But so, essentially these are alternative versions where you have your on-chain Bitcoin, you'll take that on-chain Bitcoin, pull it onto this network, Lightning Network, or let's say Liquid Network. You're going to operate. You have then the trade-off there is you kind of need to trust at this level a little bit whoever you're operating in that ecosystem with, so that you can have that rapid transactability of that Bitcoin. And then at some point in time, if you want, you could take that liquid Bitcoin and pull it back off onto the on-chain where you have no requirement of trust of that person, essentially, or entity, or whatever it is.
So it's like a middle layer, layer 2, whatever you want to call it, that you want to use to interface with Lightning. And you can do that to aggregate small UTXOs, like Ben BTC Sessions. He likes to take payments in Liquid, and then when he gets a big enough Liquid UTXO, he'll swap out to main chain. But there's, everyone's promoting their own substrate, and they're all different trade-offs. And I think Liquid offers the best set of trade-offs, because a lot of other things are just a server or 3 servers. And, if they go offline, yeah, you can exit, but does it make sense economically to exit? And does the economic use warrant that level of stringent trust minimization? Because, a lot of people that are using Aqua are just paying small bills, like, $10, $20, $30. Who knows? But it's not like it's the end of the world if Liquid went down, which it won't. But you should be, never keeping that much money in a hot wallet anyway. So amongst all of these wallets, they're all hot wallets. So you should not be keeping a ton of money in your hot wallet, no matter what. So it's really a moot discussion. The key here is really who offers the best user experience. And yeah, we think Aqua Liquid offers the best of every option out there. We're bullish.
Awesome. Heck yeah. Well, I think it's a great thing. I think you guys are, I like the design of the product. I just downloaded it recently, and since I knew we were going to chat, and I was just poking around. I like how it feels, and I think that that's super important. That's something that a lot of the Bitcoin developer crowd doesn't get very well. Is like, it needs to feel good, it needs to look beautiful and that sort of thing. And so I could see those design choices in there. And I think that it's, banking the unbanked is, I've lived in countries for periods of time where people there, all they have is access. They don't really understand all the big, crazy geopolitics of what's going on in the world. And they just have their paper currency that they transact with and stick away in a box. And they don't have bank accounts, and they don't realize that they're being stolen from year after year. And so to get people into something where they have optionality, where it's like, okay, here you can use your stable coins, you can use your US dollars, stable coins. You can use, you have the optionality for Bitcoin there and everything. I think, for the people who have no access to that, it's such a massive step just in giving them the opportunity to play on the same playing field that people in developed countries have. And that will, I really believe that will be a rising tide that is good for everybody. All the boats will be lifted as more and more people get to play a more fair game. So I think that's great. I think what you're doing, go ahead.
I fully agree. Well said.
Yeah. Thanks. I think what you're doing at Jan 3 is great too, because there's that, there's a Trojan horse element of that. I for a while, I mentioned at the beginning of the conversation that, I was doing some political consulting work, and I had that conviction of like, wait, I'm talking to all these people at this high level about Bitcoin, and I want to, it should be plebs first, but also too, I can see what you're saying of like, this is how we increase the adoption. And there's certainly a Trojan horse element to that, and getting them to stop printing money would be lovely. So, I think you're on the right track, man. Thanks for the work you do. It's great to have this chat. How can people support you? How can they connect with you? Where can they find you? Anything you want to plug?
Sure. We're on X. Jan3com is our X handle, and then Aqua is Aqua Bitcoin. And my handle is Excellion, EXCELLION. And I'm mostly on X over other platforms.
Awesome. Well, thank you, sir. It was great chatting. Hopefully we'll talk again
Jake.
soon.
Great chat.
I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices. You're seeing it in the prices of the preferreds. in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. These are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so, okay, I'm a Morgan Stanley advisor. We just launched our own Bitcoin ETF. There's going to be a wave of slow adoption, but I think you're going to really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated. And it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, we are going to be talking about good old Strive because I wanted to make a video today that wasn't some grand philosophical thesis. I wanted to make a video about getting rich, kids. Now, none of this is financial advice. This is financial entertainment. I am not telling you to go out and buy Strive shares, even though I will be doing that myself. I look back on this last year of my investing journey, and what have I found? I have found that Bitcoin, super volatile, and Bitcoin Treasury companies are super volatile entities that are not for everybody. Not everybody can handle Bitcoin volatility, let alone Bitcoin Treasury company volatility, because the thesis does require more work. Bitcoin is kind of the prerequisite, and then you got to understand more stuff on top of that, why you would buy stock in a company who's just buying Bitcoin. That takes additional work. But I have done the work. You see, I continue to go back to the drawing board and look at the long-term math, the value proposition on a long time horizon of a company like Strive, and I continue to get blown away by the risk proposition here, the risk reward calculation that is presented to me. I continually love this trade. Lately this year, I don't know, I've usually been buying Bitcoin. Sometimes when I get cash, I get analysis paralysis where I'm like, I like Metaplanet, I like Strive, I like Strategy. Which one do I buy? And sometimes I just end up buying Bitcoin. Sometimes I literally will split a chunk of cash into 3 of them and then buy an even third with a chunk of cash that I have. But regardless, I really think that Strive has a very interesting value proposition, and we are going to be talking about that today. Because tomorrow, I think I'm going to buy more ASST shares based on the growth potential that I see in this stock. Today, we're also going to be doing some stock price modeling. This is all off the cuff, nothing planned. So hopefully you can kind of see how my mind works as I work through this myself. If you guys could do me a huge favor, hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Before we get into it, I really want to take a moment to thank my sponsor, The Bitcoin Way. These guys are my friends that will help you become a sovereign Bitcoiner because the real revolution is Bitcoin in self-custody. Bitcoin is the ultimate form of savings. If you're not custodying your own Bitcoin, what are you doing? Get them off the exchanges. They will teach you to be your own bank, eliminate counterparty risk, become a sovereign Bitcoiner. You can scan the QR code right here, or you can go to thebitcoinway.com/Adam to get started and schedule a free introductory call right now. I'm not asking you, I'm telling you, click the link below. The Bitcoin Way is awesome. So obviously the question continues to be with most market participants, Adam, why would you buy a Bitcoin treasury company other than Bitcoin? I don't want to explain myself too much. Sometimes I do think I like to take additional risk with my capital. Bitcoin is savings. I like to invest some of my risk capital to outperform Bitcoin. Yes, price the stock in Bitcoin and then outperform Bitcoin to hopefully get more Bitcoin by the end of this journey. This does not require any multiple expansion over long time horizons, not in the slightest. And I think a lot of people misunderstand my content or what I'm telling people. My dearest listeners, have I ever been a chart squiggling trading signal to you? Guys, you gotta get in now because it's gonna go up. No, I'm not a trader. I am a long-term value investor. My projections run months and years into the future. I'm talking sometimes 5, 10, 15, 20 years. I like to be positioned for long-term convexity over long time horizons where I see advantages in the market with the pricings of these equities, especially because I don't think we're in an efficient market. The world's not even orange pilled yet, not even close. So anyway, as it relates to the value proposition, I see alpha in buying these things before they are even close to consensus. And that is how money is made, because Bitcoin isn't even consensus yet. And you can buy an amplified expression of that. That means you can make more money. You can buy more Bitcoin, provided management does what they have to do. They execute the plan. Bitcoin continues to go up and everything is fine and dandy. Obviously, you are accepting additional risk, but I think it can be worth it. And today you're going to see why. Now, when it comes to Strive, what you must understand is that they are not just buying Bitcoin. They are amplifying your Bitcoin exposure. And that, my friends, is a beautiful thing because they're not doing it with debt. They have zero debt on the balance sheet. They have 19,921 Bitcoin that you can see right there. That is at least until tomorrow, when they probably announce another buy. Over the last year, they are buying almost 45 Bitcoin per day, and the share price is $11.49 as of the Friday close, and guess what? $1.3 billion of Bitcoin. So there it is in one single snapshot view there. You can see that there is zero debt outstanding. The Bitcoin NAV just under that 1.3 billion. So you might be asking, how are they amplifying their Bitcoin exposure? They are issuing preferred stock to buy Bitcoin. They issue SATA shares, and then they take that capital, they go off and buy Bitcoin. What is SATA? It's a preferred stock that pays you a 13% dividend, and guess what? The dividend is paid daily. So over the course of a year, provided that the variable rate dividend stays at 13%, you can make 13% per year, but you are paid daily. The daily dividends hit your account every single business day, so that's super cool. So basically, they have $1.29 billion of Bitcoin, but they have more than half of that acquired by issuing preferred stock. And you can see that here, they have just under $783 million of outstanding SATA. So basically, when you do the math, when Bitcoin goes up, that preferred outstanding stays at that $782.95 million, and then the residual that's left over for you after those dividends are paid, the residual expands, and that is how you get outperformance over Bitcoin. So let's break down the math because I'm not being emotional today. I know a lot of Bitcoiners like to be these purity spiraling hooligans, but I don't care. I want to get rich. That's right. I'm a Bitcoin capitalist, kids. I'm here to divide and conquer. I'm not here to take part in your libertarian ANCAP LARP. All right, so let's load up the terminal and get to the number crunching. We are now going to import Strive here. Here is their balance sheet, all fine and dandy, ready for us to import. Let's go ahead and do that, and this should be fun. So let's start going through our assumptions for what we think that Bitcoin is gonna do, because this could be fun. Now, this is the cool part. Because I'm holding the stock for a long period of time, because I acknowledge that with volatility, there will be additional outperformance because that's how amplification is just going to work here. Whether Bitcoin goes to 200K in 5 years or 500K in 5 years, I outperform Bitcoin by holding ASST shares, and I don't need a multiple expansion to outperform Bitcoin, and the numbers get pretty crazy here, which is why I absolutely love this company. I love the management team. They're based. So we've loaded it up here. How fun. We have $11.49 is our stock price. You know, they're paying those 13% dividends. You already know what the deal is. I don't got to go over that. But what we do have to put in is, you know, maybe an assumption. How long do you guys want to hold the shares? For me, let's just put in 4 years. 4 years sounds fun because, I can probably hold them until July of 2030. And we're going to assume that Bitcoin goes linearly to $500,000. Will it happen linearly? Absolutely not. Bitcoin is volatile, but I can't predict the volatility of the move on the way there. But I do think it's going to go up over long periods of time. So we're going to say it's a linear move. The math still works out. We're putting in 500K. Now, what is another assumption? The assumption would be how much they can issue in preferred stock, because as Bitcoin goes up and to the right, unfortunately, to keep the same level of amplification, you have to hope that there's more demand for SATA shares so you can continue to issue those into the market, sell those shares to get that capital to keep your exposure amplified. And unfortunately for me, this number is totally unknowable. Just like how I don't know exactly the path that Bitcoin is going to take over the next 4 years, I also don't know how much SATA they're going to issue. We can make a reasonable estimate to be fun. In my opinion, what's reasonable? If you don't think it's reasonable, you can leave a comment and let me know. But SATA is only 8 months old. I think it IPO'd back in November. So basically we have 8 months since then. What you could do to be conservative is take the amount outstanding that they have, the amount that they have sold in year one, divide it by 12 and not 8 months. And you know what I get? I get $65 million a month. So this assumption would be assuming that they don't speed up the pace after year one when digital credit is still in its infancy. So to me, that's pretty reasonable. It's assuming a slowdown. So let's just go ahead and leave a $65 million per month on average issued. Let's just assume that the digital credit model works, but it's even slower than their year one pace. Now I'm going to go ahead and assume that they sell 0 common stock to ever buy Bitcoin. Now it would be rational for them to do this if their stock was trading at a premium, and it is trading at a premium today, about a 35 or 40% premium or so. We're going to see that shortly. But regardless, I'm going to be conservative, assume that they sell 0 of the common stock to buy Bitcoin. So this is another conservative bearish input. The point of this video is I really want to dial into how much of the outperformance of the stock is just from the embedded amplification and the Bitcoin move. So if there's additional levers like selling common equity at a premium, we're just going to take that out of the equation. And in fact, not only are we going to do that, we are going to assume that the dividends are funded by issuing those common shares. So they are issuing ASST shares, taking that capital to pay the SATA dividends. So yeah, you're being diluted. Oh no, so scary. But regardless, you're probably going to like it as we dig deeper into the math. Now, once you've figured out all of those other inputs, the last piece of the puzzle is the valuation. What type of valuation does the market then assign that residual for you, the common shareholder, or the enterprise, or the market cap value of the company? You can calculate the MNAV in a variety of ways. It's no surprising to anybody that I like to look at the MNAV, the true MNAV of the residual that's left over for the common shareholders. That is a 1.36 today. And you know what? We're just going to go ahead and assume that when Bitcoin goes up that much, the MNAV stays the exact same as it is today. So we're going to put in that exact same number, and the multiple path is just going to be flat right there. So we're going to go ahead and see what this does when Bitcoin goes to $500,000 over the next 4 years. The ending implied price at that MNAV, if they issue that many shares and Bitcoin goes to that price, sorry, it's not my opinion, kids. It's literally just a math calculation, and I went ahead and disclosed every single input. There you go. It's a $189.83 implied stock price at that MNAV valuation. Would I take that? Absolutely, because the stock is a little over $11 today. So there you go. That is a 16.52x stock multiple. I absolutely love that return. They are amplifying the Bitcoin move with the balance sheet. That is a beautiful thing. This is the stock return broken down with a simple multiplication problem that lets you know what gains you get. The stock multiple equals the move in the Bitcoin, then the move in the Bitcoin exposure, your residual increasing in value because the Bitcoin price value, it's going up. So Bitcoin going up makes your common equity Bitcoin exposure also go up. One thing happens And then guess what? One variable is turning 2 gears because of amplification. That's beautiful. That's the engine actually working as designed. And then on top of that, you could multiply it by a move in the MNAV, the move in the premium, but we kept that flat. And because of the embedded amplification, Bitcoin is a 7.73x, but the stock does a 6.52x. So it more than doubles Bitcoin's performance just off this scenario. With the MNAV staying flat, we don't even need the MNAV to go up to outperform Bitcoin. We more than double Bitcoin with just the same MNAV today. Now, do you think the MNAV will stay at 1.36 whatever when Bitcoin goes to $500,000? I think the MNAV will likely expand when we see violent moves in Bitcoin's volatility to the upside. But regardless, who knows what the actual MNAV will be? I'm not pretending to know. I'm just showing the outputs of the calculations. But you know what? Let's go ahead and talk about the premium risk, because right now you are paying a premium over the residual Bitcoin. That is literally true. That's the math right there. You can see you are paying that 36% premium. And so many people ask the question, why would I pay the premium? Well, I just explained it. You're paying the premium for access to the amplification. But of course, the premium could go down over time. It also could go up. You have to underwrite your own assumptions about what will happen. You have to think about your own holding period. You have to think about when you're entering. Do you think Bitcoin is cheap or expensive right now? You probably wouldn't want to buy a heavily amplified Bitcoin Treasury company if Bitcoin is super expensive. But let's just assume that the MNAV does go down to 1, even though Bitcoin goes to $500,000. Let's make that assumption and let's see what it does to the math. And this is something that the bears absolutely hate, because they act as if the only reason to buy a Bitcoin Treasury company is hope that the MNAV multiple expands and then you can sell at the top. And then everybody buys from you and then you get out. As if that's somehow different than you're selling Bitcoin, but it's not. You're selling to a willing buyer. There's two sides to every trade, but whatever. Even if the MNAV goes down to 1 at the end, remember, I went ahead and said we're going to hold that ending MNAV at 1 right here. The premium collapses. What do you think happens? You still outperform Bitcoin. You get an 11.4x stock multiple, because you get the move in the Bitcoin price, you get the move from the amplification, and then because the move in the MNAV, you would multiply that by something that's below 1, the 0.73, and then there you go. That is outperformance over Bitcoin by a pretty sizable margin there, 11.4x versus 7.73. If we move the Bitcoin price from $500,000 to, let's say, 300K, that situation would still outperform Bitcoin, even though the premium collapsed down to 1. And that would imply an ending stock price of $72.06 here, with the MNAV going to 1 and the Bitcoin price going to 300K. So yeah, this is just proving that you don't even need premium expansion to outperform Bitcoin. That is a myth from people who cannot do math. And in addition to that, you also could expect a premium collapse below 1 and you would still outperform Bitcoin. This is just the math. You can calculate your own break-even MNAV if you think, I want to be able to sell 3 years into the future to hopefully capitalize on a Bitcoin bull run, buy my family lake house, whatever your financial goal is. Maybe you want to buy a crack house. Maybe you want to start a meth lab. We all have different goals here. I'm not going to judge, everybody's different. But right here, I've went ahead and calculated a break-even MNAV because I went ahead and put in a 0.81. And still, let's go back to that return decomposition. What are you seeing here, folks? You are seeing still outperforming Bitcoin, even though the MNAV collapsed from 1.36 to 0.81. Right there, 4.69x in the stock, 4.64x in Bitcoin. So after assuming the premium collapse risk, you still get the amplification, and that leads to outperformance. So let's do a more bullish scenario, shall we? Let's say Bitcoin is at 600K in 5 years. It's the year 2031. We're in the summer. We're going to say Bitcoin goes to 600K over 5 years. And let's just say digital credit really takes off and they actually increase their rate of preferred issuance. Let's bump up that $65 million per month to 80, because, I think that still would be close to the year 1 pace. Because remember, we adjusted that number for 12 months, a full year, but it IPO'd in November. So let's just go ahead and put 90. Let's just do 90. And let's just say that the MNAV expands linearly over time. Now, let's also do something interesting. Let's assume that they sell some common shares at a premium too. How much that should be, I have no no idea. Let's just do $40 million a month. You know, we'll see what that gives us. That would make ASST go from $11.49 today to $283.01 per share. Your current residual exposure is right here, just over 13,000 sats per share. This scenario would amplify that to 31,446 sats per share of common equity Bitcoin exposure. That is pretty rad. Your 1x MNAV price would be $188.67. And then assuming the MNAV moves linearly from a 1.5 to a 2, this is where it starts to get really fun. You would have $393.50 per share for a share of ASST when it's $11.49 today. Now let's go back to a 1.5 MNAV and let's go ahead and assume that Bitcoin hits $1 million in 8 years. The MNAV has moved down to a 1.5 again. We're holding that flat, but we're going to project out 8 years and $1 million Bitcoin. Super fun stuff. And also, this is assuming that that dividend rate never gets lowered. They pay 13% cost of capital for 8 straight years. So is that realistic? Probably not. I think it'll probably go down, but hey, another bearish input. That is an ending implied stock price of $491.63. Pretty bullish stuff there. The ending 1x MNAV price is $327.76, and this would be close to a 43x over a 15.4x for Bitcoin. So great outperformance over Bitcoin on the way to $1 million Bitcoin. That would be the graph of your common equity Bitcoin exposure going up and to the right over time. You know, that would be pretty rad because it's amplified Bitcoin. Now, what's interesting is that they would have to raise a lot more SATA to keep it amplified at the level that it's at today. That is the senior claims as the percentage of the balance sheet, and that will drop pretty considerably on a violent Bitcoin move upward to $1 million. So, you know, clearly in order for them to really keep Bitcoin amplified, they got to keep issuing SATA at a higher degree than that $90 million a month that I just put in. So there is your full table, that linear move of Bitcoin going up and to the right over time, and essentially the implied stock price just marching on upward month after month after month. Is it going to move in a linear basis like this? Absolutely not. No, it isn't. The MNAV is not going to go up linearly, nor will the stock price, but I don't know what the volatility is going to look like, so I always like to do linear projections. Now let's just do a fun little bull case, because we're going to assume that Bitcoin goes to $1.3 million over 10 years. Let's see where that takes us. I just put the number in. $1.3 million over 10 years. And let's assume that they issue $100 million of SATA per month on the way there. Can they do that? I don't know. That'd be rad if they could. We'll see. That seems super bullish, but that is a lot of money raised. What is the implied stock price at that point? It is $665 right there at just a 1.5x MNAV. Remember, this is not me saying this will happen. I'm just showing you the math blatantly in public here. Not financial advice, financial entertainment. But this is where it's interesting. Even with this bullish scenario, look at actually what it does to the total ending Bitcoin. This sounds crazy, sounds bullish. This only gets them to 61,792 Bitcoin, which is wild. The senior claims will shrink over time. Your common equity Bitcoin goes up, but you only end up with 61,792. And this just shows you that, hey, we're in a digital gold rush. The management team will probably sell more common stock at a premium to buy more Bitcoin to juice those returns long term. So this is just showing you that, you know, this math seems super crazy, but look how much Bitcoin strategy can buy once they got to scale. Who knows what can happen with Strive. Anyway, that is the video for today. Pretty bearish results, you know, with some bearish inputs in my opinion. We did have some fun at the end there, but hopefully you can now understand the value proposition, why somebody might buy a treasury company over Bitcoin. Because the amplification is sitting there, it's already embedded. I don't really need them to issue that much more SATA, and I don't need strategy to issue a lot more STRC because the math works with the amplification that's embedded right now. Anyway, that's the video for today, guys. If you could do me a favor, like the video, subscribe to the channel if you have not. I will see you later, my dearest little goblin rat children. Class dismissed. And you know how excited I get about Bitcoin treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999 where the world was going to implode. Technology marches forward and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way, way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin it will adapt to it, already is. The discussions are great around it. And we're going to see many, many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. People continually ask me, Adam, why would I buy MSTR over Bitcoin? A lot of people do not understand the magnitude of what strategy is building, and this is a video about the grand vision going forward. People continually think that Michael Saylor is trying to run the world's largest Bitcoin ETF with a software company stapled onto the side. But that is not true. He is attempting something vastly more ambitious. Strategy is really annexing the monetary base of the next civilization. And this is misunderstood by so many people, whether it's those crypto bro traders on Bitcoin X claiming that Saylor is being a bad Bitcoin trader. There are some people who understand what the grand master plan is, and there are some people who do not get it at all. You got to understand that Bitcoin is cyber Manhattan. It is finite digital property. And MSTR is the acquisition vehicle. You can look at Bitcoin as territory, and the endgame is a new hierarchy of global capital with strategy at the center of it. MSTR has been a great acquisition vehicle for finite, scarce digital capital in Bitcoin, but now we have the preferred securities. They are this embedded financial machinery that is being welded onto the entire apparatus here. The ultimate objective is to construct an entire hierarchy of credit, income, liquidity on top of this scarce asset, this scarce reserve asset that strategy cannot manufacture, okay? And this is what is important, because when you look throughout history, every single previous financial empire eventually acquired the ability, either directly or through the government, to just create more units of the thing supporting its liabilities. And then when the arithmetic becomes uncomfortable, the rulers, they always change the arithmetic in society. This happens time and time again. You can look to countless examples. Coins get clipped, paper claims get multiplied, convertibility disappears. You can't redeem your paper currency for gold. That happened in the United States. Central banks just purchase the debt and it just gets easy for everybody. And then they just kick the can further down the road with monetary repression of the country's citizens. This is a tale as old as time at this point. But Bitcoin obviously refuses to participate in this ritual, and Saylor, I feel like, understands the game better than anybody else. He understands that the free market is a PvP game. Hey, when you want to accumulate the most of the best asset and you are in first place, that means you're winning the actual game here. So the market participants are participating in this digital gold rush of acquiring Bitcoin. And you know, if you're going to acquire the territory honestly, if you're going to win the game and play it better than anybody else, that might be a reason to invest. That is my entire thesis as to why I am an MSTR shareholder. So this is the grand plan. We're going to get into more detail. Essentially, it's to build a monetary institution on a foundation that any institution cannot corrupt. MSTR is one financial product out of many, but it is the first vehicle that has been capable of making the crossing, monetizing the bridge between the old fiat system and the new Bitcoinized future. We are pilgrims on the orange Mayflower, kids. We are being transported into the age of the next monetary architecture, and Saylor is steering the ship. You guys are going to love this video. It's super bullish on MSTR, and it will actually explain the strategy, the end game, the grand vision of what is going to happen and why this will be the most valuable company in the entire world. And you guys know how much I love MSTR. I love the institutional adoption wave of Bitcoin because I want the network to be monetized and I want to get rich. But if you really must understand the true revolution, it's Bitcoin in self-custody, and my friends at the Bitcoin Way will help you be your own bank. Be a sovereign Bitcoiner running your own node with the best open source tools, and they will help you do it with a free introductory call. You can go to thebitcoinway.com/Adam. You can scan that QR code. The link is in the description. Participate in the real revolution of the first ever monetary neutral free market of money, and that is Bitcoin, my friends. So please click the link below, get started today, become a sovereign Bitcoiner, and take control of your sovereignty. So let us count the sacred tables of arithmetic, because when you break down the numbers, things start to get a little crazy when you put it into perspective of what this operation has done in a little over half of a decade. Since August 10th, 2020, the Bitcoin miners have produced 1.595 million Bitcoin. That's simple, but during the same period, Strategy has accumulated 843,775 Bitcoin. That is 4.21% of the circulating supply. I am not claiming that Strategy purchased these Bitcoin directly from the miners as they became available. This is a supply equivalent comparison here. 52.87% of all miner issuance. Yes, they acquired the equivalent of 52.87% of everything the global mining network produced for nearly 6 years. That is one of every 1.89 Bitcoin mined. One corporation now holds 4.21% of the circulating supply of the hardest monetary asset humanity has ever created. You need to read those numbers again very slowly if you do not understand the magnitude of what is happening here. Thousands of mining facilities, just across multiple continents, they consume power across these multiple continents. Billions of dollars of specialized equipment screaming inside of warehouses. Engineers negotiating with energy grids. The mining pools coordinating global hash power. The protocol executing the largest decentralized monetary issuance program in human history. And one man with a suit stood at the other side of the conveyor belt with a corporate treasury and has collected the equivalent of more than half of that output. And the bears describe this as a Bitcoin ETF with extra risk? Really? Do you not understand the accumulation? It would be like if these people transported back in time to 1803 and they witnessed the Louisiana Purchase and they thought that it was Thomas Jefferson doing a real estate flip that should be on HGTV. You got to understand that it's not trading here. Saylor is not placing the chips on red. He's not walking into a casino and placing a bet on a roulette wheel. He is absorbing monetary geography. And the market just remains obsessed with the next week, the next day, the next quarter. Will MSTR issue shares? Will the premium expand? Will Bitcoin visit the realized price of $53,000? Is there going to be a death spiral? Right now there's some 43-year-old balding guy named Brent. He's on his trading view and he's drawing descending wedge patterns on an MSTR chart, while Strategy is accumulating a percentage of absolute scarcity that was previously reserved for religious endowments. Strategy has now acquired 843,775 of the only units that can never be replenished, okay? This is not corporate treasury management anymore. This is monetary annexation that is being performed through SEC filings. So you might say, Adam, that's cool. Those are some fun numbers, but what is the big deal? Let me tell you, you need to understand that civilizations are built on substrates. What do I mean by that? Well, we can look to Rockefeller. What did he understand better than anybody? He understood that industrial civilization would run on oil. Andrew Carnegie understood the physical skeleton of the new world would be steel. Railroads accumulated rights of way because controlling the corridor meant controlling the movement of goods, people, and capital. And this is how civilizations are constructed. There is a base layer. Why did empires hoard gold for thousands upon thousands of years? Because military power and commercial power eventually settled their accounts in the same scarce metal. So when you look to how society is constructed, you need to understand that the intelligent actor out there, they don't wait until everybody agrees that a resource is indispensable. They accumulate it while everybody else thinks that it's still optional. Saylor is seeing the end game decades before everybody else, literally decades, and that is why you have to have a very long time horizon view. He sees Bitcoin becoming the world's capital infrastructure before all of the pension funds and insurance companies and sovereign wealth funds and the other corporations, before they fully understand what is happening. As oil powered industrial civilization by converting that stored chemical energy into useful work, the same thing is happening Bitcoin, but instead it's going to collateralize the digital civilization by providing a scarce, globally transferable asset against which financial claims can be measured and finally settled. But still, Bitcoin possesses a characteristic that oil never had. More territory cannot be discovered with Bitcoin. There is no Saudi Arabia of undiscovered Bitcoin beneath some orange desert. Exxon cannot announce that satellite imagery revealed another 14 million Bitcoin under French Guinea. Congress cannot create a strategic Bitcoin manufacturing administration and appoint a bunch of men named Craig who print every email before reading it. The entire geography is known of Bitcoin, 21 million units forever. This is the continent. These are the borders. No expedition is returning with future Bitcoin, okay? You can't make more of it. Which might mean that accumulation of Bitcoin has a terminal character to it. Every single Bitcoin strategy acquires permanently changes the distribution of an absolutely scarce asset. Most market participants, they absorb this information after being psychologically lobotomized by 70 years of financial television. They can understand a quarterly earnings beat, and they can also grasp the concept of a price target and an earnings call, earnings per share. They can understand a man who looks like a medicated goat farmer, like Jim Cramer, yelling oversold while standing next to a touchscreen on CNBC, but they struggle to understand permanent acquisition. Saylor is drawing property lines around digital scarcity before the rest of civilization recognizes that it is standing on monetary land. And by the time consensus arrives, guess what? The surveyors are going to be finished. And it's beautiful. Bitcoin solved the base layer problem. Saylor understood this before anybody. And honestly, I'm surprised it took anybody 11 years before they got it. Digital scarcity, final settlement, a monetary asset that can move across the planet without permission from anybody. But unfortunately, a reserve asset alone is not a complete financial system, okay? And this is where the philosophical disagreement in the Bitcoin community starts. Because it's very simple. Some people like Bitcoin as peer-to-peer electronic digital cash, just what the white paper tells you, which is all fine and dandy. It serves that purpose, and that is a beautiful thing. I love being able to transmit value to somebody else across the globe at the drop of a hat with no permission from anybody. That is a beautiful thing. But Bitcoin is a free market. It is a neutral technology. Satoshi disappeared, and guess what? He left humanity to absorb this beautiful creation, and we are finding other use cases. What is it? Well, civilization itself, it has required for a very long time things like income, credit, collateral, maturity, transformation, duration, working capital, and instruments that hold relatively stable value over short periods. Now, obviously, Bitcoin is incredible, but it's very hard, in my humble opinion, to make the case that it can be sold to everybody, especially after it just nuked 50% in a world that is still, unfortunately, fiat denominated. And I also think that a lot of the Bitcoin community, they have a subjective political preference about the end state of Bitcoin, what it must mean for me for Bitcoin to win. But unfortunately, the Bitcoin white paper, it is not a political document. It is literally just describing final settlement of peer-to-peer electronic cash, no counterparties involved. That serves a beautiful purpose, but it's not a political manifesto. It's a technological document. And the reality is that humanity is always going to follow rational incentives, just like they did with the next best thing, which is gold. You can look throughout history. Gold existed for thousands of years, but economic activity eventually developed banknotes, deposits, bills, bonds, loans, and the credit markets above gold. So some people think that Bitcoin's win condition is that the government just disappears one day because we can live in an ANCAP society where we're transacting together. Investment doesn't exist anymore. Equities don't exist. People don't want to return on their capital, so they don't invest it. It's total nonsense. That will never happen. And this is why I'm more of a pragmatic Bitcoiner, because I believe that Bitcoin can serve as the foundation base layer. And not only that, but the best ever base layer that humanity has ever seen. Bitcoin has arrived with this magnificent bedrock and almost no architecture around it. And Saylor's grand master plan is to build that upward. Credit instruments will always exist with humanity. That will never, ever go away because people want to distribute risk across time and across balance sheets. This is something that will always occur. We're never going to live in some anarcho-capitalist utopia where everybody abides by the non-aggression principle. Unfortunately, for a lot of the libertarian Bitcoiners, I'm sorry, this will never ever happen. A much more realistic win condition for Bitcoin is we can still get rid of fiat money 100% if you think that is your win condition, but your subjective relativistic political preference of governments being obsolete, that will never ever happen. So there's a difference between fiat money and government money. We've only had fiat for 50 years. Sorry, but government itself is just an abstraction. It's a word that we use for a group of people that enforce rules upon society with coercion and violence. The libertarians have that correct, but unfortunately, that's never going to go away because humans will always have a different definition of what constitutes aggression. So people will never agree on abiding by a non-aggression principle. So the libertarians in the Bitcoiner movement, unfortunately, they are too idealistic. This is the path forward. It's going to happen. You already see it. That's why you see so many people kicking and screaming right now, because they think that their precious libertarian stateless money, nobody will ever touch it. But unfortunately, governments are an abstraction. They are made up of people, and unfortunately, people follow rational incentives. Therefore, people in governments will also want the most of the best asset. We already see that happening right now with the strategic Bitcoin reserve, legislation around the world. What El Salvador is doing, we're already seeing this, so this isn't even my opinion, it's a fact. Bitcoin is going to remain the incorruptible reserve asset. If you want to spend your Bitcoin, that will always be there. Nobody's ever going to take that away from you. You can run your own node. You can transact with somebody else who is also running a node. But clearly, this thing that's being engineered, it can be bedrock for a monetary architecture. Bitcoin-backed credit is in its infancy. It's going to be combined with conventional liquidity reserves to create stable value instruments useful for corporations, retirees, savers, and payment systems. And this is the leap that most people are missing. Saylor doesn't believe that every single retiree should raw dog a 60% annualized volatility while checking his hardware wallet while he's 85 years old and he's in the waiting room of a regional orthopedic clinic. Don't you think it's probably smart that network effects can be derived from increased capitalization of the Bitcoin network? I think that is a much more rational path forward as Bitcoiners here. We should recognize reality, recognize that there are pools of capital out there that should have a Bitcoin compatible instrument designed for its particular mandate. Bitcoin can be the foundation for that, and strategy is becoming that financial transition layer. The protocol remains simple precisely because the institutions built around it can become complex to serve different needs of individuals. Bitcoin can improve the lives of millions if we let the development around it happen. The cathedral does not improve the granite by rewriting the molecular structure of the granite. It builds upon it. You can think of Bitcoin as monetary carry crude oil because it's enormously valuable. Obviously, you've seen what's been happening with the oil prices lately. But modern civilization does not pour crude oil directly into your Honda Civic. It refines one resource into gasoline, diesel, jet fuel, lubricants, plastics, and thousands upon thousands of structured, specialized products. And Strategy is just attempting that same transformation with raw Bitcoin exposure. Raw BTC serves the sovereign individual who wants direct ownership of digital capital. I'm one of those people. I love saving my life energy in Bitcoin. But MSTR serves the investor who wants first loss equity. You know, you are getting the residual after the senior claims are accounted for in that capital structure. You get maximum upside with the amplified sensitivity to Bitcoin price movements. Now, there's also part of me that wants that as well, so I am actually both. I like my sovereignty, but I do like going out on the risk curve to try to outperform Bitcoin in Bitcoin terms to hopefully acquire more of the sovereign digital capital for my bloodline. Strike combines the income plus some equity participation as well, so you can get paid to wait for Bitcoin and then therefore MSTR to go up. Stride and Strife, they offer the more long duration credit, you know, with different degrees of seniority and investor protections. And Stretch is more of the par oriented with that par stability mechanism that hopefully gets kicked back into gear here soon, but it is more shorter duration credits, you know, this experience with this variable dividend. If you're interested in Stretch, like most people are, that is pretty much the simple, if you like money, you buy Stretch. And they have proposed this concept of digital money. Now, in my opinion, Bitcoin is money. We can use it as money, but unfortunately, it is in its monetization phase where it is absorbing the monetary premium from all the other assets in the world, and it is a very volatile process. So we are in the infancy of using Bitcoin as money. Now, there's a lot of people that absolutely hate that Saylor has even used the term digital money. I have a very nuanced view on this. I don't like the term either necessarily, but if you could think of some securitization of Bitcoin and maybe even a derivative of a credit instrument where you strip more of the volatility out, you have a zero volatility thing that pays you maybe 5 or 6%, something above the risk-free rate that you can transact with hopefully zero volatility, whether or not that can be constructed. You know, obviously this is a niche. I think a lot of people do have an issue with the semantics of calling something like that money, so I'm not a fan of the title, but I do think if you can serve an investor pool, a global capital pool that wants something like that, and if you can deliver it using Bitcoin on your balance sheet where you're making it economically feasible and you can help capitalize the Bitcoin network, I think that is a win at the end of the day. This might be a controversial position to have as a Bitcoiner, but in my humble opinion, I really think that increased network effects are going to happen as we continue to capitalize the network. I think $1 million Bitcoin will drive a lot of eyeballs to Bitcoin. They will be directed to an endless stream of Saylor podcasts and Bitcoin Wizard content. Hopefully these people get orange pilled. I think that something like what they are calling digital money, that can still serve Bitcoiners and improve people's lives at the end of the day. So I don't throw my arms up in rage when they use this term. I'm not the biggest fan of it, but you know, that is what it is. That's my opinion. But this is the grand master plan that we don't need the entire world to become ideologically orange. We just need the world to select the instrument matching its risk budget. And the beautiful thing is that Bitcoin is permissionless. You can go ahead and continue to transact with the network any way that you want to, despite these things being built on top of it. Just like how if you didn't like gold credit, you can go buy gold if you want to. You can walk into Costco and buy gold. I just think as long as the dollars continue to flow into Strategy, it's the ultimate corporate speculative attack. Borrow in a weak currency, buy the best asset, accumulate Bitcoin, and then the monetary territory continues to disappear into increasingly permanent hands. We power up the network, drive capital to it, and then Wall Street can deliver dollars and receive the financial hydrocarbon of its choosing, yada, 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 but Saylor keeps buying the oil field. It's just reality that different investors want different relationships with the future. That is, when you get down to brass tacks of it, that is reality. Credit investors want income today, maybe because they think they're going to be dead in the next 3 to 5 years. Corporate treasurers might want liquidity tomorrow morning. Now, if Strategy can provide these different tools to these different classes of investors using Bitcoin as that monetary base, and I get rich in the meantime and they work around the clock to continue to make Bitcoiners rich as Bitcoin continues to be adopted in the world. In my opinion, I think Saylor and Strategy have done more for Bitcoin than anybody, and nobody else comes close. There's literally not even a close second place. They can continue to sell certainty to the impatient and convexity to the patient, and I have zero issues with that because they're not stopping you from buying Bitcoin. And in fact, nobody has done more to advocate for Bitcoin than Saylor himself. And this is why Michael Saylor's Endgame is bigger than just MSTR. MSTR is the covered wagon. Strategy is the settlement. Bitcoin is the continent, and the orange frontier is closing. My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for tuning into today's transmission of the Orange Gospel of Bitcoin. If you enjoyed this video, please hit the like button, subscribe to the channel on YouTube. That way you can support me spread the Orange Gospel of Bitcoin to the masses. Have a terrific day, everybody. Do not party too hard. Class dismissed. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it. Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Strategy spent last week selling more MSTR shares to add cash to the USD reserve, and they purchased 0 Bitcoin, and immediately this inspired the usual online funeral procession for MSTR shareholders. We are being diluted. We are being sacrificed. Yes, we are hearing this over and over again from the totally uninformed out there. Apparently, cash entering a corporation vanishes into the same metaphysical dimension as missing socks and congressional accountability. Yet inside Strategy's capital structure, liquidity has a job. It supports the preferred stock, especially STRC. Because the increased liquidity, it improves the credit profile. It helps Stretch migrate back toward that $100 par value that we're all waiting for. The transaction of adding $200+ million of cash to the USD reserve that might look defensive at face value, but in reality, it is reloading the balance sheet for another offensive capital markets campaign. We are going to run the transaction through CEBE today. We are going to examine Strategy's credit rating roadmap. We are going to model Stretch's impact on MSTR. How actually important is it to get Stretch back up to $100? Everybody's freaking out right now. They want it back to $100 ASAP. But I'm going to run the math on how big of a deal it actually is for your MSTR gains if you are an MSTR shareholder. Also, I'll be talking about SATA and ASST, good old Strive. Which one might be the better buy right now? You guys are going to love this content today, whether you're a Strive shareholder, an MSTR shareholder. This is a digital credit update and a reviewing of the capital markets activities last week from both companies. Do me a favor, hit the like button on YouTube and subscribe to the channel if you have not. That way you can support me spread the orange gospel of Bitcoin to the masses. And I do want to take a second to thank the Bitcoin Way for sponsoring the video. You guys know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption that we are seeing, but do not lose sight of the real revolution. Bitcoin in self-custody, 100% owned by you, you being sovereign and you being your own bank. My friends at the Bitcoin Way will train you to become your own bank using only the best open source tools that are out there. They will turn you into a node runner and they will make you a sovereign Bitcoiner. Do not delay. Your freedom depends on it. You can scan that QR code right there. Go to thebitcoinway.com/Adam. Link is in the description below. So as we review what exactly happened with Strategy last week, well, they sold a bunch of MSTR shares, 2,732,318 common shares sold, and that raised $263.5 million. Now, out of that, they added $225 million to the USD reserve. So now they have $3.225 billion in that USD reserve. So basically, when you want to talk about the dividend coverage, they have 31 years in Bitcoin. Yes, 31 years. That is over 3 decades of dividend coverage in Bitcoin. And in addition to that, now they have 22 months. They are zeroing in on that 2 years of dividend coverage in their USD reserve. So the surface level reaction to this, it's all about the 0 Bitcoin purchased last week because people are freaking out. The shares went out, the coins failed to arrive, civilization collapsed, and then of course you have the retail shareholders or people who are not shareholders but somehow have a very nuanced opinion about this. They carve out a tiny tombstone called Bitcoin per share. They cry that it's going down. This was a cash and credit transaction, and it was done while Bitcoin was under stress, which is very important. That liquidity supports the dollar-denominated obligations above the common stock here. Why is this important, you might ask? Because when you look back at when Strategy got their credit rating, and S&P Global published 2 articles about the criteria for, number one, their initial credit rating and what they could do in order to potentially get a better one. They explicitly stated whether Strategy can access capital during a Bitcoin stress. And what were they concerned about? They were concerned about the USD liquidity. The management of Strategy, they walked straight into a bear market in 2026. They raised a lot of money. They deposited some of it into a reserve, and then they took some of that to pay off some debt. That turned out to probably be a little bit of a mistake. Maybe it wasn't totally optimized. Regardless, it wasn't existential, and now they have built it back up to a level that we've never seen before yet. So this is observable credit positive behavior, regardless of whether or not the timeline applauds. So we have 22 months of dividend coverage in cash right now on the balance sheet. Now, is this a positive? Is this a negative? In my opinion, it's a positive if you can get the stretch machine turned back on. This reserve, in conjunction with Bitcoin going up and to the right a little bit, I think it will really help the coverage of STRC, and I don't necessarily think that the market will be demanding such a high effective yield to hold STRC. So I do think this is credit positive. It's good, and at the end of the day, when you are swapping the common equity for cash, and if it's even at a slight premium to the common equity Bitcoin exposure, it's actually accretive for shareholders. It's not dilutive. It is CEBE neutral. So if you can swap equity for cash, remember, as an MSTR shareholder, you absolutely are exposed to the cash. I know it's not Bitcoin. What's the problem? We know that cash earns less than Bitcoin because cash has the metabolic rate of a tranquilized houseplant. Its value comes from endurance because the preferred investors, they want their dollars on a schedule, while Bitcoin continues to experience lots and lots of volatility because it is true, Bitcoin is still in its infancy a little bit. Liquidity just buys time for volatile assets to continually recover, and for a company that's just built around an asset capable of losing 50% in the blink of an eye, time is very productive, so I really like this liquidity runway here. So running the exact math through common equity Bitcoin exposure, because there are some shareholders and non-shareholders that are hyper-fixated on the week-to-week actions of Strategy's management team, I have routinely shown on this channel that ultimately so much of the percentage of the latent gains that are waiting there are already embedded with that 40% amplification ratio. So a little bit more Bitcoin on a week-to-week basis. It actually doesn't matter all that much. I will actually break down the math for you in a little bit here, but if we want to look at the snapshot of the prior week versus this week, if you count only the $225 million reserve increase, it is very, very, very slightly negative in CEBE terms. But if you count all of the net proceeds that were raised, because there was a bit of a discrepancy here between the $263.5 million versus that USD reserve $225 million contribution, it is actually accretive. But I think what happened, they probably sold some MSTR common stock to pay some of the stretch bi-weekly dividend. So regardless, it seems like it's very close to neutral here. It's a few basis points of neutral. I mean, let's just take a midway point here. I don't know, let's call this 80 sats per share between the two. Using today's Bitcoin price, we just went above 65,000, which is cool. 80 sats is 5 cents. So it's literally 5 cents of NAV per share. That is essentially the difference. So who really cares? And the reason why we are looking at the CEBE and ultimately not the gross Bitcoin per share, because like I just said earlier, well, you are exposed to cash as an MSTR shareholder, so that's pretty cool. Because if you do sit on cash on the balance sheet, you know what a percentage of the balance sheet cash is not? It's not a senior claim. It is part of the residual that you are exposed to when you hold MSTR, so you gotta factor that in here. So this nearly sets off all of the gross dilution. This is why the dilution clowns are ridiculous. And remember, what did I just say about 5 cents of CEBE NAV per share? Who really cares here? If this helps get the stretch machine turned back on, I think it will be worth it for the MSTR shareholders. And Strategy is laser-like focused on getting Stretch back up to $100. I'm sorry, but we don't even have to look back a month. On June 29th, you guys got to remember, they came out with the Digital Credit Capital Framework, and obviously Saylor and Fong Li, they have both come out on X ever since this was published, and they've said they want Stretch back up to $100. And the exact sentence from the management team says, Strategy's corporate objective is for STRC to trade over time in a range of approximately $99 to $100, close to its $100 stated amount. And this is the simple plan in a flowchart form. You take the cash, you increase the credit confidence of the instrument. Hopefully that lets Stretch go back up to par, and then the ATM reopens, and then you get to buy more Bitcoin and juice the amplification of MSTR even further. By now, I'm sure you're starting to notice that all of the MSTR bears that have been crying about MSTR's imminent death spiral since February, all of these people are ridiculously stupid clowns. And I have been proven to be totally correct, that there isn't an existential crisis during this bear market. They are raising billions of dollars at the drop of a hat, a fraction of the deep pool of liquidity that MSTR trades at. Bitcoin bear markets don't last that long historically, and we have been in one since October already. We're 9 months in, and guess what? Strategy continues to raise more capital faster than they ever have, and all of those latent gains are sitting there just waiting for Bitcoin to go back up. And remember, during a Bitcoin bear market, S&P published their 3-part credit roadmap for Strategy. Number 1, improve the dollar liquidity, which they're doing. Number 2, reduce the reliance on the convertible debt. They retired $1.5 billion of that. And number 3, access capital in stress. So through this Bitcoin bear market, after Bitcoin has corrected 50%, they are literally hitting on every single part of S&P's roadmap that they handed Strategy back in December. So by literally any objective measure, even if you don't want to look at anything and use BTC yield, it's still up year to date. Strategy's having their most successful year of capital raising ever, and they are knocking out the criteria for inevitable S&P 500 inclusion because their credit rating is going to go up. You think it's not? Bitcoin's going to $1 million. They're going to have 1 million Bitcoin. That's $1 trillion in net asset value at a minimum. So Strategy's dominating, and the haters are just foaming at their mouths. Now everybody is freaking out about Stretch getting back up to par, and honestly, I haven't even looked at today. So let's look and see if the market liked this cash reserve addition. Hey, check that out. Not bad. It's actually up a couple dollars, 2.13%. Not terrible. We'll take it. And it almost hit $89 intraday just about 28 minutes ago. So it seems like this is working so far. But regardless, the big question is, oh my gosh, can they please just get it back up to par? There are so many MSTR shareholders who have the time horizon of ants. They literally don't have patience at all. They're saying, Adam, Stretch needs to get back up to par. We need to buy more Bitcoin. Yeah, that would be ideal, I'm not gonna lie, but I also have patience. The real question is, how much more Stretch issuance will juice my MSTR returns? So I went ahead and crunched the numbers, everybody. I ran some projections, and I basically normalized, I indexed all of the returns by controlling for a variety of variables. I assume that Strategy does not issue any more MSTR except to pay the dividends. I assume that Bitcoin goes back to $100,000 that you can see right here. And then the different scenarios are that MSTR goes up with no Stretch issuance, and then 4 different scenarios where they're issuing $500 million a month, $1 billion a month, $1.5 billion a month, and $2 billion a month for the next 12 months as Bitcoin climbs back to 6 figures. And also there is 0 MNAV expansion. The MNAV stays exactly where it is today, which is very slightly over the net asset value. So it is a very small premium. And what are the differences? Well, it's actually not too crazy. I know the additional Stretch issuance, it will help 100%, but people continue to ignore the latent gains that are already sitting there. Bitcoin is going to go up and to the right because we're all Bitcoin bulls. And there's also embedded amplification there already because of the outstanding preferreds and the outstanding debt. And so MSTR with no Stretch issuance, the 2 gears in the formulaic equation of what actually dictates the MSTR multiple, you got the Bitcoin going up and CEBE per share going up, which is actually derived from just gear 1, the Bitcoin price going up. So one variable changing actually influences 2 variables in the MSTR multiple. Therefore, amplification happens. This is what the math tells you with 0 MNAV expansion. MSTR with no Stretch issuance at all in this scenario goes up 76.35% and it outperforms Bitcoin by 22%. So there you go. You get a 76.35% return. If they're able to issue $500 million per month starting today for 12 months, you only get less than 3% additionally, less than 3% again if they go back up to $1 billion per month issued. $1 billion per month would be slightly over their first year pace ever since STRC came out. $1.5 billion would actually still add less than 3 percentage points of return. And then $2 billion a month, which is close to their two best months ever, April and May. This would juice the return up to an 87.9%. So that would be about a 34% outperformance over Bitcoin versus the 22%. So yes, would it be great if they could get the stretch machine turned back on as soon as possible? 100%. I think it's a matter of waiting for Bitcoin to go up, hopefully raising that dividend, because I do think they need to be more competitive with SATA, because I think both instruments right now are competing for retail cash flows here. I don't think that the retail investors are doing sophisticated credit analysis at all. They are seeing the higher headline yield for SATA and they are seeing more frequent dividends. That's why I think SATA is being more successful right now. And that is the math broken down for what actually $24 billion of stretch would create for the residual if we did have Bitcoin go up to $100,000. The numbers are pretty sweet because Bitcoin is cheap right now. That's why people do want the stretch machine turned on, because this would get them over 300,000 Bitcoin. And honestly, I thought that they were going to get that much this year because they came out this year swinging for the fences. Stretch was really successful. They were issuing a lot of MSTR. So they were buying a lot of Bitcoin. We're having a bit of a slowdown as of late, but we've seen some Bitcoin price stress. Ultimately, I'm not concerned, knowing that the higher the Bitcoin price goes, Strategy just has the capital markets access available more to them, and that's when they can buy more Bitcoin. Regardless, that's how the math breaks out. Now, SATA is running the same exact play inside of Strive, but they do have a smaller denominator. The corporate wrapper is dramatically smaller. We know this. Strategy has over $50 billion of Bitcoin. Strive has about $1 billion. So literally 50x the size we're talking here. Now, basically, I went ahead and modeled that same exact Bitcoin move, going from $65,453 today to $100,000. There is a slight discrepancy in the Bitcoin price from when I calculated. You guys will see that. But regardless, it seems like ASST is going to rise 82.01% if the MNAV stays exactly where it is, which probably won't happen. But adjusting for just the current amplification, them issuing 0 more SATA, and this is just the amplified move with the amplification that already exists on the balance sheet. They don't have any leverage because they don't have debt, so it's only amplification with Strive, but this is closer to a 30% outperformance over Bitcoin. Now, obviously, the big question is, okay, with their smaller scale, they're not able to issue as much preferred equity because you can only issue so much before you're 110% amplified Bitcoin. And do they want to run it that high? Probably not. Is there demand for that? Probably not, because it's trading below par right now when they are offering a 13% dividend. But regardless, I did plug in some projections. What if they're able to issue $100 million per month in SATA for the next 12 months? I'm not saying they will. I'm saying, what if when the machine gets turned back on? What if they can do $200 million a month? What if $300 million a month? Now, I don't know which of these numbers is possible. None of this is financial advice. This is financial entertainment. You need to underwrite your own assumptions, but I did want to demonstrate how much harder the SATA issuance hits the convexity of the common stock, this amplified expression of Bitcoin, as you continue to add on those preferred senior claims. The difference is quite staggering here, because if they issue nothing and Bitcoin goes to 100K, that's an 82% return for ASST with 0 MNAV expansion. But if you can issue $100 million a month, that juices the return by 30 percentage points, literally 30, while Bitcoin is obviously staying at that 52.78% return. If you could add another $100 million on top of that, that would be an additional 28 percentage points. And then if you could issue another $100 million on top of that per month, that means that that would add on another 28 percentage points of return. Look at the gap here between the Bitcoin and the SATA issuance. It's a considerably bigger gap the torque that's hitting the balance sheet when you compare it to strategy. ASST magnifies the effect because each dollar is landing against a much smaller equity base here. Obviously, Strive is super small. Would they be able to issue $3.6 billion SATA over the course of a year? I think it's not impossible, maybe in a Bitcoin bull market when everything's firing on all cylinders. But regardless, you can kind of see how much this would help amplify those Bitcoin terms when you look at the senior claims as a division problem with the Bitcoin assets there on the denominator. It goes up considerably. They juice the amplification despite Bitcoin going up. And because it's a division problem, you have the senior claims rising faster than even the Bitcoin going up. So who knows exactly how much they're going to be able to issue, but I just wanted to demonstrate that small denominator is killer for ASST. And if you wanted to calculate how $10 million of each preferred stock issuance would hit both of these equities, it's very simple. Look at the $10 million as a percentage of the MSTR wrapper here. It's actually 0.027. That's it, but compared to Strive, it's 0.971. That is a 50x advantage for Strive. 50x. So yeah, that small denominator is a killer advantage. And there's the math broken down for you. You get 4.58x more common equity Bitcoin exposure sats per share per $10 million of preferred issued. And that is a 10.9x increase more return impact per sat for a 50.15x modeled return sensitivity per preferred dollar that is issued. Now that's obviously just within the models that I went ahead and projected those Bitcoin price movements with, the MNAV staying the same, all of those inputs. This is not a permanent physical constant. I'm not saying that. This is just the math on this snapshot. But remember, if you want to talk about the advantages of both of these companies right now, look at Strive. They just bought 21 Bitcoin. They're still having buys that are, relatively really small versus MSTR. Clearly, strategy has the capital fire hose. They have the scale, but ASST has the Bitcoin sensitivity. That is a great advantage to have. The big question is, hey, if there's a 50x advantage for preferred dollar issued for ASST, how much more can strategy raise of preferreds due to their scale once Stretch gets back up to par? It's a very interesting question. Can they outrun that small denominator advantage that Strive has? So as we look to this week right now, what I'll be looking at is what Bitcoin's going to do. It's performing really well, above 65,000 and holding very strong despite all of the chaos in the Middle East, having another flare up. And when I look at digital credit, is it dead? Absolutely not. Every single dividend has been paid. I actually think that if you count all of the strategy dividends from when Strike came out in January of last year, and when you look at all the daily dividends that SATA has paid out, I think that the digital credit issuers have successfully paid out over 60 dividends successfully. If it's not 60, it's like 59 or 58. It's really close to 60 for 60 dividends paid. I look at the asset coverage of both companies. They are massively over collateralized in my humble opinion. They're not pledging it as collateral, of course, but you know what I mean. The coverage is there. Over 3 decades of Bitcoin for strategy, close to 2 years in cash. And I just showed you that so much of the common equity returns is made up of just Bitcoin going up. So yes, would it be nice to get the preferred issuance machines turned back on for both companies? 100%. It's not an existential crisis to me. I think that we're going to be back at 70,000, 80,000, eventually $1 million Bitcoin. And I think there's going to be a lot of money made on the way because I think that digital credit is still offering a great return per unit of volatility endured. And we are still in the infancy of this thing. So when I look to MSTR, I continue to be nothing but bullish because of the returns when I'm running the CEBE models. Same thing with ASST. I'm heavily allocated to both. And right now we're just in bear market survival mode and both companies are surviving incredibly easily. To me, it seems like they can meet their obligations, whether it's the debt, whether it's the preferred dividends that they have to pay out. And check this out right here, because they're now sitting on roughly $55 billion of Bitcoin, their net leverage is down to 6% only. I don't think I've seen it this low. I think I only saw it at 7%, but their overall debt as a percentage of the balance sheet continues to drop. Just wait till Saylor and Peng can pay off all the debt, do their Dave Ramsey debt-free scream, and then amplify Bitcoin with stretch issuance and boost that amplification percentage from a 40 to a 70. Yeah, you excited for the volatility super gains then? I am. And then we'll load up the CEBE terminal to get that true MNAV where we're at right now, because at the end of the day, we got to use their real MNAV, right, folks? Let's go ahead and import this. And there you go. It's a 1.03x premium to the common equity Bitcoin exposure net asset value. That means that if they want to, they can probably just go raise another $200 million this week. And it would be accretive to MSTR shareholders. So this is my entire point. Can they survive the bear market? We're 9 months in. Keep raising the cash. It's not dilutive. Get the stretch machine turned back on, kick the can down the road, and patience will play out, in my humble opinion. My name is Adam Livingston. I am the Bitcoin Wizard. If you guys like this video, please hit the like button, subscribe to the channel on YouTube. That way you can support me spread the orange gospel of Bitcoin to the masses. Have a very terrific day, everybody. Do not party too hard. Class dismissed. And you know how excited I get about Bitcoin Treasury companies and the insane levels of institutional adoption of Bitcoin that we are seeing. But don't lose sight of the fact that the most important strategic reserve is your own Bitcoin in 100% self-custody with zero counterparty risk. This is the revolution. My friends at the Bitcoin Way will train you to be your own bank using the best open source tools. They will turn you into a node runner. They will make you a sovereign Bitcoiner. Go to thebitcoinway.com/Adam to schedule a free introductory call and get started today. Do not delay. Your freedom from the fiat system depends on it.
If you're not at the table, you're on the damn menu. I think we're pretty spoiled right now. We may find out very soon what it's like to be on the other side, and I don't think we're gonna like it very much.
I've got questions lined up for these gentlemen, but first I want to ask them about maybe the bigger question, which is that when we think about Bitcoin, it's decentralized, it's permissionless. The ethos of Bitcoin is very independent. Some would even say libertarian, and they think it's Bitcoin versus the state. So what are we doing up here on a panel, kind of getting into the weeds on what DC is doing? How do you push back on that cynicism and that nihilism about today's politics? So we'll start with Stephen. And feel free to introduce yourself.
Yeah, Stephen Pollock, Signal Ridge Partners. We're a consulting firm, works with Bitcoin businesses. Before that, I was at Bitcoin Pulse Institute for a while. And before that, I ran campaigns, state, local, national, all over the country in issue advocacy. So to tee that up, why should we not be cynical? Great one to start with here, Pierre. So I would say I think I am cynical, first of all, and that's why we should be involved. The reason we should be involved in national politics, or we should worry about what's happening with Bitcoin on Capitol Hill, and this is a conversation I've had with tons of people outside of corporate Bitcoin, hardcore Bitcoiners, everyone across the spectrum there. The reality is that if you're not at the table, you're on the damn menu. And so I think we're pretty spoiled right now. I think we're fortunate. And there's some people here in this room and the room next to us adjoining that I think we have to thank for that. However, I think and we can get in this later, we may find out very soon what it's like to be on the other side. And I don't think we're gonna like it very much.
Good afternoon, everybody. Steve Baum, Managing Director at CBiz. I head up the crypto division at CBiz. We're the 7th largest accounting and audit firm in the country. I focus primarily on helping companies get to the public markets that have digital asset businesses. So the question, I'm not in politics, right? So I'm more on the compliance side. But when you talk about the kind of last 15 years of Bitcoin, we look at revolutions, right? And how do revolutions start? And whether it's this technology, blockchain technology, or how the internet started, it's always people pushing for the next level of innovation. And I think when that began, you had this libertarian view of Bitcoin as this free money and something that would be outside the government's control. But then over the last 15 years, I think that the technology became so strong that people started to realize that this type of tech actually is so innovative to be used in financial institutions that it had to have some sort of oversight by government. And that shift has pushed people out of the industry, but also has brought a lot of new faces in. So I think overall it's a good thing because this technology is going to get broader as we kind of see it evolve over the next, decade or so.
Paul Tarantino with Byte Federal. We are a Bitcoin-centered fintech platform. We have two different divisions. One that is our retail on-ramp through our kiosk network, so Cash for Bitcoin. And then our other, which is payment processing. We just launched the very first US regulated casino transaction in Vegas with Circa. So we are funding bets in the casino with Bitcoin. To answer your question, I'm probably the least political person on this panel, but I have also been impacted by it directly with our business. So we definitely have some opinions. But I got into Bitcoin because I believed it was a tool to really fix a lot of the problems that we saw with this combination of the political and financial mechanisms of the world. So Bitcoin, from that libertarian perspective, was for us a way to solve or heal what we long perceived as a lot of deep problems within those two systems. So the adoption of Bitcoin at the larger scale, both Wall Street and government, is a double-edged sword, because you do come, or we came to this with these sort of idealistic goals in mind, and the political process is obviously a negotiation that will continue for some time. And so I think that we sort of struggle with that internally. We want it to be done right, and that fight to get a proper policy crafted it has been challenging and difficult, I think, for all of us to achieve.
Excellent answers. I'll give my own answer, which was my experience with Bitcoin mining in Texas, where we saw legislators who were opposed to Bitcoin mining, and by a process of engagement and education, they actually changed their views. And so as much of the cynicism there is out there about politics, I actually came away with that almost idealistic. Maybe I was in ideal circumstances to have that experience. But now, Stephen, we saw the Genius Act for stablecoins kind of sail through, seemingly, because they want to finance the deficit. So let's get back to cynicism. But it seems like the Clarity Act is kind of stuck in some mud here. The odds online are saying 50-50. Depends which website you check. What's the sentiment like in DC around the Clarity Act, and why should we care?
Yeah, big question. First of all, legislation, clarity, ARMA, whatever. I don't know. I don't know what's going to happen. I don't think anybody knows. Maybe somebody out there, if you know what's going to happen, love for you to raise your hand. But I love that it's a coin flip on Kalshi right now. And I think that what I'm more interested in, obviously it'd be great to get something done. I think we have 5 weeks is what they're saying, right? And I think the question behind that is really about the House and the 82-18 odds that we're seeing on the House flipping, because I think where we're at is we're on the cusp. Some would say we're almost there. Some would say we may be there soon, and some would say that we're now, which I would probably say we're there now in the midst of crisis as an industry. As far as, I mean, Bitcoin's down. I'm not talking about that. I'm talking about the political realities. And I think we also have a massive opportunity. And so if you don't mind, unpack that a little bit. The crisis is that, well, first of all, we have Senator Lummis, who's been phenomenal. Senators like Senator Blackburn, Tennessee, let's go. They're about to be gone. And I don't know if any other senators really could have pulled off what they have with clarity, with market structure, because they've been there a long time. They have seasoned staff, and they've sort of danced through the hula hoops to still give this a chance. It's still at 50-50, which is unbelievable, because it really doesn't feel like it should be a 50-50. It feels like it, you know. And so they're going to be gone soon. And I don't know. I don't think there's any heir apparent. There's people who, you know, we have fans in the Senate and in Congress, but I don't know if we'll ever have another Senator Lummis. I mean, maybe. I hope so, but we may not.
She's a one of a kind.
She's one of a kind, and so that's about to be over with. We're going to lose the House, apparently, right? It's 80% odds the Republicans lose the House, and I say we because the Republicans have been the ones who are supporting us and dragging us all of this forward. And so, you know, we've got a massive opportunity that's about to be, the window's about to be closed. And on the other side of that, you're gonna have a Maxine Waters on the House Financial Services Committee, dragging everybody in front of the committee and embarrassing them on national television. So yeah, it's a little bit of a crisis, but I think the opportunity here is that there's still a 20% odds that the Republicans keep the House. And I think that there's a lot that we can do. There's a lot that has been done. Are you guys familiar with the, there's this thing we used to have, I'm from Southwest Missouri, like 30 minutes away at this small high school. This guy grew up, went to school there, his name was Brad Pitt. And we had this thing we called the Brad Pitt rule, which is basically, if you ask someone out on a date and she makes up some reason or says some reason she can't do it, and you're like, I don't know, you're like, well, if you were Brad Pitt, would she say the same thing? And if the answer is no, then she's just not that into you anymore, or not into you at all, right? And I think what we need to realize is, as an industry, we're no longer Brad Pitt. If we ever were, we're not now. And AI is Brad Pitt. And our mining companies are going to AI, and our Bitcoin Policy Institute, which I was at for 4 years, their new summit's about AI, and I think it's fantastic. I think it's smart, it makes sense. But I think we need to realize we're no longer Brad Pitt. And so if you're not Brad Pitt, what do you need to do? You need to figure out how to impress this girl. And so I think at the midterms, we have an opportunity to impress her. And I don't think we're doing enough yet, but we can talk about it more. I don't want to dominate the time, but I think there's some, Nick Begich, for instance, is a fantastic advocate for us in the House, and I think we need to do more to support him. Everyone in this room, anyone out there who hasn't maxed out, them, their wife, their dog, probably needs to do so. And I doubt that we're doing those sorts of things. And anyway, yeah.
He's representing Alaska, is that right?
Yeah, he's in Alaska. Yeah, but he's essentially solely responsible for ARMA.
Yeah. Oh, well, tell us what ARMA is and kind of what the impact of that legislation would be for the reserve.
Well, yeah, I mean, U.S. government buying a lot of Bitcoin and holding on to it for 20 years is, you know, that'd be phenomenal. I think it's the top of my list. I think it should be the top of most of our list. I think it's a stretch, but I think it's great. So, you know, I think Lund, you know, we have advocates in the House side that we need to take care of, and I'm not sure that we're doing it.
Yeah. Now, Paul, let's shift gears to Bitcoin ATMs, not the at-the-market offerings, but the automated teller machines, the hardware. This administration has been pushing back on issues around fraud. Our vice president himself is in charge of this anti-fraud task force. I've seen headlines of fraud busts abroad, like in Thailand or Cambodia, where these call centers are defrauding people, sometimes using Bitcoin ATMs. And so can you kind of get into kind of what the landscape is there and what the legislative and regulatory pitfalls are and what is kind of legitimate in terms of making sure that we go after the bad guys?
Yeah, sure. Thank you. The Bitcoin ATM space, a lot of people may not be aware of this, is been under a misinformation attack that I think is pretty akin to what you went through with mining. I'm not going to sit here and fool anybody that, you know, we do have some bad operators in the space, but there are a number of us which we consider best-in-class operators that go way above and beyond what's required by law to legally operate, because we want to stop fraud before it takes place at our ATMs. But the state legislators specifically have been led down a path that the Bitcoin ATM companies themselves are the fraudsters. That's simply not the case. As you mentioned, the vast majority of this high dollar fraud starts in the telecom and voice over IP industry, where you could get a phone number for $100 and very light due diligence. They have a protocol in place called the STRC protocol where they're ranking these calls on legitimacy, but the fact of the matter is that the highest rated calls make up 48% of the fraud. So they just don't do enough. And the FCC's filed about $208 million in fines and collected $7,000, so way to go. That being said, you know, that architecture fraud does not just affect ATMs. There was well over 200 and something billion dollars of fraud last year just in the banking system, all starting from those calls. The ATM industry is about 247 million last year. So we're a very small drop in the bucket of total online fraud. And if you look at this fraud, it's not just hitting the banks, it's also Zelle, PayPal, gift cards, credit card fraud, ACH, wires, you name it. It's across the system, and it's growing at about a pace of about 25% a year because of the AI. So the attack on the Bitcoin ATM industry in specific is really misguided because they don't take the time to understand that not all operators are created equal. We have a number of protocols in place inside our terminal that are sorting out and confusing people that are being coached, so we can find out if they're not reading our terms of service, if they're not properly addressing the fraud questionnaires that we have built into our terminal. And everybody over 60 is getting a live phone call from a trained US customer support staff to specifically verify that they're doing this transaction for their own investment purposes and that they're not being coached or being sent to the ATM in order to make a payment to somebody. That's all on top of full KYC, BSA compliance, AML, SARS, CTRs, on-chain analytics, verifying your wallet, tracking your money after you've bought it. All of this is to say that the ATM bans that are taking place across the United States right now, we have Minnesota is banned, Tennessee is banned, and Tennessee actually made it illegal to actually even own a machine if it's off, right? You can't even have it on your premise even if it's turned off. You can go to jail for that now. And then, we have a bunch of pseudo bans where they've restricted the operational profitability to the point that it just was not profitable to operate. So we have been, like you, through the mining debacle, have been trying to educate lawmakers. We've combined with 2 other operators in the space. We just had a great call with Durbin's staff. We're trying to make sure that they understand there's a right way to do this business so they can preserve access for the 26 million and underbanked Americans that need it. This is the group that's underserved, that suffers most from inflation. That's the primary customer for the ATM industry, and we want to preserve access. So that's crucial that we get in front of these people and we have time to educate them. They're passing laws without understanding the way the network works. They're passing laws without understanding all the protocols that are in place voluntarily in order to prevent fraud. And frankly, we have a much lower rate of fraud taking place on the ATMs because of our protocols than any other part of the financial ecosystem.
All right. So I will continue not answering my phone calls because it's fraud.
52.8 billion calls, robocalls last year in the US.
That's crazy. I feel like half of them went to my phone. Steve, all right, let's kind of go on to a rosier topic. Although with the Bitcoin price doing what it is, it's not that rosier. I put on my red tie today because we're down. Fair value accounting. So it used to be the case that you could only write Bitcoin down on your balance sheet. Now you can write it up, hypothetically, in the future. So that was removing a major obstacle for corporate Bitcoin adoption. What now do you see as kind of the obstacles you're encountering with your practice, or is everything kind of streamlined compared to other assets?
Look, I mean, we'll talk a little bit about accounting, and I could talk about the ATMs, or I could talk about the Clarity Act as well. Obviously, the ASU that got passed a few years ago allows you to now mark-to-market digital assets, all digital assets, including Bitcoin. That was a big change because the financial reporting that you saw public companies, specifically 10Ks, 10Qs, didn't represent the true value of those assets because you would have to drive them down to cost and you wouldn't be able to remark them if the price recovered. It doesn't have that big of an impact overall because most investment vehicles require fair value accounting regardless. So it really didn't have a huge impact except if you were really just a public company that wanted to report digital asset holdings. So we see that change now, simplifies the accounting, but does it really change much? I don't necessarily think so. It just gives a little bit of a better picture of the fair value of those coins. Now, Some of the bigger topics probably are around revenue recognition. If you're, taking Bitcoin, doing different strategies, whether it's covered call strategies or if you're mining Bitcoin, they're still dealing with how do we report this properly from a rev rec perspective. And I think there's a lot of diversity in practice that continues to be there with digital asset transactions that generate revenue or income streams. It's an area we see typically that the SEC is pretty involved in, as well as the PCAOB, which is the oversight committee for public accounting firms.
All right. Now we're running short on time, so I'm gonna try to kind of provide a wrap-up question. Stephen, how should people really get engaged? We've got these midterms coming up. The primaries were very interesting in their results. We could lose the House. What do you think the Bitcoin community should be doing more of and less of as they engage with politics?
Sure. I think simple. Double down, triple down on your winners. So Nick Begich, like I said before, Zach Nunn, max out to these guys. Call up the NRCC. Say, hey, put me in, coach. As an industry, or you individually, we should call the NRCC and say, what can we do to help? And then, engage, grassroots, ground and pound. Top down's not going to work. We're going to have to, really roll up our sleeves and do what many have done before us and learn what it's like to really engage, like at a local, state level, congressional district level in the upcoming midterms.
Yeah, and that's something I've seen in Texas is that we've got the Texas Blockchain Council, which has been really effective in engaging at the state level. So I'd also encourage people to find their tribe, find the people around them that are working on these issues. And Paul, do you think the Bitcoin ATM kind of outlook is that going to be an opportunity to orange pill more politicians, or at this point is it really just damage control?
It's a little bit of both. I mean, the educational process through the meetings that we're having with the state lawmakers has really lit the light bulb for a lot of people, right? It's sort of split. It's those that are not taking the time to understand, and then the others that really dig into our fraud protocols that instantly a light goes off, and we commonly hear, how come I haven't heard of this before? And then they want to share it. So we are having traction in regards to that educational process, both stopping further damage, and also they're now starting to think like, I can re-implement new legislation in the future that addresses this in a way that's pro-consumer and pro-business and eliminates fraud. So I do think we're having a good impact. I'll just leave you all with this. If you're interested, you can go to bytefederal.com/fraud-prevention. You can see the architecture of scams that affects the entire financial industry and exactly what we're doing to prevent it. You can also find a petition there that you can sign to preserve access to Bitcoin ATMs for people that so desire it. So yeah, I guess I'll leave it there.
Great. Well, thank you to our panelists, and thank you to the Bitcoin for Corporations team for organizing this symposium. So yeah, well, also, I want to make a shout out for the Bitcoin for Corporations show. We've got a podcast and YouTube that everyone should go check out and subscribe, including some conversation with Paul on this topic. So thank you all and have a great afternoon.
Thanks, Pierre.
It does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
And to kick us off, I first wanted to start with the question of, there's kind of three different pieces here. There's the asset manager, there's the investment bank, there's the custody provider. And for the past, I don't know how many years, I think ever since I've been in Bitcoin, people have been saying the institutions are coming, the institutions are coming. And it feels like the three of you represent the institutional stack of Bitcoin. So my first question would be, what are the institutions waiting on at this point in time in order to enter our market and our industry?
I'll go first. So I'm Chen. I'm the Chief Revenue Officer at BitGo. We are one of the world's largest infra companies for everything digital assets related. Been with the company for about 6.5 years, so seeing a lot. In terms of answering your question, I think it hinges a lot on the passing of Clarity. Clarity Act needs to go through. We have midterms coming up in November. Who knows what's going to happen after November? So we have only a few months between now and then before Congress goes into recess, and that thing needs to be passed. We are obviously in conversations with many, many banks all around the world here in the US and most areas around the world. And here in the US specifically, there's a number of banks that has a bunch of folks queued up. They have a plan ready to go, do a lot of tokenization work on chain. It hinges on Clarity. Around the world, what's interesting is the regulators, especially in the larger tier 1 countries, they look up to the US for guidance. Whatever we do here in the US will get propagated around the world. And if we're able to get Clarity through before the midterms, it's going to unlock a lot of business around the world as well. The last thing I have to say is Brian Armstrong, man, like it was going to go through a couple months back. It's all public information. And the guy and his army of lobbyists in Washington, D.C. did not like the couple of lines that they had in that version of the act and pulled the strings and pulled it off. So I'm very disappointed at what happened a few months back. Hopefully we can regroup and get this thing through as soon as possible.
So maybe I'll jump in here. Definitely agree with those comments. I would say from our side in investment banking and bringing new product to market, new issue, it's certainly supply. Like we need more supply. We need more people in the good parts of the environment being innovative and hitting the scale that's required for those institutions to be able to buy into that, both on the common equity side as well as digital credit. The easiest way to play that, if you didn't have scale previously, were converts. And we've seen a lot of people do that, including yourselves, right? But I think that the superior product is certainly digital credit and the perpetual preferred product, because it's better asset liability matching. It just has the carry trade that's affiliated with it. It makes sense, right? And it's defensible in terms of your balance sheet over time. There's a lot of debate about that right now, and certainly strategy, having a mixed balance sheet is clouding the dialogue around that specific situation. I would say if you think about, okay, well, what's holding institutions back besides availability of investable issuers, right? Which is a real, there's not enough, right? Strategy, we did 5 prefs in 1 year effectively for them. And a lot of institutions got excited about it. Institutions were there and looked at the first one, maybe turned it down, came into the second one because it was so successful. And we kind of built on that success over time leading up to Stretch. There's still fundamental constraints though that exist, like lack of ratings. Lack of ratings takes a ton of institutions off the table. People talk about like huge pockets of capital in insurance and asset managers. Well, they're still antiquated with respect to how they look at their investment thresholds. And if you're, you can be put into buckets that mean love it, understand it, but can't do it because you don't have a rating. And we tried to work with Saylor and team and everyone else to break down that wall back in 2005, but it was just not possible. So I think there's some structural constraints that still exist within these asset managers, both in terms of accepting Bitcoin as an asset class, as true collateral. There are things like ratings and other areas where we're working hard. The regulators, I mean, that's the one thing that's moved in our favor, absolutely. So that's been extremely helpful.
Great comments. I would just add, and I think it's really interesting that we got grouped by the first letter of our company names, because I actually think that introduces like a nice little mix of perspectives to the dialogue. But obviously, Blackrock's a large asset manager. We manage $0 of digital assets for clients as recently as 2-3 years ago, and now we manage 130. Maybe it's lower. Got to check the screens. Right, but the largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it coming to today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing. It's great progress. Obviously, we're in the early top of the first inning. There's a lot more work to do. And some of that is a combination of regulatory clarity as well as infrastructure build out. And they're kind of hand in hand, right? To echo Chen's comments, I think more regulatory clarity is going to be what drives the progress from linear to exponential. Even with a delay to that, which would not be good, I think the adoption rate and the growth continues, just at a more linear-like rate. Because a lot of things need to be built in terms of custody, in terms of wallets, right? A lot of people use IBIT because the ETF wrapper is actually easier and more familiar and more plug and play. But all the folks that we speak with in the ecosystem, whether they're crypto native or TradFi, are increasingly building for this future. So it does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
So I want to start with the first question for you, Will. You just launched a new ETF. Congratulations on that. You know, there is some level of competition between, let's say, the role that Treasury companies and DATs play in the capital markets ecosystem, and what their options chains play, and et cetera, and the products that you are launching. How do you all think about the interplay between launching new wrappers and competing with the Treasury companies that are out there in the ecosystem versus working cooperatively with them?
Yeah, absolutely. Thank you for bringing that up. So we launched our BitA ETF, which is a Bitcoin covered rights option ETF last week. You know, anything that Blackrock launches, we do because of client feedback. We're a very client-centric, client-led firm. And one of the things that clients have articulated is, I am interested in Bitcoin, but I sure would love some way to generate income, and I would like some sort of downside protection. And we can wrap it into one for me, that would be great, right? So I would say completely different products and completely different lanes than what a lot of the DATs have been issuing. Also, BitA, I think we have seen a lot of success in its first week. We're sitting at $30 million of AUM, right? So if we can ever even get close to some of the other credit products, we'll be very proud of that. But again, I think it's just an evolution in the market structure for Bitcoin, right? From the very early days where it had no derivatives to then obviously the early days of perps, and then cleared options, and then the perps really adopting, and then all the ETPs launching in early 24, and then the options, and now having these other maturing things are just ways where that market structure gets more mature and gives you more options, right, for others to come in and build different types of products. Volatility on Bitcoin used to be habitually above 100% realized. And today it's kind of down to this kind of 40 to 60, hovering around 50% range. And I see that as progress, right? I see that as a sign that the ecosystem is maturing and allowing the traditional institutions to come and say, okay, this is an asset that we can work with and create more products and create more creative ways to give clients what they want.
So I want to come back to that topic in a minute, but Lee, I wanted to talk to you about STRC, and I think that that's like the topic du jour of the moment. You know, you worked with Strategy to help design that product. You know, we had a discussion last night about it. You know, now that we're getting into what I would call the edge cases of the product, like the product in, you know, the non-normal circumstances, how would you conceptualize or think about the key mechanics of that product and what matters to the market? And what would be your advice to Treasury companies, several of whom are here that I know are working on pref products, whether or not they've been announced, on how to navigate the uncertainty of the current moment?
Thanks for the easy question.
Yeah, it's a softball.
Okay, so I've got my own opinions. Listen, I do think it's a groundbreaking product. It is an iPhone moment. I've talked about it before. I know Saylor is passionate about the product, but as with all new products, you just don't know what to expect as the product matures. And that is not a mature product. Let's be totally clear. I mean, it's, you know, maturity in financial markets takes time. And you need to go through these events. You need to be tested. I would tell you that we do stay in very close communication with them and Strive. We also help with SATA. We felt really good coming out of the Iran conflict that both of those securities did exactly what we would hope them to do. They were a safe haven, they were yield, they went to par above the ATMs issuing, et cetera. And the yields made sense, I think, just still given the early nature of the issuers, less so strategy, obviously. But, I think that Strive is a good example because you can look at the leverage and amplification on a smaller company like that and still see it hold in nicely. That's working. So it was working. What we've seen here is there are other structural factors that are playing into why it's trading down below 80. I mean, look, in the mid 80s, we IPO'd these things at 80, 85, 90, whatever it might be. So could it go back down to the original IPO price? Of course. I mean, IPOs do that all the time. We're seeing SpaceX broke, right? So there are factors that could lead you down. But I think, unfortunately, we've hit so many people so quickly had put leverage on the instruments or you got retail buying it on margin. And I don't think retail fully understands the product. So we've got some other issues that are forcing us to go below 80, and it's it's unfortunate, but it's a learning experience from my standpoint. And I do think that we're all hopeful that Michael and his team will come out pretty soon. They'll have an 8K on Monday with a very strong message about confidence. I mean, this is not a credit problem, and we talked about this last night. This is not a credit problem. And by the way, taking the yield to 15% or 16% also is not going to get it to trade to par. This is just a structural trade-off and test the security. And everyone needs to take a deep breath and sit down. And Michael needs to come up and say, listen, this is not a credit problem. We have a fortress balance sheet, right? Sure, the converts are coming due, but I'm here to tell you as Barclays, we can refinance those converts tomorrow. I mean, our hedge fund clients that technically priced converts would love to come in at $85 on the stock price right now and restrike a convert. That's not a problem. The put, all that kind of stuff's not an issue. You can refi all the convert debt, and Michael can come out and say all of this. He could choose to do other things too, right? I mean, he's raising cash. You saw in the last 8K last week that he actually sold equity. He could, who knows what he's doing? We'll find out on Monday. He could be selling cash. He could be doing other things, right? And he could raise cash. And they could also, look, the concept of a buyback is a very common concept in all other areas and products. It's just for perpetual stock, because it's such a novel new product, has not been rolled out. And so, a buyback is also a very logical way to support a security like this. By the way, it's not a bad financial trade to be buying it back at 75 when you issued it 100 and then reissue it 100 3 months from now, right? But I think specifically, I don't think it's buybacks that way as opportunistic and financial engineering. I just think you're supporting a new security that's out there and it's going to experience some bumps in the road. And you need to know as a Treasury, when is it moving in a zone where we could hit a leverage trigger? Don't want to go there. We went there. So I think that we should take this experience and say, this is not a problem. There's structural dynamics at play. And I think the learning experience going forward is, do you have other tools in your toolkit as the issuer, Strive or Strategy or future issuers, that will allow you to structurally support that security in these periods of uncertainty?
If there's one great thing you can count on from the crypto market, is that if you design any product and you draw a line of do not cross this line, guarantee that
we're going to cross it.
Right?
We're going to definitely cross it.
So Chin, I want to ask you in a different direction. Y'all have been custodying Bitcoin for a long time. Y'all are dealing not only with the wrappers of Bitcoin like Blackrock or different ETFs, but you're dealing directly with the corporate treasury teams that are holding Bitcoin directly with you. What has had more success in terms of corporate adoption, going through wrappers or holding it directly? And what's the biggest hurdle you see with getting someone to actually squeeze the trigger and put 2, 3, 5% of their treasury into Bitcoin?
We have a very diverse set of clients. We do work with a lot of DATs. We do work with ETFs. And we do work with a number of OG Bitcoin hodlers. We're talking like 2010, 2011, 2012 folks that have kept Bitcoin with us for a very, very long time.
there's also this cohort of people, the wealthiest family offices in a lot of the major countries around the world, they're waking up to this asset class and they're looking at options. I have to say, one of our competitors actually is IBIT. There's a number of folks thinking about, what they can do with the Bitcoin they currently have at BitGo. And to be very frank, we had some customers go the other way, meaning they're taking it out of BitGo, they're moving it over into his product, and it's unfortunately going to Coinbase, I believe, underneath. The thing I want to stress about this entire thing is fundamentally, Bitcoin is a bearer asset. You lose the keys, you're done. And maybe I shouldn't say this on stage, but having Coinbase have, 60, 70, 80% of all the Bitcoin floating around in the traditional financial space is frankly dangerous and not responsible. So you should look at other custodians. There's plenty of other custodians floating around, and diversify where all the Bitcoin is currently being held. If Coinbase messes up, we're done. And we cannot have that fundamentally.
We're all friends.
A powerful statement. I mean, to BitGo's kudos. I don't know of another custodian that's been around as long as y'all and Coinbase that has the track record y'all have. So, well, I want to kind of end on this question, which is probably the number one question I get as a non-capital markets person. I'm a Bitcoiner, putting on a costume of a suit to go to an institutional finance event. But the everyday Bitcoiner tells me BlackRock, Barclays, maybe less so BitGo, but these are the firms that Bitcoin was created to destroy. We don't want these traditional financial firms entering into the Bitcoin market. They are domesticating Bitcoin. What would be your response to that?
Yeah, I'll just say a few things, right? I think number one, we repeat this with every opportunity we get, just to set the record straight that we don't own the Bitcoins, right? We are a provider of a wrapper so that folks who, frankly can't even open like OpenAI or adopt any of this new technology can have exposure to something that they have been educated on and are excited to participate in. So we kind of see our role as being able to bring more people into the philosophy, the belief, the asset, the growth of Bitcoin, right? Now, the fact that they're all concentrated into a single wrapper is one question. But again, if you look at the number of holders on IBIT, there's more than 1,300 that report on the 13F, right? And for many of them, they represent thousands of other individual holders. When a retirement or a pension or a foundation holds IBIT, they're holding that exposure on behalf of a lot of people. So we kind of view it as an opportunity to allow more people to come into the ecosystem, and we don't view our role as someone that's kind of trying to centralize what that represents, right? I do think there are certain instances where if you look, for example, at the quantum risk, right, which a lot of people talk about today, there's an educational process that we can be a part of, right? We're not going to be influencing or controlling whatever the outcome is. But there are ways to coordinate and to help other people see how we can kind of come together and solve that problem. So there are ways to work together. I think at the end of the day, we're all on the same team, right? We want to see this asset thrive. We want to see it become more important and more relevant in the world as it has been for the last 15 years. And we're part of that journey.
I have heard some cool stories about Larry Fink and his journey into Bitcoin, and I've been impressed by how y'all have done it so far.
I think we all know that he used to call it pirate money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
100%. Lee, what's your take on that question?
Yeah, I'm not going to answer it directly as asked. I'm going to ask it in terms of what Barclays, as an investment bank, is doing in the context of that question. And at our heart, we are trying to continue the mission of Bitcoiners, right? In the corporate sense. We are helping new and existing issuers that want to go acquire Bitcoin have access to the institutional bid and bridge that gap, because there's a language barrier in many cases, okay?
Huge language barrier.
Yeah. And so we're believers and we're on your side. And what we're trying to do is we're trying to crystallize the bid in a way that works for everybody, right? And so that's effectively what we're doing. And I'll just to put it in perspective, because there was a panel a couple before this, and someone was like, well, Stretch is 80% retail and 20% institutional. Actually, no. Every single one of these IPOs is 80% institutional and 20% retail. It's why? Because retail needs the validation, particularly of these new products, but they need the validation of the management team, that we've done the diligence and everything else. And then retail will come over the top, just like it's a SpaceX IPO, right? And smother that instrument and take it to where it needs to go. But the institutions are the starter fluid and the validation factor. So they're super important in that regard, because their due diligence and their structuring and their one-on-ones that we do, we don't just roll the product out to the public. We wall cross Blackrock. We wall cross 10 to 15 of our top accounts, okay? And have very deep conversations around what you want as the issuer. We've already got it all written on paper, like this is what we really want, okay? But we know there's gonna be some level of concession. Maybe the cash reserve, that came out of one-on-ones with Strive. Cash reserve was not on the table in the beginning. Didn't want to give it up, not interested. You know what, at the end of the day, it was the right thing for both people, and look at it now. Strategy put the cash reserve in after their Stretch IPO, and it's one of the main factors in supporting that security today. But that came out of the institutional due diligence and the banker and the issuer all coming together in the beginning, and then retail, and then further adoption and success and everything else. And that's pretty much how the model works from our perspective. Yeah.
Jen?
I'll be quick. I mined my first Satoshi December of 2012. I was part of one of the Seattle Bitcoin communities way back when. We met at a coffee shop every weekend to talk about Bitcoin. Those were the good old days. And when I first showed up, I worked at Microsoft. I had a tucked-in collar shirt, and all the libertarians in the room were looking at me funny. It's like, who are you? Oh, the big corporate is here. We've come a long way from those days. And I would say you have to pass the institutional hurdle for this to be truly adopted by the world. I would also say, on top of the institutional demand, there is demand from actual governments around the world. We're talking about the US Strategic Bitcoin Reserve. We're talking about basically the El Salvador playbook smeared across as many countries as possible. BitGo, we do a bunch of hardcore technology for securing Bitcoin. We're working with a number of these countries right as we speak to help them set up what effectively is their own version of a digital Fort Knox. The infrastructure needs to be there, both at the institutional level and at the government level, for us to truly take this to the next level. It's been many, many years since 2009. We have many, many decades to go to get this propagated around the world.
Not to answer my own question, but I always take the view that Bitcoin's the same Bitcoin before any of the people up here bought it.
That's right.
Maybe the same Bitcoin tomorrow. But I think BlackRock after buying Bitcoin, or Barclays after buying Bitcoin, is a little bit different of an organization than they were beforehand. So it's like unleashed capitalism. So anyway, I thank you everyone for being on this panel. Give them a round of applause.
Is quantum computing a threat or is it overblown?
It's both.
I am fascinated by quantum computing.
I think there's definitely a lot of unknowns with quantum computing.
It is a theoretical risk on the Bitcoin network.
The big threat, in my opinion, is the discovery and unlocking of wallets that have been lost forever. Bitcoin is a scarce asset that you can make more of, but you can find more of it by unlocking these old wallets that could pose a threat to Bitcoin.
The quantum concept is, what do you do with the Satoshi coins if they are not quantum resistant and they don't move? It's a really interesting philosophical debate because you could argue that if quantum computing is a real threat and it can come and crack the Satoshi coins, I mean, obviously there's a probability of having a bad actor that wants to tear down the entire ecosystem, but the game theory would suggest that there's more incentive to break the Satoshi wallet, keep the coins, and build on that into the future.
I don't know what the answer is, but I do know that there are a lot of teams working on protecting Bitcoin against it. Teams like Blockstream have a lot of PhD engineers currently working on upgrading Bitcoin to stave off those threats.
I do believe that the technology, as all technology does, will progress and get better. The Bitcoin network has the ability to upgrade and change and morph, and I think that's really the beauty of Bitcoin, is that it's distributed network of nodes. Frankly, I'm currently unconcerned by quantum.
The question is still if and not when. Still, it is important to take that question into consideration and most importantly, not add changes to the protocol with rushing into a solution in search for a problem.
There are people in the Bitcoin community that don't want to see a change to Bitcoin. They believe Bitcoin will be fine as is, and it's designed the way that Satoshi envisioned, and it would be a bastardization of what Satoshi viewed if we make a change to the Bitcoin protocol.
And my view is that Bitcoin will win. Bitcoin will actually be the best prepared for the future of what could be quantum. And you have already solutions that are being proposed by the market, and the best will win. And my view is that the best will be an optional one where people can opt in over time as they perceive a potential risk.
I do understand why people have the fear. I think it's an incredibly complex topic. We're literally talking about quantum physics, and I'm no expert, but from the people that I've listened to and the people that I trust and the research that I've done, I do not think it's an immediate threat. And if it were to become a threat, there are things that the Bitcoin network can do to protect itself.
I would say the threat is less imminent than the headlines suggest, and work being done already to address any potential threat in the future is more robust and diversified than people think. And what I mean by that is there's lots of different work already underway that they range from changing the protocol itself or updating the signature scheme to post-quantum proof signature schemes versus, say, having contingencies and plans that would allow somebody, in case in the future they need to move or migrate to that signature scheme, they can. And so there's a lot of work being done, and the community is already discussing and debating ways that this could potentially happen, but it seems like the threat is more theoretical in nature right now. And I think people underestimate Bitcoin's resilience. Bitcoin is the most secure computer network in the world. It's decentralized. And so what that means is there's a ton of eyeballs looking at this open source code. They're maintaining it, looking for vulnerabilities, making proposals. There's a ton of discussion, and that hive mind is one of Bitcoin's biggest strengths. And that's why its uptime is 99.9%. Despite it probably being the biggest honeypot for any potential attacker to go after. So I think Bitcoin is extremely resilient, and people shouldn't underestimate it.
I think it makes for a great story. It is incredibly interesting tech. It'll continue to move forward. We saw this back there with the Y2K bug back in 1999, where the world was going to implode. Technology marches forward, and Bitcoin continues to adapt for it. And if anybody's worried about quantum breaking Bitcoin, they should be more worried. Quantum will break everything way before Bitcoin. And Bitcoin's already adapting to it because that's the nature of open source software and something at this kind of network scale. So it's actually going to unlock incredible possibilities. So I'm not one of these people that sees the progression of tech as dangerous. I see as we adapt to it, Bitcoin will adapt to it, already is. The discussions are great around it. And we're going to see many great things unfold from quantum computing.
There's multiple attack vectors for quantum on Bitcoin, but there was even just a paper that was released a couple of weeks ago where, without even having to go through a protocol upgrade, we know how Bitcoin and Bitcoin wallets and the consensus mechanism can be completely quantum proofed. So is it a threat? Yes. Are there ways to alleviate that threat such that it will not destroy the Bitcoin network? Absolutely. Do we have to come to a consensus in the Bitcoin community as to what we need to do to protect Bitcoin? Absolutely. Do I think that's going to happen tomorrow? No, but I think we have some very smart people in the community that have figured out ways to make this work, and we have a couple of years before quantum really becomes the true threat that it may be. And at the end of the day, I'm more worried about what quantum and its threat will be on the global financial system as a whole, more so than just native Bitcoin.
Bitcoin's down 50% from the all-time high.
It's going to zero. Should we just cancel the rest of the podcast?
We got to cancel the rest of the podcast. Welcome to the Bitcoin for Corporations show. I'm your host, Pierre Rochard. And today we're joined by a return guest, Mike Belshe from BitGo. Mike, thanks for joining us.
Good to see you again, Pierre. How are you?
Very well. Very
Great.
well. We're here recording in Las Vegas at the Strategy World Conference. And obviously there's a Bitcoin element to Strategy World as well as a business intelligence technology component. So BitGo has had some great news. There's the OCC Bank Trust Charter and your recent IPO. Congratulations. We got lots to talk about, to unpack. And also I want to talk about trends in the industry because obviously Bitcoin's down 50% from the all-time high. Sentiment's a little morose.
It's going to zero. Should we just cancel the rest of the podcast?
We got to cancel the rest of the podcast or change
Bummer.
the name to AI for Corporations. But the reason I bring this up is because you're an OG. You've seen it all. And you founded BitGo in 2013 before anyone was talking about institutional custody. So I'd love to hear how kind of the founding story for BitGo and what your vision was and how you've built from that.
Well, thank you for that intro. Look, I feel fortunate to have learned about Bitcoin earlier than some folks did, but grateful and excited about what we could change from the monetary side once you find Bitcoin. So look, my background is all technology. Never had any intention to be in financial services, much less running a national bank. Yet here I am. And when I was going to college, I was studying, systems. I did programming, of course. But my interest was more in how do you make, the back ends work faster and more scalable. I have a lot of background on the web and things like that. But you discover money and you're like, wait a minute, how does this stuff work? And I remember seeing Eric Voorhees talk, I think it was in 2012, he's so eloquent. And kind of laying out, here's what the properties of money are that are interesting. And I think he said something to the effect of we spend so much of our time, so much of our money, time pursuing money, and yet we don't really know how it works. And it's so true. Most people, just this green stuff, you get it, you want more of it, you go to work and you do your thing. All right. Anyway, fortunate to find Bitcoin and had this realization that, wait a minute, now we can have computers paying computers. And I had spent a lot of time on web protocols. There's a 402 payment required. Error code used to be the loneliest error in HTTP. When I was at Netscape back in the mid 90s. And so I was not on the SSL team. I don't deserve credit for that. But Netscape pioneered building SSL, now known as TLS, which is how you secure web communications. And that was all done with the belief that we weren't going to be able to get e-commerce unless you had an encrypted channel. And of course we built that, and then we used it to use credit cards. And that's, to this day, state of the art for payments. With 402 payment required and Bitcoin, finally now you can actually pay directly in the browsers. That's what got me excited. And then it is a fascinating rabbit hole, as many people call it, where it just keeps going deeper. These days, probably spending more time not so much on what's the properties of money, how do our markets work? There's a market structure bill. What does market structure mean? Most people don't know. Where we sit, we started out, you asked for the origin story, we started out, we just wanted to secure Bitcoin better. So we pioneered multi-sig, which is a protocol for using multiple keys. Basically the idea of securing large amounts of digital asset instead of having a single point of failure. I always try to break it into multiple. So anywhere you do have a single point of failure, you have more. So instead of having one key, you can have multiple keys. And instead of having one person hold the keys, you have multiple people hold the keys. instead of having it be multiple people, you can have it be corporations, and then you have multiple users on wallets and things like that. So it's what eliminates that single point of failure, and we've been using that kind of ever since. We use more technologies. Some blockchains don't support multi-sig like Bitcoin does. I believe multi-sig is absolutely better than MPC for Bitcoin, and the reason is because it's very tried and true technology, and you can actually have two different signers, completely different technological stacks, signing on a transaction, and supply chain type attacks, you're not as vulnerable because it's two completely different implementations. There's a lot of things you can do that way. With MPC, it's a newer crypto. Most people think of crypto, oh, it must be proven to work, right? But actually, most cryptography does not actually ever get mathematically proven to be correct. Instead, what happens is, researchers at great universities do fantastic mathematics. It's complicated, and because there's no mathematical proof that it works, instead they put it out for peer review. And typically about 10 years, of peer review and getting different implementations and having people, try to poke holes. All right, MPC is a relatively new field. I'm not trying to criticize it, by the way. It is ready. But if you want to just talk about the best way to secure Bitcoin, you've got it on chain. You've got the ability to use multiple implementations. It's very simple, tried and true. It's definitely the best way to secure your Bitcoin.
And multi-sig is one of those magical properties that Bitcoin has that, for example, gold doesn't have. Like gold has to physically be in one place at one time. It centralizes to Fort Knox, right, or to the New York Federal Reserve. With multi-sig, you can actually decentralize custody and avoid that peril.
That's correct. So as examples, what we do with our own keys, we use 2 out of 3 typically, and those 3 keys are each of them 1,000 miles away from each other at all times. So we got our cold storage keys in one place, we got our data center keys in another place, we got our backup keys in yet a third place. You can also do it cross-jurisdictionally, right? So you can have one key in the US, you can have one key in Europe, you can have one key in Singapore. Again, making it so that if anything did happen geopolitically, that might make one of those keys vulnerable, the others would hopefully be able to be safe. And then with the 2 out of 3 model, we do one other thing. So just to bring it home, I mean, really the analogy that's easiest to understand is you think your safety deposit box, you've got a key, the banker's got a key. In order to get in the box, you both put the key in and you turn. Okay, so that's 2 out of 2. Now 2 out of 3 gives you a backup key. So, the problem that you have when you're trying to secure your Bitcoin is where do you put the private key? Well, by splitting it up into 3 parts and using a 2 out of 3 model, any single one of those pieces can be stolen. You still have, having lost one key is not going to compromise your wallet. The other 2 keys can still recover. So 2 out of 3 protects against both theft and loss.
And on that point about the private keys, how do hardware wallets fit into that picture and into BitGo's infrastructure?
Yeah, well, you could use a hardware wallet for one of those keys. So we use HSMs. We've been doing this probably earlier than anybody. I think we had our first HSM, I don't know, 2015 or something. We sell HSMs to some of our clients that use it for their local installs of cold storage. So those are, of course, institutional type HSMs. For the personal level, you can use a ledger or whatever for one key, and that works just fine.
Yeah. So kind of then zooming out of kind of the role of a custodian and the relationship with the clients, how is BitGo unique in the service it provides relative to maybe a traditional custodian?
Well, let me start by saying I don't even think we're a custodian.
Yes, right.
So,
right.
It is true that we have licenses to do custody. Yeah. So we are an OCC national bank, and we do custody through that. We have a license in Germany under BaFin. We have a license in Dubai under VAR. We have a license in Singapore under MAS. So those are custodians. Now we built those because there weren't any banks or custodians that we could use. We started out, how do you secure this from a software technology? We added the hardware technology as well for the HSMs. That was for self-custody. But for institutions, they needed to use full custody. So our first really big institutional client was CME Group, probably heard of them. And we did a great engagement with them. They used our self-custody wallets. We didn't have a custodian at the time. This would be back to 2016. They really struggled. They didn't want to hold the key. They searched high and low for somebody to hold the key for them. They couldn't find it, right? And it wasn't in their DNA. So that was what really led us to say, okay, we just need to go and be a full-blown custodian. That was the start of it back in 2017 is when we did that. So back to what's different about BitGo. The reason I say we're not a custodian, For us, custody is a means to an end, not necessarily the end. It is true. We do a lot on the security. I think we got the best security of anybody in the industry. So obviously building upon that, it sounds like custody and wallets. I think also, if you come in from any other asset class, you will find a market structure, and that market structure has a network of broker-dealers and exchanges and clearinghouses and custodians and banks, and they all have a place and they have a role and they fit in. You think of the largest custodians traditionally, State Street, JP Morgan, BNY Mellon. What they do is incredibly well known. It's been done for each one of those organizations, 100 plus years old. So the risk that they take, how they do it, it's pretty similar. Look, in crypto, it's very different. You look across the custodians, the folks that are storing this asset, very different technology, very different coin support, very different services on top. But more importantly, because there's no market structure, somebody chooses you, they like cold storage. We do cold storage, we do a great job of it, provide a lot of service around it, we do it all over the world. But then if you want to have liquidity, you have to take the money out of that custody, you have to go put it somewhere. So we ran into this problem back 2018, 2019. Market structure is what solves this. You don't have to trade off between security and liquidity. Like, why should you have to make that choice? You should have both, right? And that market structure is what gives you the fabric. So in the crypto industry, and to this day, we live on these vertical stacks of exchanges. That's what most people know as their kind of financial institutions in Bitcoin. And so the separation of these different roles isn't defined. And so you see different people doing it in different ways. So BitGo has started building that. Basically, because we started at the bottom of the stack, you can't build financial services that are world-class unless you've got a super strong foundation. So we started that. We spent nearly a decade kind of perfecting and building that. It's never perfect, by the way. Security's never done. But we built that, and then now the financial services where we spend most of our time.
So for the institutions that are using BitGo for custody, and due to the fact that they're not comfortable holding the private keys or spending 10 years building something as reliable as BitGo, they still have to hold the passwords, right? And so how do you advise and think about this with your clients of how they access BitGo and the secrets they do have?
Well, that's our job, right? So is to make that software usable, and I think that's what we've done. So when you're talking about businesses coming into Bitcoin, it's a little different than individuals. So it's your Bitcoin, you're thinking about how you're going to hold it. Is it going to be your personal? Is it going to be custodial? Then it's like your backups and all that kind of stuff for one person. When an institution or a corporate comes in, the CFO wants to be part of it, just like with a corporate bank account.
Right.
And your controllers can be part of it. And you're going to have a few operational people that are part of it. All of these people have roles on your bank account. And of course, they all have roles at BitGo. Also auditors, people that have view-only access are also in there. So what we did is we built this role-based system. Of course, we start with the on-chain securities, this 2 out of 3 multi-sig. Then we layer policies on top of that and then multi-user management on top of that. And then in terms of how do you make this usable, it's really the policies which are unique. So in the traditional system where you're dealing with dollars or other things, those are not bearer instruments, meaning that if somebody takes them, there are usually database ways to get them back.
Reverse.
Also, when you're working with the traditional finance system, the banks have traditionally controlled as kind of access gateways, right? The entry points into the system. So even if there's movements between banks, that's an error, somebody fat-fingered something or whatever, they can undo it. Bearer instruments, not the same thing. All of a sudden, these policies matter incredibly. So all kinds of policies are possible. And what people typically will be doing is they'll segregate their funds across different wallets of different types, different access around those, but then they set policies. And hey, spending up to $100,000, no big deal. Just these people can authorize it and it's done. You want to spend more than that, maybe up to $1 million, 2 people are going to authorize that. So now what's happening is you're getting messages down to your phone. All right, so in addition to your username, your password, 2-factor auth, you've also got your phone, which has got, by the way, another public-private key that we're using to manage you, and it's got biometrics in it. Sometimes we rely on video IDs, more for the backup system when people kind of lose things. It's more of a human problem. All right, anyway, you can layer these things together. At this point, if you're doing a very large, if you're doing $1 billion transaction, you can have 7 people approve this,
Mm.
right? And it can be these specific people, and then one of those guys, and one of those. There's a lot of configurable.
Yeah. And then is there a time element to it as well of 48 hours have to elapse after the approval so that there's opportunities to...
Those
you
are
know,
all configurable
yeah,
as policies. So at this point, I think probably mostly what we do is we've recommended to most clients, and if they fit in a certain size, they have a certain set of policies. But sometimes different businesses have different constraints as well. For instance, an exchange is probably going to have some amount of real-time wallets that they'll deal with differently than they would with like their cold storage.
Yeah, fascinating. And it seems like at this point, it's almost more secure than some of the traditional financial institutions in kind of that rigor.
Look, on the digital security side, I think it probably is. Look, we have a target on our backs, and we're securing hundreds of billions of dollars. So it's a very, very serious business. Actually, one thing I mentioned in some interviews recently, it's a small one, but like we banned LinkedIn at BitGo.
Yeah.
And why? Look, social engineering is probably the biggest threat to pretty much everybody digitally, regardless of what your business is. I think I saw a report that said something like 60% of hacks started with some form of social engineering. And how does that start? Well, they look at who inside of a company might be likely to have access to something that the attacker wants, right? And so sometimes that's customer support information. We've seen that happen in a number of companies. Sometimes it's they want to get to your DevOps team, right? They want to know who's actually doing the security. So obviously, like there's a ton of security layers that we have internally, and we do that. But also, like why give people a free org chart,
right?
Where they can just find the people. By the way, so the reason we talked about it for a long time internally, and didn't really want to do it. I don't want to take away like employees' ability
career development
to have their own social media, whatever it may be. But we had a new guy join in our IT team, and within 3 days, he was getting, phishing emails.
Yeah.
And it was targeted to him because he worked at BitGo. And it's very clear. The attackers have completely automated the process. And of course, they're trying to get in all kinds of ways. They'd love to know who your developers are, what are their GitHub accounts. So anyway, this is not a be-all, end-all. The hackers definitely have complicated database. They will find us. But we do our best to also minimize that stuff.
That makes sense. And we've also seen a lot of news stories coming out from my home country of France of just horrific, what we called wrench attacks, which is really nowadays almost a euphemism for the kind of the physical attacks that we see on people who are public about being Bitcoiners. How do you think about kind of that physical security layer?
Well, the layers that we have hopefully prevent that. So those have mostly been kind of retail type individuals. And I think what happened there actually was there was some just information identity doxing type of leaks that happened where they didn't...
From the tax authorities and from other sources as well, but
so
most troublesome.
Here's your map of these people have lots of Bitcoin and here's their name of an address. And gosh,
it's because they have a wealth tax. So they itemize kind of all the assets, and that that is a high pot.
I did not know.
Yeah.
All right.
Yeah.
Yeah, look, governments do collect information. They ask companies, financial institutions to collect information. That then becomes, people in security are like, I don't want this information.
Right.
And sometimes we're regulatorily required to collect it.
Do you think there's a path? I've heard people kind of hypothesize about using zero knowledge proofs, for example, to try to minimize how much data gets stored in all these giant SQL databases while still maintaining kind of the regulatory posture.
Look, I think it's going to help. I think these solutions are coming to market now. I think it'll be good. Certainly can't be worse than where we've been.
Right.
But yeah, the wrench attacks are tough. So look, with the BitGo solution, there's typical things. There's duress capabilities that you can use. I'm not sure that those really work that well if you needed them, but we do have them. But mostly it's the policy. So by the way, something I'd like everybody to know, like you can come and you can get me. I've got access to nothing. All you will do is, cause me, I guess, a lot of pain. It's actually a very important point. Like we made a very, very careful attempt. there's no collection of executives at BitGo that you can come and collect and then somehow steal the money.
Right. Yeah, that's really important. Okay, so to kind of get on some lighter topics, let's talk about kind of the regulatory landscape that's really evolving a lot with regards to banks and financial institutions. So you mentioned market structure that is in the works with the Clarity Act, but the Genius Act was passed that was related to stablecoins. Really curious to hear from your perspective, kind of why should Bitcoiners care about stablecoins, and kind of simultaneously, we also hear people say stablecoins make Bitcoin obsolete. So why should stablecoin enthusiasts care about Bitcoin?
Okay. Well, look, I think they're very different things.
Yeah.
So payments today, if you're here in the U.S., mostly done in U.S. dollars. You probably get your paycheck. You may not, but most people get their paychecks in U.S. dollars. All right. And imagine you walk into McDonald's tomorrow, and you're here in Las Vegas, and they say that'll be 13 euros, and you're like, well, I don't have any euros, and they'd be like, tough luck, you can't buy your burger. It just turns out that like U.S. dollar in the U.S. is going to be a payment system for a long time. You're required to pay your taxes in it, at least for now. It is the payment system that's used. Bitcoin, of course, could become a payment system in the future. I think right now most people agree it's kind of so small and it's volatile. People would rather save it than use it as a payment. This is not a ding on Bitcoin. I think it's the state of where it is kind of in its evolution. So, all right, we're going to have payments. We're going to have store value. Bitcoin can provide one, but not a lot of the other. Stablecoins are better for payments than banks ever were. By the way, we know that banks have let us down on payments because of the existence of all these payment apps, from PayPal to Venmo to Cash App, all of them. And what's happened is there's been a demand for better technology around how you do just basic payments, and the banking system just hasn't done it very well. Look, stablecoins are way better. So in addition to being able to be digital and easily added to any of those apps that we just mentioned, they can be a one-to-one backed, so there's no fractional reserve. So most people don't think about how banks work. We know that banks are highly regulated. We've probably heard the term safety and soundness of a bank, which is very important. Basically what happens is you put your money at the bank, and of course we know the bank lends it out. And the safety and soundness is making sure that the bank is doing that in a responsible way with the appropriate backstops and reserve capital, so that if you come and ask for your money right now, you're going to get it. And for the most part, it works. But it is fractional reserve, and from time to time, it doesn't work. By the way, the reason there's so much regulation in the banking industry is because there's been a ton of failures over time. Now, some of those happened 100 years ago or 50 years ago. But all of these rules have been developed to try to make sure that we don't have repeats of it. So look, with stablecoins, there's no chance of that. It's one-to-one backed. So it's super easy to put these into a T-bill money market type of thing. It's very easy to audit that, very easy to see in real time. By the way, with our stablecoin, so we have a stablecoin as a service. We don't do our own stablecoin, but we're getting these things audited twice a month.
Yeah.
Show me a bank that gets audited twice a month.
Right.
So, and by the way, one of those at the end of the month. The other one is a random point in time during the month. And they come in at a random point to make sure you're not like moving the money intra-month, things like that. All right, so stablecoins are one-to-one backed. They should be able to give you better yield than you get at your bank. Interestingly, the risk-free rate today is a little under 4%, and yet banks are giving you like 0.2%.
Right.
Think about that.
Yeah.
They didn't have to take any risk. It's called the risk-free rate because it's considered that the T-bill is the lowest risk, right? All they had to do was give you that, and they could give you nearly 4%, and instead they're giving you 0.2% while taking risk. All right, so look, I'm assuming that the reason they don't put it into T-bills is because they're making more somewhere else, but they're sharing none of that back. Stablecoins ought to be able to give this all back to you. It should be like an ETF. So like Blackrock offers a Bitcoin ETF. They charge 25 basis points to administer that. What's that administration? Well, it's some regulatory overhead and some operational capabilities and some audits. That's basically what we do with stablecoins. We have some regulatory overhead, we have some operational capabilities, and some audits.
Yeah.
So I think 25, 50 basis points seems like a reasonable kind of fee for running that type of service. And then the rest should go back to you. It's your money. You should get you know what's, and all right. So and then lastly, it's 24/7. Like there's no banking fees, no wire fees. We can build apps on it. It's programmatic money. So this is just a better savings bank than we've ever had before. So I think that stablecoins and Bitcoin are just, today 2 different use cases. And the reason stablecoins are actually great for Bitcoiners is because it brings it into the digital era. So when you look inside of BitGo's code base, you'll basically see a big if statement all over the place. It's like, if US dollar, go over to wire system, with these, Monday through Friday, 9 to 5 and all this crazy stuff. And then you got the digital world. And then that's all the same, whether it's, Bitcoin or stablecoins, et cetera, we have common code there. So we're going to just build much more efficient systems, much better systems. I think it's going to actually accelerate the adoption of Bitcoin that we now have, stablecoins. So you take your dollars. It's very easy to get your mental model around it. Oh, okay, my dollars in the bank are 1-to-1 to the stablecoin. I now have the stablecoin, which is digital. I'm now learning about how do I self-custody that? How do I custody that? How do I think about that being a 24/7 thing and what goes with it? And then now I'm going to go into Bitcoin, and it's like just a super easy stepping stone.
So stablecoins really emerged because of Bitcoin to kind of provide global liquidity for trading Bitcoin.
I think that's right.
And now I've seen it adopted for cross-border payments, remittances for people abroad who don't have a U.S. dollar bank account. But do you see it evolving domestically, where today with Apple Pay and a credit card, it feels so convenient that is it going to be an uphill battle here in the U.S. to penetrate that market?
I don't think it's going to be too bad. I mean, I think it takes a little bit of time. The regulatory components, getting the right participants takes time. There's businesses that are making money kind of doing it the current way, and they're making a lot of money. Credit cards feel like they're free unless you didn't pay your bill every month, which a lot of people do, so they don't feel it. But you're paying somewhere around 5% on every single transaction you do, and about 2.5 to 3% of that goes to the consumer side, and the rest of it goes to the business side. Then, by the way, there's chargebacks and all kinds of things that happen, which are a secondary effect of basically this credit and not very good security behind it. So there's so much fraudulent activity, right? I mean, it's a 16-digit number that it's on a card. So it's so easily stolen that there's this chargeback system. And by the way, the regulators come in here and they say consumer protection laws. If you dispute an item on your credit card, because mistakes are made, it's not digitally verified. So the default goes to the consumer, which, by the way, I think this is a good law. But of course, in the end, you're paying for this. This is part of that 5%. So what's good about credit cards, if you do want to break it down, it's really an insurance package for whatever it is you're purchasing. Whether it's a meal that you're purchasing, whether it's a piece of art, whether it's a birthday gift for your daughter, you're paying insurance on that payment, and it's expensive. But it works. All right, so yes, I do think all of these things can go digital. I also think you can add an insurance layer on top of it. I think it's going to be much cheaper insurance because it's cryptographically secured, whereas of course, the credit cards are trivially stolen.
Yeah, and now the other functionality of a credit card is that you get to pay the bill later, right? That you're getting extended a line of credit. Have you seen stablecoin type solutions that cater to that use case?
I haven't seen one. I haven't seen one that's happened yet, but there's no reason this can't happen.
Seems inevitable.
Yeah, and then of course you'll pay a small fee for that.
Yeah. Now, with this regulatory kind of new environment, we've seen Circle announce that they're launching their own blockchain. Tether announced that they're launching their own blockchain. Is this going to cause a kind of a fragmentation of different ecosystems? How do you think about like interoperability between stablecoins and you as an infrastructure provider? Your role in that.
So there's a war on the layer ones, or competition, if you want to be the friendlier term, where different blockchains have different features, different scalability, different privacy attributes, and trying to win the general ecosystem game. And so each one of them is competing. And then on top of that, now you have some specialty stablecoin blockchains. And then the regulation that we have, which doesn't allow interest to be given back to retail, is making it so that everybody wants to be an issuer. So think about it. Like, let's say you're a bank, you've got a distribution of users. You're a believer in stablecoins as making a better product. You want to take that to your clients. You've got two choices. You can use one of the existing ones, which would be like USDC or Tether, or you can create your own. If you use USDC or Tether, your users get nothing. USDC and Tether make all the money. So instead, you're probably like, well, it's my clients. Why am I going to put it on their system? I'm going to do it. So, by the way, to some degree, the reason we're seeing this massive number of new stablecoins coming out is because everybody wants to be the issuer. You get to keep all the money by regulation. So if we just fix that, like instead what will happen is we'll have a couple of these come out. There will be an administrative fee like what Blackrock charges, 25 or 50 basis points. It'll get very big. The rest will go back to whoever the actual owner of the money is. And you won't have like all of these different things. All right, now back to the some of the features that are coming out. Look, privacy is a real issue, right? So people do want private money transactions, and today's stablecoins don't provide a lot of that. So it's an area that can be better. Also, fees are a little bit difficult. You know, most of these run on Ethereum, and then you have to pay Ethereum gas fees in addition to the stablecoin payment. So you were trying to pay $1, but it ended up being $1 plus some Ethereum, and that creates a usability experience which can be improved. So I think some of the new blockchains are trying to address those problems. They'll compete it out. I mean, this is great. Like we have innovation that's happening, and different guys have got different answers about what's the best way to do it, and we'll see which one the market likes best.
And so what do you think that from a government perspective, what their incentives are with regards to stablecoins, and that they've been relatively, so it's interesting, I was at an FBI symposium, and I won't say who, but a representative from a stablecoin issuer was there, explaining that they KYC AML the primary market, but they don't KYC AML the secondary market, but they can freeze funds on the secondary market and follow up with law enforcement and all of these topics, which some have called regulatory arbitrage, but it seems like law enforcement likes it and government likes it. And so how do you see kind of why there's this alignment?
Yeah, look, the regulators, especially prior to this administration, were very clear that you need to have freeze capabilities on stablecoins. You know, we're the issuer of wrapped Bitcoin, which is a stablecoin. Instead of measured in dollars, it's Bitcoin. Wrapped Bitcoin does not have a freeze function. And so it's unique among stablecoins in that it doesn't have that. So my opinion on the freeze function is it's a lot of power, and it doesn't seem like it's that bad. There's some good intentions for why to have it. For instance, people lose their keys, and then you can freeze the old one and issue some new ones. So there's good reasons to do that. But you're also ceding over power and basically personal sovereignty. So let's use Gmail as an analogy. You know, prior to having all these web-based emails, companies ran their own corporate mail servers. And if law enforcement wanted to come and look at your email, they had to show up with a warrant, and they had to say, hey, we want to see your email, here's the warrant, and you would fork over your, and that meant they had to go prove a burden to a judge and say that they had a reasonable cause to go look at your email. Now that it's gone to cloud-based providers, that warrant doesn't come to you. It goes to Google. And look, Google doesn't want to fight these things. I'm not blaming Google here at all. I'm not trying to attack them. But they hand it over. Somebody shows up from law enforcement and says, I need to see these emails, they hand it over. Like, so you never got a chance to fight it. Even if a warrant has to be provided, that warrant was provided to Google. Google doesn't have time to go engage with your lawyers and say, hey, we got this warrant, is it okay? Da, da, da. So what's happened is you've given up your personal sovereignty over your email to cloud providers. The same thing is true with stablecoins that have freeze capability. Today, you got your money, right? It can be your cash, of course, that's definitely your own. But if it's at your bank, if it's at a place that you've chosen, law enforcement has to get a warrant and go to that place. Now they can go to the stablecoin issuer. They've got a level of abstraction, which is one-stop shopping, and we'll circle, we'll tether, fight for you, let you know, hey, we have a warrant for your stuff, or will they just freeze it? And of course, we know the answer is that they're just gonna freeze it. So I think people haven't carefully considered this enough. When it's for the good cases, there's good reasons to do this. People lose they lose their keys, they send it to the wrong place. There's good reasons. But what happens when there's Operation Choke Point 3.0?
Right.
So What happens when they decide that certain types of payments they don't like and they're just going to freeze it? Or, that happened to be a wallet that contributed something to politically was not liked. What's going to happen?
And we might think that here in the U.S. we have rule of law, so we don't have to worry about that. But there's lots of cases. And then if we go abroad, because I've heard people kind of hypothesize that stablecoins are going to enable the dollarization of foreign economies. I could imagine foreign governments not being super excited about that and wanting to use these freeze functions to freeze out stablecoins from their jurisdiction.
Well, now you get a new question. Who's authorized to issue a freeze? So if Circle is regulated in the U.S., is it just the U.S.? What happens if Europe wants to freeze, Circle in the U.S. or anywhere else? I got to believe the corporations are going to do the simple path. They're going to be like, wait, I don't want to be in the middle of this. I am regulated by this government. I operate in their business. I'm going to listen to it. So now kind of any government can make the claim. Look, these are complicated questions. And I don't know how in terms of the global dollarization, I actually do think this is a little bit true. And by the way, this is not unique to stablecoins, right? El Salvador, we talk about a fair amount. They ditched their own currency, I think, around 2000. I might not have that right. But they moved on to the dollar. And why did they do that? Well, they had a history of, running their own currency into the ground. And finally, they got some leaders that said, you know what, I need to future-proof this. I'm afraid that the next leader might ruin it as well, even if we do a reset. Let's move on to the dollar, which seems stable. And so some have done that. I think Panama has done that as well. Others will do like dollar linked. So Hong Kong dollar, for instance, is dollar linked. Others are doing algorithmic stablecoins. So the UAE, the UAE dinar, I think it's called, is a combination of oil reserves and dollar reserves.
Oh, interesting.
It's a stablecoin. It's an algorithmic stablecoin.
Yeah.
All right. So anyway, these things have existed for a long time. I actually think as long as the U.S. had the most stable currency, this all works. I think in more recent, geopolitical times, the U.S. being able to sanction certain countries makes people a little bit more worried about dollars. That makes people wonder if they want to be something dollar-backed.
So let's say everybody here in the U.S. starts using stablecoins, no more bank deposits. What happens to financial intermediation? What happens to the banking system in this new world?
Well, look, I think we'll still have banks in some form, but I do think banks are changing right now, and this is not a bad thing. I think it's a good thing. So banks, when was the bank invented? I don't know exactly, but if you go back
ancient times,
if you go back 150 years, banks were very different, right? And we didn't have computers, and so this idea that you're going to have depositors that want to secure their money, so they're going to deposit into the bank, and then people that needed loans to make the economy grow. This was very real, and so the banks provided a very local and real function in terms of, both safety for local consumers as well as making the economy work better in that region. And by the way, back in 1850 when they came in, when a bank came into an area, they would build these large marble fortresses, and it was to show that they were there in San Francisco or wherever it was. And they're permanent. They weren't building just a temporary structure. They're coming in, and people could count on this thing because look at how big it is and look at how established it's making itself. All right, today we've got computers. Like this idea of linking the depositors and the lending, it doesn't have to be that way anymore. And in fact, it's already started to shift. So for instance, when you do your mortgage, sure, the bank underwrites it. They do the paperwork, all that kind of stuff. They have it for about 5 minutes before you're out the door. They've securitized it, productized it, sent it off to Wall Street, and now it's tradable over there. That's pretty much true for the entire U.S. mortgage industry today. Small business loans, I guess they're still doing it a little bit. But overall, can we make lending markets just completely separate from the depository? So we can take stable coins, they're the deposits. If you just want to be able to get a risk-free rate, have safe money, great payments, all your day-to-day stuff, your paycheck, etc., do that there, and then we'll have lending markets, and then private equity can come in, corporates can come in, high net worths, even individuals can come in and lend into those markets, and they're taking some amount of risk when they do that.
So then how does BitGo as an infrastructure provider kind of fit in with getting an OCC charter, and what was the impetus for that?
Well, let's see, a couple things. So we're infrastructure provider. This is money. We're sort of like SaaS, software as a service. But because it's money, there's regulatory requirements to do certain things. You've heard of money transmission, sometimes there's custody licenses, sometimes there's trading licenses, you've got lending licenses. We don't do lending much for retail, but the other three. So in addition to building software, web services, hardware in order to protect these assets, we also acquire these licenses, and then we help our clients use our products and services. So you can go about building whatever it is you're trying to do, but we take care of kind of that banking aspect of it. So we call this crypto as a service. In terms of how we fit in, because there hasn't been market structure, and I guess we could talk about like what the heck is market structure, but because there hasn't been market structure, we've been basically building it. I think we've been building it really kind of on principles. And the first principle we ran into as you get into custody is like, well, what should an account look like? What should the features of that be? I have a simple thing I've been recommending to pretty much all the policymakers. I haven't heard anybody that doesn't like this. You go to your bank, they're a fiduciary for your money. You go to your broker, he's a fiduciary for your equities. You go to your RIA, he's a fiduciary for your investments. You go to your crypto exchange, not a fiduciary. I mean, look, why should you not, if you're going to have your money entrusted to this other party, why should your Bitcoin not be protected? Of course it should be. And we all know this. By the way, our industry already encountered this problem. We started out retail, and there were no banks that would touch crypto, so those had to be built, so totally understandable. And then as it got bigger, corporates and institutions started coming in, and all of them were just putting money straight onto the balance sheet of the exchange that they were trading at. This isn't how institutions usually work, because they know that the money that they've deposited on that balance sheet is at risk. So they then said, no, you guys, we're not going to put more. 25 million is our limit, whatever. We're not going to put a penny more unless you go figure out how to give us a fiduciary. And this is where we say it's a bankruptcy remote, segregated funds, fiduciary protected. It's those basics of what it means to have an account that's managed in a responsible way by another party. Of course, you should have that for your Bitcoin. So anyway, we built that. That was kind of a first principles approach. Every account at BitGo, doesn't matter whether you're institutional or retail or whatever, you get that property.
And so that's on the custody side. Now, I've also heard you talk about the separation between custody and execution. I'd love to hear you kind of dig in on that topic.
Yeah, okay. So let's talk about what is market structure and why does it matter. So if you go into our two big traditional markets, you'll find two. Equities world is one, CFTC derivatives markets is another. They both look pretty similar. At the heart of any market is an exchange. That exchange is not accessed directly by retail investors. Typically, they go through brokers. So you'll have a seller's broker over here, a buyer's broker over here. You can pick your own. You got choice. There's lots of competition. Those guys connect into the exchange. And then over the history of man, we like to trade faster and faster and faster. And that's along this arc. Well, it turns out that when you do lots of trading, you're doing it really fast, it's both capital inefficient and complicated to settle. So settlement happens more slowly. We figured out how to do net settlement, and we do that through clearing, so that'll drop down into a central clearing party, and ultimately that drops down into custodians and banks. And that's the basic market structure of the equities world. If you look at the CFTC world, you'll find something similar. In the middle, it's still an exchange, but it's called a DCM now. And then the brokers are called FCMs, and then the clearing organization is called DCO. But it's pretty similar in terms of the functions that operate there. In the crypto world today, we've got these verticalized stacks. Now, what I think market structure should be about is identifying risk to the market and mitigating that risk. So the reason it matters, the US has the best capital markets in the world. We've also had the largest economy for a long time. Now that we're going to be surpassed by China in the not too distant future, they will have a bigger GDP. I think, what is it, 2029, 2030?
I'd actually push back on that. I'm starting to be skeptical about that. GDP growth in the US has been phenomenal over the past 12 months. But
look, that would be great. I still think that China will pass the US, maybe the years.
They've got more people for sure,
But back to what I'm talking about. On the capital market side, China is not even close. There's nobody that's even close. The US is the best capital markets in the world. I think it's imperative that we maintain that. So markets tend to lean towards monopolies. So in the derivatives world, of course, you've got CME, monopoly. ICE is small in comparison. In the equities world, a little bit less of a monopoly. It used to be all New York Stock Exchange. Now New York Stock Exchange plus NASDAQ is about 75% of equities. But still, the exchanges in these markets are aggregators of the most buyers and the most sellers, which makes them have the best price, which is why they lean towards monopoly.
It's like a liquidity network effect.
It is a liquidity network. It is exactly that. So the heart of the market is the exchange, and I think it's imperative that that thing never go down.
Mm-hmm.
So what risks are introduced with crypto trading? Number one, custody risk. Obviously, we've seen hundreds of Bitcoin exchanges die for failure to custody properly. So in traditional markets, exchanges never hold custody of anything. And those are actually easier industries to hold custody because they're not bearer instruments. So digital assets, Bitcoin, is the hardest thing ever to custody. And yet we're now going to put that coupled to the exchange. All right. So imagine if the New York Stock Exchange were holding Bitcoin and trading Bitcoin and it got hacked. And so the exchange goes down and the custody goes down. We actually know what this looks like. I mean, we've seen this 1,000 times in Bitcoin. So I don't think that should happen. Remember, Larry Fink says everything. He's the CEO of Blackrock. He says everything is going to go digital. There's a whole bunch of other folks from traditional finance that also think so. So we have to believe that the capital markets exchanges of the future are going to be digital, right? And again, imagine if they were taking custody risk and they died. They failed in custody, and then the whole exchange, the whole capital market went down. That'd be devastating. The second risk, which I think capital markets need to be protected from, is counterparty credit risk. This is what took out Lehman Brothers. Lehman Brothers, 100-plus-year-old organization. When it comes to credit, humans, safety and soundness as we wish, we make mistakes, and it's difficult. So imagine if the New York Stock Exchange had been doing what Lehman Brothers was doing, right? So it's terrible that Lehman Brothers went down. All of their clients obviously wrecked and devastated. But imagine if the entire capital market went down as well. So I think market structure is separating out some of these functions so that the capital market is protected. When BitGo was forming, we started out with that technology, security, multi-sig, MPC, all this stuff. On top of that, we built custody, regulated. Okay, we got that piece. We were now an island. So, you couldn't do it. You like the cold storage, you put it there, but
to buy and sell, you'd have to send it out.
You'd have to go somewhere else, and this is because we didn't have market structure. So, anyway, you had this terrible trade-off of: do you want the security and safety, or do you want to have liquidity? And you'd have to take it out of our deep cold storage, which you liked and you did diligence on. It was so good. You had to put on some rickety exchange. So you shouldn't have to make this decision. You should be able to have both security that you want, and you should also be able to have liquidity at the same time. Market structure provides that. As a side effect, which I think is really important, the market structure allows you to have choice. So now you can be like, okay, I'm a buyer. I'm going to do my custody over here. This other buyer is going to do his custody over there. The seller is going to have his custody somewhere else. You've got multiple custodians, right? And it's all away from the exchange. You can all trade together. And the same thing is true with where you get leverage.
And the custodians would net out with each other? Is that like...
So we haven't quite gotten there yet. A bunch of ways that could happen. Yes, it could be done with net. It could also be done just atomically on chain. There's pros and cons to both. But yes, this is what market structure would do. You can have your bank, right? Somebody else can have their bank, and on the equities market, you can still trade together. Now you connect to a broker, right? And then you can have a broker, and he can have a different broker. Again, you've got choice, and those brokers compete on a whole bunch of different types of services and what types of things they trade and what kinds of leverage they'll give you. So anyway, my point is the market structure, I think, should have three things. Number one, fiduciary protected accounts everywhere. Number two, protect the exchange. And the two main risks that we see is custody risk, counterparty credit risk. As a side effect of having separated those out from the exchange, the consumer gets choice.
All right, we're almost on time, but I want to ask you maybe a more fun question, which is, you're a technologist. You've written many lines of code. What do you make of this AI coding? Have you installed OpenClaw on your Mac Mini?
I did. Yes, I did. It's incredibly exciting, for sure. I think it's like a junior engineer right now. Obviously, this is going to get better. So I did an experiment actually, and I gave OpenClaw I gave him a little coding task and some open source software. And his task was to go write some unit tests for like the least covered part of this code base. And he gave me a nice analysis. It was like, okay, great. I'm going to go do some on this module. And I said, go write those tests. He did a great job, like 4,000 lines of tests. It was great. And I said, great, well, this looks pretty good. Actually, I made sure it was okay. Had him submit the pull request. And the maintainer of the library bounced it back and said immediately, we already have this. This is redundant. I go back to OpenClaw and I say, why did you tell me this was uncovered? He's like, oh, I made a mistake.
Yeah.
So it's just like a junior engineer, right? You hire some new guy and you say, hey, go look at this segment and da-da-da. And he doesn't know everything yet, and he's trying to figure it out, and he accidentally wastes his time on something that a more senior guy knew instantly. So inside of the OpenAI, there's this context window you've probably heard about, and we don't really have, and maybe the AI guys do, but I think in general, we don't have a good way to make a measurement between, okay, a context window of this size for AI is equivalent to what I would expect for this from a human, right? So you and I, if I train you up, I kind of have an expectation. Day one, you're going to do this. Week one, you're going to do that. Month one, you're going to do something else, and you're going to retain the information. If you can't do that, well, you're not a good enough engineer, so we're going to let go of you. With AI, you've got a context window, and we don't know exactly how that interprets into depth yet. But look, I mean, it's very exciting. It's coming. There's some aspects of what AI is going to do in terms of coding, which I think is going to be better than humans. So I can go into detail if you want.
Yeah, well, so you see the trajectory going in that direction. You don't think it's going to be stuck at junior developer?
No, it's going to get better, yeah.
Well, Mike, it was great to have you back on the show, and I really appreciate your time here at the conference.
Thank you, Pierre. It's been great.
And for our audience, if you enjoyed this conversation, follow us on X at Bitcoin for Corps, and also make sure to subscribe on YouTube to get all the future episodes. And of course, share it with your coworkers, friends, and family who are interested in this new wave of Bitcoin adoption. Thank you, and we'll see you on the next episode.
Hello, everyone, and good evening. I'm CJ, Head of Investor Relations at Strategy. I'm excited to moderate Strategy's second quarter 2026 earnings webinar for you. We will start the call with a 60-minute presentation, starting with Andrew Kang, followed by Feng Li, and then Michael Saylor. This will be followed by a 30-minute interactive Q&A session with 4 Wall Street equity analysts and 4 Bitcoin analysts. Before we proceed, I will read the safe harbor statement. Some of the information we provide in this presentation regarding our future expectations, plans, and prospects may constitute forward-looking statements. Actual results may differ materially from these forward-looking statements due to various important factors, including fluctuations in the price of Bitcoin and the risk factors discussed under the caption Risk Factors in Strategy's quarterly report on Form 10-Q filed with the SEC on May 6, 2026, and the risks described in other filings that Strategy may make with the SEC. We assume no obligation to update these forward-looking statements, which speak only as of today. With that, I will turn the call over to Andrew Kang, CFO of Strategy.
Thank you, CJ, and thank you all for joining our call today. Moving on to the first slide, we now hold 843,775,000 Bitcoin, representing approximately 4% of all Bitcoin that will ever exist. Bitcoin per share is currently 203,683 sats, which remains one of the cleanest measures of how we create long-term value for our shareholders. Our market cap is approximately $38 billion, and year-to-date we have raised $17 billion of capital across common equity and digital credit. That capital gives us the strength to continue building our overall Bitcoin holdings, manage our capital structure, meet our dividend and interest obligations, and support the growth of our digital credit platform. On this slide, we show that we adopted Bitcoin as a treasury asset beginning in Q3 of 2020. We have accumulated more Bitcoin in every single quarter across 113 acquisitions. And today we hold again, 843,775 Bitcoin, with a Bitcoin reserve value of approximately $55 billion. Our total acquisition cost is approximately $64 billion, and our average purchase price is roughly $75,000 per Bitcoin. Strategy is now the largest institutional holder of Bitcoin in the world. Our holdings are larger than the largest Bitcoin ETFs shown here. They're larger than the estimated holdings of any nation state and larger than the major DeFi custody balances. That scale matters, and it reinforces Strategy's unique position in the digital assets market. We are not just participating in institutional Bitcoin adoption, we are leading it. Doing so as an operating company with access to the capital markets, a growing digital credit platform, and a long-term objective of increasing Bitcoin per share for our shareholders. Now turning to the balance sheet. Q2 reflected active execution across all of our operations and our capital structure. Digital assets ended the quarter at $49.7 billion, having acquired a net 83,901 Bitcoin during the quarter, with the total balance sheet holdings now slightly lower due to the lower price of Bitcoin as of the end of Q2. Cash and short-term investments increased to $2.4 billion as of the quarter end, and now even further to $3.75 billion current quarter to date. And now we hold over 2 years of dividend and interest coverage, and also reflect our goal of continuing to replenish the USD reserve to support our digital credit instruments. Long-term debt declined from $8.2 billion to $6.7 billion, driven by the $1.5 billion repurchase of convertible debt, which we executed at an 8% discount in Q2. And preferred equity increased from $9 billion to $14.4 billion, driven by the strong issuance of STRC during Q2. We began the quarter with just over 762,000 Bitcoin, with a market value of $51.6 billion. During that quarter, we accumulated more Bitcoin, adding a net 83,901 Bitcoin and an average price of approximately $75,500. At quarter end, we held 846,000 Bitcoin, and the quarter end Bitcoin price was approximately $58,700, resulting in a Q2 unrealized fair value loss of approximately $8.3 billion. After quarter end, we have seen a recovery in the market value of our Bitcoin holdings. Quarter to date through July 27th, we did sell 2,225 Bitcoin for approximately $135 million. And with Bitcoin price increasing to approximately $65,000 per Bitcoin, we currently would reflect an estimated fair value gain of about $5.2 billion on our total holdings. And our digital assets balance sheet will have increased to approximately $54.8 billion. As of July 27th, our total reserve, which includes our BTC reserve and our US dollar cash reserve, was $58.5 billion, with a net reserve of approximately $36.3 billion, which nets out our out-of-the-money convertible debt and preferred equity balances. Here, amplification, calculated as our BTC reserve of approximately $58 billion divided by net reserves of $36 billion, is over 1.5 times. Amplification represents our total Bitcoin as a multiple of reserves remaining after taking into account our debt and preferred claims. We have $15.4 billion of preferred equity outstanding and $6.7 billion of convertible debt outstanding, and a low net leverage of 5.4%, which reflects our debt less our cash reserves divided by our BTC reserve. At a current Bitcoin price of roughly $65,000, our approximately $55 billion of Bitcoin reserves provides an 18.5x BTC rating against our net debt of about $3 billion. In an extreme stress case, As you can see here in the middle of the slide, even with a 95% Bitcoin price decline to roughly $4,000 per Bitcoin, our converts would remain fully covered at a 1.0x BTC rating. Over time, our plan remains to equitize, repay, or refinance existing convertible debt while continuing to maintain strong collateral coverage. And as we demonstrated in Q2, we believe the market remains open to all of these options. We plan to remain patient, monitor the market conditions, and continue to focus on the overall liability management of our outstanding debt. Turning to the Q2 financial results, we reported an operating loss of $8.3 billion, a net loss of $8.6 billion, and an EPS of negative $24.45 per share. These results were driven by the quarter-end non-cash fair value mark-to-market of our Bitcoin holdings. Our focus remains on the long-term drivers we can control, which include capital allocation, balance sheet strength, the strengthening of our digital credit instruments, and increasing Bitcoin per share over the long term. And I mentioned earlier, quarter to date, with Bitcoin price having increased to closer to $65,000, our current fair value mark to market of our holdings would reflect about a $5.2 billion gain. Turning to our Bitcoin KPIs, as of July 26th, Bitcoin per share was 203,683 sats compared to about 191,904 sats in July of 2025, which is an increase of about 6% year over year. Year-to-date BTC yield is currently 4.5% compared to about 22.8% for the full year 2025. BTC gain is approximately 30,000 Bitcoin year-to-date, which is about 30% of last year's full year gain. And in dollar terms, BTC dollar gain is approximately $2 billion year-to-date compared to about $8.9 billion for the full year 2025. Despite the significant drawdown in BTC price year over year, we continue to execute positive performance across all of our core KPIs. Since 2020, our Bitcoin per share has increased from approximately 46,000 sats to 203,000 sats, which is more than a 4x increase over that period. And in 2006, we have delivered, as I mentioned, 4.5% BTC yield year to date. As you can see here, historical annual BTC yield performance does move sort of in conjunction with Bitcoin price. In Bitcoin bear markets like we saw in 22 and 23, BTC yield was lower than the bull market years of 24 and 25. That being said, BTC yield this year does have the potential to outperform the prior bear market if BTC price improves and through the support and strengthening of our digital credit instruments. On this slide, we show here in Q2, within Q2, Bitcoin per share increased approximately 201,170 sats at the end of Q1 to approximately 210,824 sats at the end of Q2. Despite the lower price of Bitcoin and the overall market volatility in Q2, the quarter's BTC yield of 5% outperformed the Q1 BTC yield of 3.2%. So we are continuing to make good progress. And lastly, I will end with a quick snapshot on the most recent view from our equity analysts. We added 2 new covering analysts from Barclays and Siebert for a total coverage of now 16. Across the firms shown here, the average analyst Bitcoin price target, for those that have one, is approximately $98,000. The average MSTR price target is approximately $296, and all with corresponding buy ratings. While we do not endorse any third-party forecasts, it's important to note that the banks are increasing their engagement with Bitcoin, with digital capital, and with a focus on Strategy's role within that market. I think the growth also reflects the deep and growing demand from investors as well for independent institutional views on Bitcoin strategy and digital credit. And it helps deepen investor understanding of our business model, our capital structure, and the long-term value we are pursuing for our shareholders. So with that, I thank you all for your time, and I will turn it over to Peng for his remarks.
Thank you, Andrew. Thank you, everyone, for joining us this evening. I'm going to provide an update on our capital market strategy and our capital markets programs. And before I go into some of those details, I do also want to recap Q2 2026. We acknowledge that it was an up and down quarter for Bitcoin, and our common equity and our preferred have gone down in that period of time. But if I look at the key metrics that we look at for performance and health of the business, things are generally speaking positive. Our Bitcoin holdings over the course of the quarter increased 11% from 762,099 Bitcoin to 846,000 Bitcoin. We reduced our debt outstanding from $8.2 billion to $6.7 billion. And on a net debt basis, we reduced it even more. This was down 18%. Our US dollar reserve is up from $2.1 billion to $2.4 billion at the end of Q2. And as Andrew noted, we're now at $3.75 billion. That's a 12% increase quarter over quarter. And our Bitcoin per share, potentially our most important of our metrics, went from 201,170 Satoshis to 210,824 Satoshis, so a 5% increase. So many of these metrics show health in the overall business. How were we able to do that? 3 months ago in our earnings call, we said that we were adding engines to the strategy playbook, if you will. We went from one-way capital issuance, buying Bitcoin through active issuance of MSTR, of our preferreds and our convertibles, to what we call active capital management. We're able to sell MSTR to buy Bitcoin, US dollars, debt, prefs. We're able to sell our prefs to buy Bitcoin, US dollars, debt, MSTR. And we're also able to sell our Bitcoin to buy US dollars, buy debt, buy prefs, buy MSTR. And we're able to use those US dollars to pay off dividends and to strengthen our balance sheet. We continue to be net buyers of Bitcoin and net issuers of Stretch. We want to be the largest buyer of Bitcoin in the world and the biggest issuer of digital credit in the world. And year to date, 2026, we have proven to be just that. We bought 174,895 Bitcoin year to date 2026. We sold 3,620 Bitcoin during that same period of time. We bought 48